All right, 9 o'clock here in New York City on this Friday, February 19th, 2021. Welcome to Yahoo Finance Live. I am Miles Upton, joined as always by Julie Hyman and Brian Sazzi. Let's take a look at futures this morning. We are seeing futures with a little bit of a bid here. All three majors pointing to gains at the open. Nasdaq futures, which have been underperforming, the Nasdaq overall have been underperforming, outperforming here as we get set to start the week's final trading session, up about 0.7 of 1%. Let's take a look at what's happening over in crypto land. Looking at the price of Bitcoin, of course, we have seen Bitcoin at a record this week, and we see it again closing in on 53,000. Why not? Another day, another record. I suppose we were joking with Melton Demir's at CoinShares earlier this week about Bitcoin 80,000, Bitcoin 100,000. I suppose we should just take the under on how long it does indeed take us to get there. But the big story remains this morning, that hearing that we had on Capitol Hill yesterday regarding all of the trading in GameStop and other names. We see here Robinhood CEO Vlad Tenev, there's Gabe Plotkin of Melvin Capital, Ken Griffin, Citadel, and here, of course, the star of the show, Keith Gill, Roaring Kitty. And he really stole the show right off the top. Let's take a listen to Gill's introduction of himself.
A few things I am not. I am not a cat. I am not an institutional investor, nor am I a hedge fund. I do not have clients, and I do not provide personalized investment advice for fees or commissions. I'm just an individual whose investment in GameStop and posts on social media were based upon my own research and analysis.
And I think, look, Keith Gill has kind of been the hero of this story all the way from the beginning. And who doesn't win the hearts and minds of the public when they begin their testimony before members of the House of Representatives by specifying that they are not a cat? Julie, Brian, I know that we all watched probably a little bit too much of this for our liking yesterday. Julie, let's start, I guess, talking a little bit about Gill. I know we're going to get into some of the stuff that Vlad Tenev said, and we're going to talk to a representative later who asked some questions of Ken Griffin. But just thinking about Roaring Kitty's role in this whole thing, I thought that he made very clear what he sees himself as and what avatar he thinks he serves for the Robinhood community, which is a pre-informed individual investor who wants to make one big bet for themselves and isn't all that worried about all this conspiracy nonsense that kind of started the hearing in the first place.
Well, and started the hearing in the first place, but that really didn't get that many questions when all was said and done, right? The whole conspiracy collusion angle of all of it didn't get a lot of air from the members of Congress. They reserved most of their questions for Vlad Tenev of Robinhood, although most of them didn't say Vlad Tenev. They pronounced it many different flavors and varieties over the course of that many hours long hearing. But they did focus most of their questioning on him. But again, it wasn't very targeted in terms of topic. But some of the interesting sort of lines of questioning that came out of it had to do with things like trading on margin and had to do with how retail investors on the Robinhood platform actually perform. And even if we didn't get the full scope of the answers to those questions in the hearing, it seems like that perhaps at some point we'll hear again from Tenev, or when he eventually replies. You know, you always hear about these promises to follow up on questions in these hearings, and I don't always hear what the actual follow-up answers are, but that frequently happens where a person being questioned will say, I'll get you that answer, Congressman. So we'll see what ends up happening here. And do we want to, let's listen actually to what Vlad had to say about the question of trading on margin.
To clarify your point on the $1,000 margin, that's actually something that we refer to as Robinhood Instant, and it's provided as a courtesy. When a customer initiates a deposit, we allow them access to up to $1,000 of that deposit immediately. Similar to how if you deposit a check at a bank, as a courtesy, they might provide access to those funds or a portion of them before that check clears. As for margin specifically, borrowing money on margin, the rules are very ironclad industry-wide. Obviously, Robinhood Securities conforms to all of the applicable rules. And Robinhood's product is in many ways more restrictive than that of our competitors, because in order to even qualify for borrowing on margin, you have to be a Robinhood Gold customer, which involves paying $5 a month for the service.
Yep, you have to pay $5 a month to be a Robinhood Gold customer. I mean, presumably there are other things that they do, credit checks and whatnot, in order to allow you to trade on margin. But, you know, guys, this speaks to the whole gamification allegation against Robinhood, right? Does something inherent to the Robinhood platform versus the many other online brokerages out there, does it encourage risk taking in a way that the others don't? Sazi, I know, you know, this is something, as I know that this speaks to your sort of fundamental trading background here when we talk about these issues like this. But, you know, I don't know that, I mean, personally, I don't know that Robinhood does more than the others, but who knows? It's a good question.
Who does know, Julie and Miles? But, you know, my analysis off of this was very simple. I have a couple bullet points. First up, you know, you get the sense that Robinhood is not prepared for another black swan event. You know, that's what they used the term. Tenev used the term black swan yesterday, and you get the sense that they might have to raise more capital, and then, you know what, raise more capital and more capital after that to cushion themselves ahead of a world that is only going to get even faster in terms of trading. And then last but not least, I do think, you know, you watch Tenev up there, and I think this is a bullish event for the likes of Schwab and interactive brokers, more established trading platforms for their retail customers. I wouldn't be surprised if those two platforms gain some Robinhood customers off of this event here. I think you would want to maybe go with a more established name if you're a retail trader, that you just feel better about giving them your money, and then you'll get it back.
Yeah, and I know that, and you know, there was a graphic from the New York Times this morning. Tenev got like 120 some odd questions, and I think the most next questioned witness was Ken Griffin, who got somewhere in the ballpark of 30 or 40 questions, and then it was down from there. Steve Huffman of Reddit, you know, I was kind of wondering what he's doing there, but he said a couple interesting things, but he only got a handful of questions. I mean, this was really a hearing about Robinhood, and I think so many lawmakers had stories about family members or constituents who had gotten involved with the markets using their app. But Sazi, I will say to that question of, you know, does a Schwab gain, does a TD Ameritrade gain as a result of this? I just still don't think that most investors that are now in the markets for the first time because of Robinhood really even know that those companies exist, right? I mean, the whole thing with Robinhood, and I think it still is their advantage, and I would actually say after this testimony, the case for them going public and growing and being an ever larger company is probably strengthened. I mean, yeah, I don't think there were a couple timeline questions where Tenev kind of messed himself up, and there was one exchange kind of towards the end where, you know, they kept going back to that timeline of the day they had to post the capital, and he was sort of said something he maybe shouldn't have said in terms of whether they could have gotten the capital, what would have happened had they not gotten the capital, and he cleaned it up in a later response. But I do think overall the brand remains as strong as it was before this incident. And I just think that maybe in the business press, in a space where, you know, to us, Schwab and Ameritrade and all these other people, they're all household names. To the general public, most people don't care about stocks at all. They only now care about stocks because Robinhood has made it easy for them to care about stocks. And, you know, to that point about the black swan event, there's a circularity here, right, where Robinhood itself creates the conditions for this kind of event. And those events may happen in the future, but in a weird roundabout way, that circularity, you know, affirms how important they are, right, within the market.
Well, here's your deep thought for the weekend, Miles, and I definitely want you to think on this here. Does this situation just strengthen the 13 million people on the platform? Does it just strengthen their resolve and why they love Robinhood? Perhaps, but does it attract more new users to Robinhood to the point where they can grow their already inflated valuation and eventually go public? To be determined.
Or none of them care. They didn't watch the hearing, and they're just going to stay on Robinhood.
Well, that too, Julie.
Anyway.
Well, that too.
Well, and I will say on that point too, and the official feed on YouTube that I watched didn't have comments, but a lot of, you know, other media organizations, including ours, were streaming it. They all had comments. Anytime Keith Gill spoke, everyone went nuts with approval. Everyone loves Keith Gill. And so I think to your point, Julie, people watched and they did the thing that always happens. They said, I can't believe that these are our representatives, blah, 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 blah. But then they waited for their hero, Mr. Roaring Kitty. He came on and they're like, this is my guy. And he, at one point, he digressed into this big fundamental take on GameStop's business. Again, that's his bit. And a lawmaker cut him off. They're like, all right, I got it. I don't really care if GameStop is a good business or not, but he's so passionate about it. And I do think people connect with that. All right, let's stay on the topic of markets, thinking about the role of retail, and talk a little bit more about what's happening on the fixed income side as well. Billy Holt joins us now. He is the markets president over at TradeWeb. Billy, it's great to talk with you this morning. I'd love to begin by just asking about the role that retail plays in the market as far as you guys see it, and how that's changed for your platform in the last year, how that conversation has changed with folks in the industry who saw it going one way for a long time, and now it's really been quite an interesting year.
I was happy Friday, guys. I was listening to how you guys were describing yesterday, and I was kind of watching along with you guys. It was absolutely riveting television. And I would kind of say that I kind of agree who the kind of hero of the day was. The kind of I am not a cat moment, I think, is a moment that we all kind of have now kind of seared in our brain. It was just, it was an amazing kind of television day, and you guys covered it great. It was a fun kind of afternoon to kind of watch what was happening. The fixed income market has always traditionally been an institutional market, right? So TradeWeb kind of lives and breathes in the institutional market. We're really in the network business of connecting, the biggest buy-side clients, the pension funds, the hedge funds, the asset managers, the central banks into the biggest banks, the market makers, JP Morgan, Goldman Sachs, Morgan Stanley, et cetera, across all the kind of big liquid areas of fixed income, from, on-the-run government bonds to high-yield credit, ETFs, global derivatives. We're kind of in all of that game. And it's been an incredibly interesting year for us, and in part because the markets are super interesting, obviously, around volatility before and after the election. Obviously, everything that happened in March was a huge deal around how the bond market was functioning. And now you have all this kind of big, heavy issuance happening in both credit and government bonds. And oh, by the way, work from home has kind of changed kind of everything. So I grew up, I'm a little bit older than you guys. I grew up kind of reading kind of Liar's Poker. So I grew up as a bond guy, and I always kind of knew the sort of bond market as these big kind of characters historically at all of these banks. Kind of, it was, it's a Friday morning. It would be hamburgers at 10 o'clock. And these were big, forceful personalities. And it's amazing to see how the electronic world has kind of risen inside of fixed income. And it's a really big kind of moment for us as a company.
Well, now we have no time, Billy, to eat hamburgers during the session because things are moving so fast. But we'd love to get your thoughts on real-time trade settlement. How is that going to be a thing? How heavy a lift would that be?
In fixed income, I think the fixed income market operates really well in terms of kind of how that settlement process works, particularly in the liquid areas around government bonds. I think we've kind of had that sort of the plumbing around all of that nailed. I have kind of learned one thing this year, and I think you guys know this really well, which is basically anything can happen. And we're always going to try to get to the best answer around all of this stuff. The one thing I was kind of thinking about yesterday as I was watching was just really understanding the plumbing of how these markets work is really, really important. And also articulating the plumbing is really, really important. So, the operating of fixed income has worked traditionally really, really well. That being said, we all know anything can kind of happen, and we're going to stay very focused on making sure it continues to operate very well.
Billy, Julie here. I want to ask about something that we've been talking a lot about, and that this is a reflection of, is increased risk taking in the market. And I am curious about that on the fixed income side. And one example maybe of that is that MicroStrategy convertible debt offering that we saw earlier in the week. They got upsized from $600 million to $900 million with basically a way for fixed income investors potentially to play crypto. And I'm curious if that is emblematic of this reaching that we're getting in all sectors of the market for yield, for return, and whether there is any risk in that.
It could be. It's a great question. I mean, I think that we're all trying to figure out on some level where the yield curve is going. Is there a moment in time where the right trade becomes around shorting interest rates? Obviously, and you guys cover this extremely well, the rise of Bitcoin is kind of a part of all of this. What is Bitcoin? Is it an asset class or not? Is it correlated to the market or not? I think the participants, especially on the retail side, are getting more and more sophisticated. And I think that's one of the things, quite honestly, that came out yesterday was just the level of sophistication has risen. And I think ultimately that sophistication is going to connect more into fixed income. And so we'll see more of that going forward. It's a great question, though.
Billy, I want to ask a bit about, and you mentioned, the old trading floor, the liar's poker vibe. I remember my dad was doing the communities for something back in the 90s, right? It was a whole thing. Seemed very cool, very fun. That's not coming back.
I'm the 80s, but it's okay. Yeah.
Yeah. William Simon back in the day. Anyway, so, that whole thing was very fun, but that's over. Do you think that working from home during COVID, I know a lot of banks have brought people back to the floor, but has that even further accelerated the distribution of trading teams, geographically? Because certainly things have worked okay for the most part with kind of a hybrid setup, only a couple guys in the office. And is this going to make big institutional firms rethink their physical footprint, especially with a platform like yours enabling that digital trading as well?
Yeah, there's no question. It's a great point. Look, those days are kind of over. You're right about that. That being said, the business still stays, I think, in a really good way, relationship based, right? So the relationship component to fixed income trading is really, really important. That being said, the work from home environment has absolutely accelerated ultimately the electronification of these markets, and there's no going back. So let's kind of start there and understand that. My general instinct is New York City is always going to be a major player around how these markets operate. It's been a rough year for New York. We all kind of know that really well. But it's kind of where the action has historically always been. My general instinct is New York's always going to play a very large role around the marketplaces. And I think the big banks and all the major players will continue to have a big presence in New York. That's my hope. I'm a New Yorker. I love this city, and I want it back to where it was.
I think we can all agree on that as we sit here and distribute it across the New York metro area. All right, Billy Holt, president at TradeWeb Markets. Billy, really great to get some time with you this morning. I hope we can talk soon.
You guys are great. Thanks very much for having me on.
All right, coming up on the other side, a lot more here, especially that ruling over in the UK on Uber. We'll get into all that coming up right on the other side of this break.
This is Yahoo Finance Live. We are looking over to the UK this morning because there was an important court ruling that has to do with Uber, quite similar to the court and legislative battles that Uber underwent in the state of California. Our Latoya Harding is joining us now from the UK to explain this ruling and its importance. Good morning, Latoya.
Morning. Yeah, that's right. Yeah, Uber lost a pivotal Supreme Court case on drivers' rights in the UK today. So it was basically ruled that Uber drivers in Britain qualify as workers rather than contractors. So that means that they are qualified for full employment rights. So there are around about 40,000 Uber drivers in the UK, and they're now entitled to minimum wage, holiday pay, sick pay, and rest breaks. The union which supported Uber drivers who brought the claim, GMB, they called the judgment an historic win, was the words that they used today. And of course, it was a long-running battle. But the case in itself comes as a blow for the company, and it could lead to compensation claims from other drivers elsewhere, and also a challenge to Uber's business model in the UK too. So that's affected Uber shares today, down pre-market at the moment. Now, just quickly with markets for us here across the pond, it's been a subdued start to the day, but they are all higher, and that's on the back of a vaccine-led recovery, vaccine rollouts across Europe. So the FTSE, the DAX, the CAC, they're all in positive territory at the moment. And of course, restrictions hopefully easing in the coming weeks, also pushing markets higher. The FTSE managing to shake off the pound after 3 consecutive days of decline. And that's also even with a firmer pound, which hit highs against the dollar today at $1.40. And again, that's a level not seen since April 2019. And so we've also had data as well today. So again, the FTSE managing to climb in the pound also, despite having a bit of negative data today with UK retail sales falling and government borrowing. Again, it's at the cost of about £8 billion in January. So yeah, that's the news from us over this side of the pond.
Latoya, thanks. Fingers crossed also for you guys that restrictions start to ease in the coming weeks. I know it has been tough, as I've been hearing from my friends over there. So be well. Have a great weekend. We'll check back in with you next week. And when we come back, we are going to take a check on the markets as we open for the regular session of trading. We're also going to hear from one of the congressmen who was participating in that hearing that we all watched yesterday. Stay tuned.
All right, welcome back to Yahoo Finance Live. Just a couple of minutes away from the opening bell here on this Friday morning. We see stock futures are pointing to a higher open as we wrap up this holiday-shortened trading week. But just as we came on the air, we mentioned Bitcoin had been pushing higher. We saw another record high for the cryptocurrency. Jared Blick rejoins us now to talk a bit more about this and all things markets. But Jared, let's just start with what we're seeing over in the coins, because this is, I think by my count, the third time in 4 days now that during this period we have talked about another 1,000 increment milestone for Bitcoin above 50K.
That's right. You got to get your hats in early here. And not a lot of whole new moves or news that's making these moves happen or catalyzing them. We have seen so many different entities, especially in the financial sector, coming out and buying Bitcoin. The cadence has slowed a bit, but all it's going to take is one more big name like Apple or somebody else. Lots of speculation around that. You got to think there's a lot more gas in the can for this move. And also Ether. Looks like it's up about 78 basis points here over the trailing week, still up 3.5, just hit another record high overnight. And then some of the other coins have really been getting some juice here. BNB, that is a Binance coin, that is up 110% over the last 7 days. So I think the speculative money is going into some of the cheaper, less known coins, and there could be a game of catch up here with the big guys like Bitcoin and Ether.
Yeah, even as the enthusiasm sort of becomes its own kind of risk, if people are getting out too far on a limb as they make bets on all these cryptocurrencies, which is something that Meltem Demirs, when we talked to her earlier in the week, brought up. I want to talk about regular old-fashioned currency that we watch, the dollar, and bonds, which where we're seeing the yields push up once again, Jared.
Yeah, we have the 30-year at about 1.31, 1.32%. I'm pulling up a chart right now in the interactive. So here's a 10-year T-note yield 2-month, and you can see it's up quite a bit. We were at 90 basis points roughly at the beginning of the year here. So we are now 40, 42 basis points above that. And this could have some effects on the risk markets that we cover, not in the long term, but in the short term. When the bond market gets ahead of itself, we have these rising yields. Guess what? That makes our currency more attractive. People pile into the dollar to get these higher yields. And so we are indeed not seeing too much pressure on the dollar right now. It's been down over the last 2 days, kind of a wash for the week here. But if this trend keeps continuing, the 10-year gets up to 1.5%, much less 2%, probably going to have a big sell-off in EM, emerging markets. But that's just kind of a headwind to look at down the road here.
All right, Jared, as we prep for the opening bell here, let's. I know you watched with much interest the hearings yesterday, and we're going to talk again to Representative Troy Hollingsworth of Indiana in just a few minutes about this. I'd love to just get some of your high-level thoughts on what came out of the hearing yesterday, really from any party. Obviously, Vlad Tenev got a lot of the questions, but certainly as someone who's been in the markets a long time, what Ken Griffin had to say certainly of interest to you as well.
Oh, yeah. And we learned that there were 5 people in the room with him at the time. That was one of the pointed questions at the end of the testimony. But it just goes to show you these hearings have really changed the game. In the old days, you'd have those guys, you'd have your support staff behind you. They'd be passing you notes. And now it's all electronic. We only got 2 5-minute breaks in the entire hearing. I was sitting there in our rooms throughout the entire thing. That's my takeaway. But no, I have some serious ones. T+2, not coming for years. It would wreak havoc in the margin system if it were implemented immediately. So I think there'll be T+1 maybe in a year or two, but it's going to take a while. And then Ken Griffin really had some interesting things to push about the sub-pennyization of markets again. And since 2005, it's been illegal for stocks that are over a price of $1 to be quoted in fewer increments than 1 penny. Looks like we got the opening bell right there. But I don't think this is going to work out in the long term. If you want to take, the situation we have with the off-exchange dark pools, and that includes some of the market makers like Citadel, you take the problems with that market because they can sub-penny quote, you put them into the regular market. I think that's just going to drive less liquidity and less transparency in the markets, but that's going to be a big discussion. He brought it up multiple times, so I don't think that's going anywhere. Finally, not a lot of talk about suitability and leverage. Interesting statement by somebody who I would consider a libertarian, maybe, saying that we need to get rid of the accredited investor rules so everybody can find the next Apple and ride that bandwagon. But the issue of whether The firm Robinhood actually stuck to their suitability guidelines. That's a legal issue that wasn't raised. So I think there could be some follow-up there in the Senate.
Yeah, and Jared, it was interesting to kind of hear about the subpennyization, and Ken Griffin was just on CNBC, and I just saw a headline that he he said they can't trade in penny increments, but I think he misspoke because they can't be quoted in smaller than penny increments. But of course, the trade can itself clear at an increment that is tighter than that.
If it goes to a dark pool, it can be. But then you got the issue of front running. So, like I said, don't bring that to the regular markets.
Yeah, and then I guess just also finally, like on the Keith Gill side, the individual investor side, we've talked so much about the role that retail plays, and I think you and I would both agree, and I think Sazi and Julie agree as well, that retail investors are far more sophisticated than gets kind of discussed maybe in some corners of the market. And I thought, Gill did a great job representing that faction of the market. Obviously, there's people who went in and bought AMC just for fun and, all those problems that caused. But in general, people have probably never been more informed with respect to their own investments in the market.
Yeah, and I think that's a trend that's going to continue. We have an incredibly huge swath of new traders entering the market. I get DMs, thoughtful, intelligent questions on Twitter all the time. I try to respond to them. It's going to take some time to educate this new class of investors. You got to live through various market types of markets, different genres, trading epics, as I call them. And we've only been in a couple, and one major one and maybe 2 or 3 minor ones. So it takes years at this, but people are going to learn that there are so many ways in trading to be separated from the cash in your account. And GameStop just proved it's probably only one of them.
That's right. Especially, there were a lot of questions about the gamification of Robinhood. That's a great way to frame it as well, Jared. Ways for the market to separate you from your cash. All right, let's stay on this topic and talk to someone who was a part of the hearing yesterday. Trey Hollingsworth is a representative from the state of Indiana, member of the House Financial Services Committee. Congressman, thanks so much for joining the program this morning. I'd love to start with asking you about your line of questioning, because you only spoke to Ken Griffin and you had some really pointed questions there around off-exchange trading and tick sizes there. And I'm just curious, is this something that you and your staff are looking at to engage with the SEC on, and sort of what drove the impetus to spend some time with someone who knows a lot about that, getting into the arcana really of financial markets?
Absolutely. It is something that we're starting to look into. I want to make sure that we look at all aspects of policy framework and how this huge increase over the last 20 years of off-exchange trading, whether it has some deleterious impacts on the market or whether alternatively this is just a large trend that public policy has no ability to affect. I want to make sure that we've got the right framework to allow our exchanges to compete on a level playing field with those off-exchange dark pools.
Hi, Congressman. We heard a lot yesterday from many, especially on the other side of the aisle, saying that as you democratize trading, you need to make sure that you're watching out for retail investors. Some of them saying that Robinhood and other platforms aren't doing enough to protect those investors. What do you think about that?
Well, look, I certainly understand the idea that we've got a new class of traders that are just getting into the market. As was said just a few minutes ago, it takes real experience to understand how you can hold on to your money and grow your money over time. I want to make sure that we don't erect barriers that keep those new investors out of the market. I understand that my friends across the aisle want to make sure that they are well protected, but we shouldn't put new regulations in place under the name of protection that in fact just exclude a class of investors from being able to participate in financial markets. I think what I hear all the way across the district every single day is the feeling as though there are two financial worlds, one for the wealthy and one for those that aren't quite wealthy yet. And we want to make sure that we close the gap, we close the information, we close to parity so that those who want to become wealthy and control their financial future over time, that they have the ability to participate in the market.
Congressman, now that you've got a feel to just, you've felt out, you've got to see Robinhood's founder up close and personal, hear what he had to say. Do you think Robinhood as a platform, it's just a bad thing to have out there? The mere fact that it even exists?
No, I don't think Robinhood is a bad thing in and of itself. I think we've seen a whole new group of retail investors that are now participating in the market, because of Robinhood. But I think we need to help people understand that with that great power over their financial futures comes a lot of responsibility and a lot of care that needs to be taken. And I hope Robinhood will continue to participate in relaying that to their customers, that there is a long process by which you need to think through your investments, not just what you might read on Reddit, that this is not a game, this is real life, and these are your real dollars.
Congressman, it's Julie here. I wonder not just about protecting the retail investor, but sort of improving market transparency and operations overall. You know, there is the transparency issue, obviously, and both Robinhood and Citadel in the past have had to pay fines related to their own transparency practices and related to payment for order flow. But many retail investors now seem to understand they get free commissions. There is payment for order flow on the other side, and that's a price that they are willing to pay, to take, perhaps not getting the ideal price for their relatively small trades. But what about overall market functioning? Is it the best way for the overall market to function? And does that need to change?
Well, look, I would push back against that premise a little bit. What I continue to see in abundant research is, in fact, retail investors getting better execution than ever before. I think we saw research that said over $1.6 billion in price improvement in the first 6 months of last year alone that went to retail investors because of payment for order flow. So I think it's a little bit of a misunderstanding to say that retail investors aren't getting the best execution because of payment for order flow, because it's going to market makers and not going to the exchange. In fact, they're getting better execution in these dark pools than they would in the exchange. And that's really what Ken and I were talking about, is making sure that we improve the competitiveness of exchanges to compete alongside dark pools to be able to deliver best execution to every investor in the market.
Congressman, the Robinhood CEO yesterday admitted that he has made some mistakes, that the company has made mistakes, but he didn't specify exactly what he was talking about. And on a call with reporters yesterday, Chairwoman Waters said that's something she really wants to look into going forward. Did you walk away with an idea of what mistakes he could have been talking about there? And if not, is that something that you're going to dig in on in the future?
I think there is some work to be done with this, and not just specific to Robinhood, but in brokerage writ large. We want to make sure that if you're trading in a certain stock on Wednesday, that you don't wake up on a Thursday and suddenly can't trade in that stock going forward. I think we need to think through whether brokerage firms can, without due notice to their customers, cease trading in certain securities. I think that's a real problem and something that we should look into. And I know certainly the Robinhood CEO defended himself in saying that this was a 1 in 3.5 million event, I think is what he said. I think we need to make sure that we hold brokerage to a high standards so that they are prepared for those outlier Six Sigma events, so that brokerage customers are not caught unawares of that.
Well, and Congressman, I'm curious if you would, I saw this event as kind of showing the system sort of worked, right? There was time for Robinhood to get the money together so that we didn't have an even larger event, which kind of suggested was on the table there. I'm curious if you see this as proving some resilience within financial markets as they're currently arranged.
Well, I think you're asking about a different aspect of this. So number one, there's the forward-facing aspect that went to customers themselves. That's where I think the problem is, right? Customers were told, hey, you can trade in any security when it's open at any time. And then suddenly we're told otherwise with an hour, with 2 hours of notice. That's different than I think what you're talking about is what really did work was inside the plumbing of the financial system. DTCC coming to Robinhood and saying, hey, given the trading that you're doing, given the volatility of those securities, and given that your investors are predominantly on one side of that, here's the margin that is required and the collateral that is required in order for you to continue those trades. That is working to keep the system safeguarded so that we don't have the significant counterparty risk that could arise if they were failing to do that. So that did work really, really well. My concern is Robinhood not having the capital or the foresight to see necessarily that was coming down the pike, given what their retail investors were doing, and the fact that they failed to give adequate notice, in my mind, that there would be ceasing trading in certain securities. And I understand the view that we should not force a financial firm to engage in transactions that might lead to its insolvency. But I do think brokerage firms owe a duty to their clients if they've represented that you can trade in all of these securities, all of these specific times. They owe a duty to their client to make sure that they're executing on what they've told and represented.
Yeah, it sounds a little bit sometimes like Robinhood is finding out what line of business it's exactly in as these events go along. All right, Congressman Trey Hollingsworth, representative from Indiana. Really appreciate the time this morning. You can find us as Jessica Smith as well. Thank you both.
Thank you.
All right, we're off for a short break here. Again, stocks higher on this Friday morning as we settle into the week's final trading session. We're back here with a lot more on Yahoo Finance Live right after this.
I really would love for us to have some sort of laser sound effect with that graphic that we show when we come to Brian Sazzi on his takes. A little like pew pew would be, that would be ideal. You are training your lasers today on consumer price inflation, Brian, because we've been talking to a lot of consumer products companies about whether they are raising prices, and certainly we've been seeing commodity prices go higher as well.
Yeah, there's a lot of little signs of inflation floating around out there. First and foremost, we've seen the rise in the 10-year yield, sparking some inflation concerns. But we've seen big moves in recent weeks in copper prices, lumber prices, steel prices are still trading near record highs. And I've been on the prowl for inflation. And certainly we've seen also inflation too in oil and gas prices as well. But I talked to Clorox CEO Linda Rendell earlier in the week and asked if she is seeing inflation. To keep in mind, they use a lot of resin in the products they make. Here's what she said.
We're absolutely seeing the inflation across our commodities and transportation markets. And the very first thing that we do is employ the huge toolbox we have to deal with costs over the short to mid and long term. And that's a focus on strong cost savings discipline, which we deliver year after year. And so we're focused on that. We delivered our goals in fiscal year 20, and we're on track to deliver in fiscal year 21. But we're also evaluating other tools like pricing, but that's always a mid to long-term play and will be dependent on the category. We have no news to report today, but we are looking at it across our portfolio.
And that is I should note, that is the new CEO of Clorox. She just officially took over in September. Longtime Clorox executive, joined the company in 2003. But Miles, I don't think we're at the point yet where we're going to have to start talking about the Fed raising rates because of inflation. I'm really not seeing that in the CPI or the PPI numbers, but we are starting to see the first signs of inflation in many consumer goods. You look, Clorox potentially could be raising prices in coming months. We talked to Kraft Heinz CEO Miguel Patricio. He sounded like a guy ready to raise prices on some of its foods. So it lurks. It's out there. It's a potential risk.
Yeah, I think it's going to be interesting to see how that plays with consumers. One, if they notice. Two, obviously how it plays with the data, because 40% of actual CPI is housing costs. So what happens there given the lack of supply in housing? But Sazi, like, when can I go get some Clorox wipes again? It's amazing that it's been about a year, and I can find the smaller tubes in some of the grocery stores near me, not all of them. My parents go to BJ's out in New Jersey, and they say that they can't get the name brand stuff out there still. So is that supply problem for them? I mean, it's amazing that a year in, that supply problem still seems to be sitting there.
Well, Miles, I will hashtag deep tease you here. That exact story, I have a story on yahoo.com right now answering that very question. That's all I'm going to say. Julie, back to you.
Just tell me the answer.
Ooh. Everybody, go immediately, yahoo.com, to find out when you're going to get your Clorox wipes. As we take you to break, just want to mention as well that the input cost issue that I mentioned is also definitely at work. We're seeing lumber prices rise. We're seeing copper prices rise, which definitely is an issue for many of these companies that we're going to keep an eye on. And how about steel? We're going to be joined by the CEO of U.S. Steel coming up next to talk about what's going on with pricing and much more there. It's the latest as part of our infrastructure series. Stay with us.
Our next guest perhaps put it best in a recent op-ed. Steel is the backbone of infrastructure modernization. So it's only fitting that we wind down our Rebuilding America infrastructure series this week with a look inside the steel industry. Joining us now is U.S. Steel President and CEO David Burritt. David, good to see you this morning. We talked to a lot of folks in infrastructure, and we haven't focused a lot, I would say, on the Texas situation and water system. And let me just share this stat with you real quick. More than 800 public water systems serving 162 of the state's 254 counties have been disrupted because of the storm activity. that has happened in Texas. Really, just a startling stat. Is improving our water systems perhaps one of the most important things that should be in any infrastructure bill?
Well, I think that's certainly true, Brian. I think it's really important that we get this infrastructure bill off and running. You know, it's one of those things that is long overdue. I think during the Great Recession, we would have liked to have a bill. We would have liked to have a bill 4 years ago, but it seems like the time is right. And I think everybody understands where we are today, and a lot of great lessons learned from this pandemic. I call them silver linings, because these are the things that we have to get after to make this country stronger. And if we've learned anything about conditions through the pandemic, is you've got to have things that are made in the USA so that you can take care of the USA. And what we like to say at US Steel is mined, melted, and made in the USA. So whether it's water, whether it's roads and bridges, whether it's cybersecurity, these are the kinds of things that this country needs. In fact, needed years ago. And I'm glad to see that we're building back better. And as we say at US Steel, with best of both, the best of mini mills and the best of integrated mills. So whether it's water, roads, bridges, or cyber, we think this is a great time for us to have an infrastructure bill that will benefit so many people, great jobs, and certainly put the United States back where it should be, with roads and bridges and infrastructure that our population expects and frankly deserves.
David, is that one of your concerns here, that if we do get an infrastructure bill, that the U.S. infrastructure is rebuilt in the case of steel with steel from China? Look, I mean, the Section 232 tariffs are still on here. It continues to have a major impact on the steel industry. What are your thoughts?
Well, I think what we've always said, we can compete with anyone with a level playing field, but it's very, very clear that we haven't had that level playing field, and the 232 was necessary. The steel that would come from China, the illegal steel that would come from China, would find its way into Europe and then into the US. So the risk is that unless you have enforcement at the borders and you would take the 232 off, that steel that would come from Europe might actually come from Asia and find its way in. And that's the real danger. I think it's too soon to take off the 232. I think we need to make sure, I know we need to make sure that we can take care of the United States. Again, getting back to the pandemic, what did we learn? You have to have a resilient supply chain, a supply chain that you can count on. And that means making sure you have enforcement of the borders and keep the illegal steel out.
David, it's Julie here. So I want to ask, are you pushing for a measure within the infrastructure bill that would mandate some percentage of steel used in these projects would be from U.S. sources? Do you have the capacity to meet that kind of demand? If so, and I mean, how much of a boon for your business is this infrastructure bill going to be if it gets through?
Well, I think the infrastructure bill is good for everybody in the steel industry in the United States. Now, for U.S. Steel, the infrastructure bill, we look at that as in terms of construction, that would be about 15% of our business. And so in terms of what does that mean to us? I mean, I think it means more to the population than anybody else. I think what we found with the American Society for Engineers, what they say, $3,300, $3,400 savings per family that this would save. So frankly, it's less about U.S. Steel, it's less about the steel industry, and it's more about the population and creating some great jobs for people, for the customers that we serve, our customers, whether it be Yellow Products, the Caterpillars, the Deeres of the world that make the progress possible, or it's the roads and bridges that need to be repaired and contain our steel. But there are going to be great jobs there that frankly can be physically distanced during a pandemic. So I think this is something we can get on with. And it's not just a one year and done thing. This is going to be a multi-year program. And when you have multi-year programs that have good paying jobs, you really create a situation that's fantastic. And yes, we can supply the steel here from the United States. I know U.S. Steel, we've had a V-shaped recovery with the auto industry, and trying to keep up with that, but everything was turned off so dramatically in the second quarter of last year, trying to ramp up and understand what the demands are. But, I have to say, I've gone from, even back in the second quarter of last year, cautiously optimistic to, dare I say, bullish to bullish. And now I'm sensing there's going to be a super cycle here with lots of cash, liquidity from the Fed, from Powell did an incredible job last year, just amazing. And then we have the relief bill that's gone into place, and even money in that relief bill hasn't been spent, and another 1.9 trillion. So there's a lot of money on the table, ready to be spent, and spent on the infrastructure, spent on clean energy. Again, building back better. It's a great thing for this country, and I think it's going to be a great thing for the world too, to see the United States step up, collaborate, and lead.
And David, it's Miles here. Before we let you go, I want to ask a little bit about the market right now and pricing we've seen. I mean, iron ore prices have gone bonkers, really, in the last couple of months. I will say selfishly, I'm looking at trying to spec out a home gym. The stuff doesn't exist right now. There's a supply crunch. Pricing is going up. What is the bottleneck still? Is it distancing within factories? Is it the inability for product to be shipped, cross continents? And how do you kind of see that rectifying itself as we get into this economic cycle that clearly you're quite excited about?
Well, I think right now lead times are definitely extended, and we would expect those to come down later in the year. But we do think that we do have room to run through this year. And again, I do believe it's a super cycle. How long the cycle lasts, I don't know. I mean, in the past, typically a cycle would be 6 months. This could run a couple of years, especially if we get the infrastructure bill in place, and especially if we as the president says, build back better, with our best of both, as we said, kind of rolls off the tongue, mini mills and integrated mills. So I do think it's going to have an extended time frame. Weather-related issues obviously have impacted this year in terms of the supply chain. But to the extent that it's made in the United States, there's a lot better opportunity to get the supply under control and in our customers' hands faster than if imported from overseas. Because with lead times as long as what they are, by the time that the materials come in from overseas, we will have things under control here in the U.S. and better for our customers, better for us, and looking forward to a stronger future together.
All right, U.S. Steel President and CEO David Burritt, appreciate your time this morning. Good to chat with you, and congrats on the acquisition of Big River. We'll talk to you soon.
Thanks for having me, Brian. Really appreciate it.
All right, do stick around. Much more ahead on Yahoo Finance Live.
All right, welcome back to Yahoo Finance Live on this Friday morning. We're about a half hour into today's trading session. Let's take a look here as we see the major averages this morning. All three are higher as we finish out this 4-day trading week. The Nasdaq is leading here, up about 0.5%. Do want to call your attention to one name that is on the move. That's Palantir. The stock is up just about 11% this morning. Some headlines that Kathy Wood's ARK Invest had purchased. Not a lot, just about 5,200 shares of the company or so yesterday in its main fund, ARK-K. But that's kind of the moment that we're at right now. Palantir been a very popular retail name. Anything Kathy Wood does gets a lot of attention, so we see a little bit of a pop in that stock this morning. All right, we're off for a short break on the other side. A lot more here on Yahoo Finance Live on this Friday morning.
Just after 10 a.m. on this Friday, February 19th. This is Yahoo Finance Live. I'm Julie Hyman, along with Miles Udland and Brian Sozzi. Let's take a look at stocks to end the week. We've been seeing a little bit of a rally going on in the major averages today, although it is a modest one. The Dow just up 0.25%, the S&P trading above 3,900, just up 1/3%, and the Nasdaq up about 0.5% today. We, of course, continue to watch Bitcoin. The market cap there is approaching $1 trillion as the price climbs above 52,000. Actually, you see there it's getting close to 53. We're going to talk to the head of a crypto wallet company with more than 7 million users. It's the final day of our series, Infrastructure Rebuilding America. We'll focus on the tech side of the equation with Neil McDonald of HPE. And what does the Texas energy fiasco mean for President Biden's climate goals? Our Rick Newman is going to join us to explain the answer to that. But let's talk more broadly about the markets right now. We're joined by Stephen Dover. He's chief market strategist at Franklin Templeton. He's also the head of Franklin Templeton's Investment Institute. Stephen, thank you for being here. We've been talking a lot today also about the hearings that went on yesterday surrounding the whole GameStop situation. And I want to ask you and take a step back for a moment, because so many retail investors have become so interested in this market, a combination of rising prices, stimulus checks, people maybe working at home with more time to trade. But when it comes to participation in this market and getting into this market, is it too late for investors to get in here after this monster rally that we've already had?
That's a fantastic question, and probably the question we're asked the most. And certainly there are a lot of people who thought the market was overvalued, have some cash on the sidelines, and are wondering what to do. And we've had a big discussion. In fact, we had a big strategic discussion on this yesterday. And our answer is yes, you should actually enter the market at this time. We're positive on the market over the next certainly through this year, but over the next few years. And I think that there's just not enough opportunity in cash. So entering the markets would be both the equity markets and the fixed income markets with an overweight to the equity markets.
You know, and Stephen, as you guys think about, your work at Franklin Templeton and think about engaging different types of investors, what is it like engaging, institutions now, retail now? How has that game kind of changed? Because it does seem, as we sort of heard yesterday, that, individuals have never been more sophisticated. They've never had more information. How are you guys thinking about those dynamics?
Well, that's great. A great question. And I think the big change in the way that we see it is the entire investment world is becoming more institutionalized, if you will. And big financial managers like us have to treat all investors as if they're institutions and with the sophistication of institutions and looking at them in the long term. So that means institutions now are looking at higher quality investment processes. They're looking at ESG, real meaningful ESG, and they're looking at more sophisticated ways of delivering products. So that's true in the retail and that's true in the institutional areas as well.
Stephen, I just want to mention some data that we just got out a few minutes ago. The PMI, the market PMI data on manufacturing, which showed a reading in January of 58.8. That's the fastest growth for almost 6 years and the highest growth in prices, the fastest growth in prices going back to 2009. And this obviously speaks to the issues that we've been talking about in terms of input cost rising. Will we see potential feed through to inflation? How are you thinking about inflation now? And are we going to see the Fed's hand being forced a little bit more at some point?
PMIs were strong. If you look at other countries, Japan and Europe, also strong. Services, not so strong. But as soon as we come out of the pandemic, I think services will have a huge rebound. We had very good news this morning from Pfizer about only needing one vaccination, and also that you don't need the deep cold refrigeration. That means vaccinations could move quicker. So we have some pent-up demand, and that pent-up demand is very likely to result in inflation. You've just had this infrastructure week. What a perfect week for you to have that infrastructure week as we see the deep need for new infrastructure with the big winter freezes in Texas and the South. And as you just had all your guests show, commodity prices are up and infrastructure will also lead to inflation. So we're going to see inflation. I think the question that we have internally is whether that's a cyclical thing, that's just an inflation coming out of this pandemic, which the markets can handle and is expected, or whether it's going to be an endemic inflation where we see persistent inflation for a period of time. The Fed wants inflation. Fiscal spending is supportive of inflation, so we're likely to have low levels of inflation going forward.
Stephen, what's your probability for a correction in March?
I think the probability is very, very low for a correction. There's a lot of money on the sidelines and lots of stimulus, more positive news on the vaccinations. So I think it's unlikely to have a correction. As you know, you have a lot of guests, and it's almost impossible to actually predict a correction. It wouldn't be unlikely that we have some pullback in some stocks in the next few months, but that is not our prediction. And going forward, we see the markets being very positive.
Stephen, thanks for being with us today. Appreciate it. Stephen Dover is Chief Market Strategist at Franklin Templeton, and he's the head of Franklin Templeton's Investment Institute. Let's focus in on one asset in particular right now. That is Bitcoin, or cryptocurrency. If we're speaking more broadly, the price is rising once again. Looks like it's at a record once again, and it's nearing a total market value of $1 trillion. So let's talk more about that with Adam Trademan. He is the CEO of BRD, which is a crypto wallet company. So Adam, before we get into the wallet side of the equation, I would ask you first to comment on the price. You know, we've been talking to some people about Bitcoin in recent weeks. they're mostly Bitcoin people, so they're feeling pretty good about the increase that we have seen in the price. But how are you thinking about the price now? Do you think it will continue to go up, and presumably that's going to continue to sort of feed on it itself in terms of demand?
Sure. Great question. What a great time to be joining you when we're at literally all-time highs right now this morning. So if we look back over the last several years at the appreciation of Bitcoin and kind of where it's moved over time, what we want to, instead of looking at sort of just the trends, I like to look at the data, and I like to look at the moves that big institutional, big money type investors are making. And we're seeing recently what I call a strengthening of the foundation or the floor of the Bitcoin price. That is, you've heard about large corporate treasury movements such as MicroStrategy investing hundreds of millions in Bitcoin, and Elon Musk talking about Tesla investing a significant amount of their dollars into Bitcoin as well from their corporate treasury. And what you see is a lot of large institutional type investors. And so what that points to is long-term appreciation and less volatility than I think we've seen as an industry over the last 5 to 10 years since Bitcoin was first created. And just a real sort of a more slow but long-term appreciation is what we see coming forward over the next few years.
And, Adam, thinking about kind of where you guys sit within the crypto world, storage has always been an issue, but obviously it becomes a larger issue the more people that get involved in the space, right? Because now you have a mix of both more sophisticated investors and then also more novice investors. And I'm kind of curious how you guys have approached those two challenges, as certainly you've seen your user base grow considerably here.
That's a great question. I mean, what's really interesting about cryptocurrency and Bitcoin as well is that it's a very global type of movement, right? Wall Street goes to sleep every night, but Bitcoin and other cryptocurrency markets continue to trade. And very much like the age of the internet and this sort of horizontal nature of the internet reaching across borders previously and, across oceans, cryptocurrency does as well. And so we've addressed that by creating, a product that can, just as easily be downloaded by someone here in the United States or in Asia from the App Store, and is a really easy way for them to get started. What we decided is that there's a lot of trepidation around new assets. We're used to dealing with banks. We're not used to dealing with mobile apps to invest. We might use a mobile app to pay someone to share a bill or to share an Uber ride, something of that sort. But to put tens of thousands of dollars into an investment through your phone is not something that historically has been as well accepted. So the challenge, I think, part of the challenge for the cryptocurrency industry has been making investing in Bitcoin easy, accessible, and to sort of engender a feeling of trust and safety for these new investors. That's what we focused on at BRD.
And then, Adam, related to that, I think everybody outside the crypto world read with much amusement that story in the Times, I guess it was like maybe 6 weeks ago, about people who've lost hundreds of millions of dollars worth of crypto because they forgot the password and so forth. And I'm curious what you, being in the industry and in the storage space, make of those stories, and how you kind of maybe think about dispelling the misconception that you have to write down your password on paper, otherwise it's kind of gone forever.
Well, what a great question. You probably don't realize it, but you're asking actually about the genesis of our entire company and product was that the co-founder, my friend of the company, lost about 80 Bitcoins due to a situation exactly as you described. That money was lost about 6 years ago, and it is truly gone for good. These days, with the advent of things like iCloud backup and Google Cloud and things of that sort, it's a lot easier for folks to be able to securely store what we call a private key, which is basically that password that you referred to. So these days, the evolution of modern mobile wallets like ours has been just to make it a lot safer, because we always forget our passwords sometimes, right? And we have to plan accordingly.
Adam, what's the evolution of your platform look like? What new services are you working on?
Yeah, it's a great question. So, what we aim to do from the beginning is to make cryptocurrency more accessible and just easier for the average, new retail investor to get involved no matter where they sit in the world. But as gains start to be made and as people start to make these investments, they're looking at what can they do with that cryptocurrency. And so there are, a variety of places to go from there. And I guess the best analogy is to think about, what do you use your current bank account for? That might be to pay your bills or to have an ATM debit card with withdraw cash. So things of that sort are sort of the type of direction that we're taking our product to enable our users who have, gosh, collectively now over $20 billion in crypto assets that they store, collectively, all of our users around the world within our platform, and to be able to basically access that money more easily. As people start to realize gains and whatnot, they want access to that money and they want to do things with it. So, we're looking at paths to make that easier.
And that answers part of my other question, which is to take a step back of all the different ways to acquire cryptocurrencies at this point. There are various exchanges. We've been talking a lot about Robinhood. There are ways to buy crypto instruments on Robinhood or a Coinbase, for example. What's the difference between those and a wallet, say, and the advantages of each of the different methods?
That's a really good question, and I could probably talk about it for a lot longer than we have. But I think the simple way to boil it down is to say, you're going to find, just like working with a different investment bank in order to buy a stock or a mutual fund, you're going to find different fees. You're going to find just different sort of ease of use and simplicity of accessibility. Also, remember that cryptocurrency is a very global thing in nature, right? We have people right now, as we've been talking, buying Bitcoin anywhere and all around the world, right? Services like, Coinbase, for example, do a great job in North America, but their geographic reach is limited beyond that. When you switch over to the mindset of sort of this young millennial generation, right, with their discretionary income, they're used to using mobile apps for everything. Everything is mobile these days. And so that's the path that we took, where we've created a mobile app. You can use it anywhere in the world. You don't have to be sitting there in the United States, and you can make an investment. And so, it's about accessibility. It's about ease of use. It's also about control of your own money. And so when you're using a wallet on your mobile device like BRD, you actually are holding your own Bitcoin versus having it stored at a centralized entity like a bank, like Coinbase would be. And that provides you with the ability to be more flexible, to use your money anywhere in the world where you happen to be, and to really operate in sort of this modern borderless society that we all live in today.
Interesting stuff. Thank you, Adam, for breaking this all down for us. All of us who, it's so fascinating to me. Cryptocurrencies, we've now been talking about it for a few years, and we are still trying to sort of get our hands around it as it also grows and evolves. Adam Trademan, BRD CEO, thank you so much. Appreciate it. All right, we are going to take a quick break. When we come back, we're going to get a check on the markets. And in just a bit, the final installment, at least on this show, of our infrastructure series with an executive from HPE. Stay tuned.
All right, welcome back to Yahoo Finance Live on this Friday morning. We see all three majors are higher here as we round out the trading week. Let's talk again about some of those stocks on the move. We just referenced Palantir about 20 minutes ago, and the stock has indeed added to its gains. Shares here are up about 11% in early trading today. Now, earlier this week, we were discussing Palantir, which has really been, it's up 12% now, has really been among the most searched stocks here on Yahoo Finance for some time. There was that lockup expiration, Julie, I believe that was Thursday morning, that made 80% of shares available for trading. Obviously, there had been some liquidity events after their direct listing back in the fall. Shares of Palantir were up as high as $35 per share, up really around 40, and did kind of get caught up in that, Reddit, Robinhood, GME whole situation. So we continue to see a lot of volatility within this name, and up about 12% here as we get today's trading underway. Another name we're watching this morning, out with earnings last night, that is Roku. This stock has had just an unbelievable run in the last couple of years, Brian Sazzi. I remember breaking earnings for this stock back in the old studio not too long ago, and it was $120 per share. Here we see $450 basically for Roku. I know you looked at the numbers last night, and the commentary from the company, Anthony Wood always puts out a really interesting quarterly letter that I think people interested in streaming should certainly read.
Yeah, I'm surprised to see the stock down. Now, let's keep in mind, Roku shares the past 2 years have increased 760%. So I'm not necessarily surprised to see a sell the news event, but really this company hit a grand slam home run across the board. They beat on platform revenue. That was up 81%. Consensus was probably about a 62% increase. 17 billion hours streamed. Consensus was at 16.8 billion. Gross margin 63.8 versus consensus of 58.4, and 51.5 million active accounts. That was up 5.2% quarter over quarter. It was really hard to poke a hole in anything from this quarter, and even the guidance was strong. So a little bizarre though to see the stock down here.
Well, I guess not after it's had a run like it's had. One other thing I'm going to be paying close attention to in terms of Roku is original programming. Remember, the company has talked about that it is going to be introducing original programming. Can't for the life of me figure out why it would want to do that when its bread and butter business has been going so well. And really what it does well is the execution and the ease of use of its main platform and main device. But I guess everybody's getting into original programming, so why not Roku? But we'll see what kind of value, if anything, that ends up adding to the stock and to the earnings as well.
They did buy Quibi's library, so I guess they can make some hay with that. But it is interesting to think about how much content do they need, because they've done fine. They've done fine without it. And in many ways, right, they can charge more if they're making the platforms compete against each other, right?
For the next
yes,
round,
but you only pay once for it, right? You buy the box and that's it. So it's not like you're subscribing to Roku.
Well, no, I'm saying like they can, they have in their investor letter, they call out like the deal with Peacock and put in the Office right in front of that. Like they can jack up the rate on Peacock, to compete against HBO Max, to compete against Netflix, to get the certain placement within, the whole Roku platform. But again, I think, for a stock that has had such a run, 1.5%, we'll kind of let that one go.
Worth noting too, really, real quickly, Roku is probably now perhaps one of the most powerful media companies around, and they don't even create any content. It's remarkable.
Yeah, and I don't think that to reference Peacock, I don't think NBCU is all that excited about it because they have Comcast to distribute the content, but you don't necessarily need to be involved with Comcast in any way, shape, or form to get the internet, to get Roku. So again, certainly a story that we will keep our eyes on as we get into the streaming era. I guess we're already in it, and we're streaming here on the internet and also on TV on this show. All right, we're back with more final installment of Infrastructure Week coming up on the other side of this break right here on Yahoo Finance Live.
Well, this week on Yahoo Finance, we have been having some fascinating conversations with all different sectors of what rebuilding America is going to look like if indeed we do get the passage of an infrastructure bill. Of course, technology is a part of that infrastructure. And we're joined now by Neil McDonald. He's Senior Vice President and General Manager of Compute at HPE. Neil, thank you so much for being here. So talk to me about, as we think about traditional infrastructure, we think about things like roads and bridges, but then of course now we have to take into account connectivity, for example, digitization. And so what role does somebody like an HPE and what you guys do play in this infrastructure conversation we're now having?
Well, at Hewlett Packard Enterprise, we work with companies of all sizes all over the world in enabling their transformation. And the COVID-19 pandemic has accelerated the need for that in so many ways. Companies that were already becoming more digital have had to become more digital more quickly. And companies that weren't on that journey have had to get on the journey very quickly. And as a result, there's a need to evolve the underlying infrastructure to enable that. You need an infrastructure with the right economics, with the right security, with the right agility to enable that kind of change in business models and in systems to adapt to the new reality that businesses all over the world are living with. If you think about the shift that's gone on with all of the limitations on our movements and our ability to go interact face-to-face with so many businesses as we would in the past, it's really meant that businesses have had to shift many, many more of those interactions to a digital experience. And that requires really transforming the underlying computing infrastructure in order to enable businesses to reach their customers and to execute on those transactions. And we've been working in many different spaces to bring those capabilities to our customers and help them create the financial capacity to execute on those transitions in what's been a really challenging year.
Neil, where do you see the biggest deficiencies in our tech infrastructure? Because theoretically, that's where this infrastructure bill needs to be focused.
So if you think about the shift, just in terms of our work, we've been in situations where we're having many more people work from home or work remotely rather than being in offices. So at a very basic level, this means that the build out of the infrastructure to enable that remote work and to enable it securely and efficiently is incredibly important. And that's something that many organizations have had to deal with, whether customer-facing organizations or even in medical settings and in manufacturing settings. You see the need to build out a different type of experience in the workplace. And that's meaning that you have to move more capability to the edge. And in some cases, that edge is your workforce. In some cases, that edge is where you're now performing other forms of computing and service. Whether you are working on technologies like AI or data analytics, more and more of that data is getting generated remotely from a classic data center, and you need the ability to actually process and react to that data in near real time. Whether you're thinking about really exciting opportunities in automated driving at the very extreme end, or much more mundane things like the automated management of infrastructure in an environment where you maybe can't have the level of access from your workforce that you've enjoyed in the past. And all of that really has shifted the nature of how corporate infrastructures are getting built and really placed an emphasis on picking the right underlying technology infrastructure that can bring that economics, that agility, and that security that we talked about.
Now, the compute business, Neil, is made up of a couple different components for HPE. So explain to an average investor that may be searching around, thinking about buying your stock, which component of your segment would benefit the most from infrastructure? For example, do you just simply sell more servers?
Well, if you think about the end-to-end infrastructure, it's really important that the systems that are deployed can be securely managed, that can be efficiently operated. And as you have more and more business moving digital, then that drives an ongoing consumption of new infrastructure. And whether that's in a corporate data center, whether that's in a remote site, whether that's in an industrial setting, whether that's in retail, there's an ongoing evolution in that technology that continues. And what we're seeing in the context of the pandemic is that some of those transitions are just accelerating, in that organizations are having to move more rapidly to evolve those business models and these processes, and that drives a need for ongoing investment in their underlying infrastructure. And across that whole spectrum, we participate as Hewlett-Packard Enterprise in really helping our customers accelerate what's next. And what's next is coming quicker and quicker and quicker, with all of the pressures to transform and adapt to this new environment.
Indeed, it is. Neil McDonald, thank you so much, sir. Senior Vice President and General Manager of Compute at Hewlett-Packard Enterprise. Appreciate your time. All right, we're going to take a quick break, and when we come back, we'll be taking another check on what's going on in the markets. We also will be talking about the developing situation in Texas and its effect on national policy. We'll be right back.
All right, welcome back to Yahoo Finance Live on this Friday morning. Certainly on the market side, we've had a lot of excitement with Bitcoin hitting a record high. We had those hearings related to Robinhood yesterday. But in the background, the biggest national story this week has been the situation in Texas, where we still have hundreds of thousands of customers without power. There are empty grocery stores, flooded homes, flooded businesses, streets full of snow where we haven't had temperatures above freezing for days in areas of the country that do not prepare to have any snow at all ever. And so it is certainly an unfolding humanitarian crisis that continues, unfortunately, as we head towards the weekend. But this also brings to the fore climate change and the effects that it could have on all kinds of industries and all kinds of goals that politicians have here in the U.S. Yahoo Finance's Rick Newman joins us now to discuss how this episode, Rick, really the first major crisis that we've seen in Joe Biden's presidency, could inform his climate plans. And I guess I would ask two things. One, how did you read Biden's climate plans, his ambitions there as he took office, and how do those get reshaped now?
Yeah, I've been following Biden's climate policy, which is very ambitious. I mean, we don't know the whole thing yet, but he wants to make major transformations in the U.S. energy sector. And the thing that I noticed in the aftermath of these storms in Texas is how quickly the whole conversation became about green energy, even though thermal energy, as they call it, powers about 80% of the electrical grid in Texas. Most of the problem there is a breakdown in natural gas pipelines, and there have been smaller breakdowns in nuclear reactor power and things like that. And yet Fox News and other places are saying, oh, see, this goes to show we can't rely on windmills because some windmills froze. So what that tells me is there's a lot of paranoia in the oil patch down in Texas and other parts of the energy economy when they're hearing about Biden's plan, and they're trying to use opportunities like this to really trash green energy when that is not the problem. I mean, a green energy failure was not the problem in Texas. It was the plain old carbon energy infrastructure that failed. And yet look where the conversation is going. So you've got Republicans in Texas saying, look, this is why we can't rely on green energy. And you've also got Democrats saying, look, this was the conventional electrical grid that failed. It shows the need for more infrastructure spending, including more green energy. So both sides are trying to capitalize on what's happening in Texas.
I mean, if anything, Rick, I've been shocked at what I've been reading in terms of how much wind energy Texas does get. Texas of all places, right? Especially in the summer, I've seen figures as high as 40% of the state's energy at times comes from wind energy, as opposed to here in the Northeast, which is very much still in the fossil fuel era, if you will. It seems to me that the Texas situation is going to give more support to Biden's perhaps infrastructure plans than anything else, since that seems to be what needs to be worked on in Texas.
Right, and that's why the messaging battle is so important. You're right, Julie. Texas is actually the #1 state for wind power. I mean, it's not surprising if you think about it. There are vast, flat expanses, and that's ideal for wind power generation. Also, solar power. Texas is #4 for solar power generation. And I don't exactly understand why the governor, Greg Abbott, is trashing wind and solar, because there are at least 35,000 jobs in these two industries alone in Texas, and they still provide a relatively small portion of the total energy there. I think it's only adds up to about 20%. So this is actually a good industry for Texas. So you'd think that the governor would be trying to use that to his advantage, but that does not seem to be the case. And you think about everything that motivates politicians. It's money. Who are your big donors? It's who are your buddies, who has control at the legislature level, and so forth. And I think what we're seeing is the ongoing control, along with anxiety, among big oil in Texas and the politicians that support big oil.
And Rick, I would also note, and I'd be curious just quickly for your thoughts on this. We haven't heard that much from Joe Biden during this time, and it certainly is very clear how different it's going to be with Biden as the president versus Trump, who would have just tweeted through it and probably said all the things that you said. I mean, it's different when Greg Abbott, a governor, says things versus when the president says them. And I think Biden's patience with this, declaring an emergency, releasing the funds, and then not coming out every day with inflammatory statements shows how things are likely to go in other areas over the next few years.
So I've actually seen some criticism of Biden among Democrats because he has not come out and made some big public statement to show we're on the case, we're here. However, Biden has had a phone call with Governor Abbott. He has pledged to send whatever they ask for. And we may get into this interesting tug of war where there's this attitude in Texas, we don't need anybody's help. We'll handle this on our own. That kind of contributed to this problem with the grid, because I think it might be the only state grid that doesn't connect to other grids because they don't want to have to deal with federal regulation. And yet people in Texas really need help. So you've got politicians kind of posturing one way, saying, we're Texas, thanks, but no thanks. and residents and citizens saying we'll take whatever we can get. So it looks as if the Biden administration through FEMA and other organizations is going to send generators, blankets, water, all that kind of stuff. It's probably already on the way. But you're right, Biden's just being very quiet about it. He's not trying to gain points on it yet. He may in the future. I mean, he is a politician after all. And I think Biden and Democrats, they will try to find a way to use this and other incidents and say, look, this just tells you why we need more infrastructure spending.
All right, Yahoo Finance's Rick Newman. Rick, thanks for stopping by. Have a great weekend. Talk to you soon.
Hi, guys.
All right, we're off for a short break here. A lot more coming up on the other side here on Yahoo Finance Live.
Well, Amwell is one of the largest telehealth companies in the country. It went public late last year, and it has announced a new way it's going to deliver virtual care. With the idea of using TVs, like I've seen out of the Jetsons, isn't new, but the potential to expand beyond the hospital walls and possibly into your living room is on the horizon. Yahoo Finance's Anjali Kimlani spoke with the Amwell co-CEO, Ido Schoenberg. Listen in.
Yeah, if we step back for a second, there is something very big happening, which is the actual model of care is changing. The way we think about healthcare is going to dramatically change over the next few years. Healthcare is going to be much more democratic, much more available to many more people. And here's how. All of us are going to emit data to the cloud continuously. We're going to analyze it continuously. We're going to think about reaching a diagnosis much sooner and then connecting with people that we trust so they can find the right opportunity to provide the right therapy or intervention directly back into our home. In order to do that, we need to find new ways to connect the key participants, patients, providers, payers, employers, device manufacturers, and so on. And that connectivity is extremely complex, but that's what we've done over a decade and a half. What we're doing right now is adding more and more ways for people to leverage that connectivity so healthcare will be a constant presence in your life. Specifically, the new TV allows a nurse or a doctor not to carry a heavy cart with them when they want to enter a patient room and connect with their colleagues or other specialists. They can just walk in, turn on the television in the patient room, and everybody is connected very, very quickly.
So moving on from that, the idea that you can use it through a TV, are there other platforms or other options that you're looking to grow into? The company just having gone public recently, I imagine that there's a lot of growth that you're looking at right now.
Well, without disclosing information that we're not ready to disclose, the fact is that we communicate digitally all the time, everywhere. And what we'd like to do is to make sure that every device, every means of connectivity can also be used for healthcare. That's far from trivial. Healthcare is different from a normal FaceTime conversation I have with my grandkids, which I enjoy immensely, but it doesn't necessarily need to be encrypted or safe or help me collect a copayment and submit a claim. So our task, our mission, is to make sure that connectivity to healthcare resources with information and services is as easy as any other type of connectivity using any device that is most convenient for everyone. When I mean everyone, I don't only mean patients. I certainly mean providers of the various type or any other participants in the care process.
When we're talking about the future of telehealth, now that we're really into it, a lot of more people are comfortable. One of the things that has happened is that reimbursement for it has come up to par with what is given for in-person visits, at least throughout the pandemic. And everyone is hoping that, of course, this stays, whether or not you're talking about Medicare and Medicaid or just commercial payers. Where do you see that going? Do you see the interest from the payer side? And how does that work in this, increasingly virtual space?
It's ironically simple at the end of the day. When you think about it, lawyers don't give any discount when they offer services over the phone, and nor should doctors do that. There is growing recognition that there is nothing inferior in connecting with my patient online versus seeing my patient in person. Of course, there are many things I cannot do online, and sometimes I need to see my patient in person, but there are many things that I can, and payers and other employers and governments growingly trust providers to use the right modality at the right time. But at the end of the day, if I went to med school for 7 years and spent many years after specializing, why wouldn't I charge the same for my time and for my therapy? Technology can envelope and make sure that the time of provider is well spent. So the interview is prepared, the session is prepared well, there is a good follow-up after it, there is appropriation, making sure that patients connect to the right providers. That's a great opportunity for efficiency. But one place we shouldn't seek to cut corners is paying doctors and nurses for the great service that they are providing online or in the room. Luckily, that's not my personal opinion. It seems to be that most states, most payers, most employers seem to agree.
All right, welcome back to Yahoo Finance Live. About an hour and 25 minutes into today's trading session. We see all three majors are trading higher, but some big moves happening underneath the surface. We talked earlier in the show about Palantir. Let's take a look at shares of John Deere, or rather Deere and Company, as the company is now formally known. Record high here for shares of Deere, up 10%, Julie, after their latest quarterly report. And boy, it's hard to get bearish on the broad economic cycle around the world when Deere is coming out with blockbuster numbers.
Yeah, I mean, we talk all the time about hot tech companies, right? And all this thirsty cash going and stuff. How much more traditional can you get than a Deere tractor, right? So the company coming out with earnings guidance and expanding its guidance for this year, saying it's going to earn as much as $5 billion. The upper end of its forecast was $4 billion, so pretty big increase there. And they're seeing a lot of demand from farmers, particularly in the U.S., although, of course, Deere is an international company, but seeing a lot of demand in the U.S. as basically we're seeing farmers upgrade their equipment right now. Optimism about the agricultural cycle as well. We've been talking about some of the increasing prices for some commodities. So interesting stuff here.
Well, if you really want to even get deeper here too, look at this. We've talked to all these food companies, General Mills, we've talked to Kraft Heinz. They're selling a ton of stuff, a ton of packaged food still. Look at Walmart yesterday. They said average basket size increased 22%. Clearly, there's a lot of grains being sold and obviously a lot of John Deere equipment.
That's right. That food doesn't make itself. Nope. Get outside the little New York metro area, and you'll see plenty of John Deere equipment out there. Let's talk a bit about Bitcoin as well, as we do all the time. As we were on the air in the last segment, Bitcoin's total market cap eclipsed $1 trillion for the first time. When we came on, I think Bitcoin might have been under 52,000 today. Julie, why not 53.7? What's your guess? By the time we come on the air on Monday morning, what's your guess at where Bitcoin's price gets to?
Julie doesn't make predictions.
I know. That's why I asked.
Here's my prediction. It will continue to be ebullient, in the words of the word that Melton used frequently to describe the market, which is a pretty good descriptor.
Sazi, I know you'll give me a price target.
It could go up. It could go down. 75,000.
There you go. All right. Heard it here first. For Julie and Brian, this is going to do it for us here, 9 to 11 hours in Yahoo Finance Live for this week. Everyone have a great weekend. We'll see you back here Monday morning, 9 o'clock Eastern. Zach Guzman and Akiko Fujita have you here on Yahoo Finance for the next couple of hours. They're coming up in just 2.5 minutes.
Welcome to Yahoo Finance Live and happy Friday. I'm Akiko Fujita along with Zach Guzman. Taking a look at the markets right now, we are seeing all three major indices firmly in positive territory. Stocks now on pace for the best month since November. A lot of the reopening stocks today, airlines and travel names getting a big lift in this session. And take a look at this, Bitcoin soaring past $53,000. We are now seeing its market cap reaching that $1 trillion threshold. We're going to break down the moves on that front a little later in the show. President Biden also meeting with G7 leaders for the first time. The focus firmly on the global vaccine distribution, COVID-19 pandemic, and economic recovery. Uber facing a setback in London, a UK court ruling in favor of former drivers seeking a minimum wage and benefits. We'll discuss the implications for Uber's business. Plus, we round out our infrastructure week with the CEO of Vertiv. He'll be joining us later in the hour to discuss his plan to build out the country's rapidly expanding IT infrastructure. We're beginning this hour, though, with that hearing from the House Financial Services Committee yesterday on the volatile trading around GameStop. The market's still assessing the implications of what lawmakers, Zach, have called this a fact-finding mission. This was a long hearing, went more than 5 hours. We saw 6 people testify and all, but a majority of the questions were directed at Robinhood co-founder Vlad Tenev. And we also learned what really drove Robinhood to restrict users from buying shares of GameStop at the height of the volatility. Take a listen to the exchange he had with Ohio Congressman Anthony Gonzalez.
Did you have the liquidity to meet the additional $3 billion deposit requirement?
So as we wrote in detail in my written testimony, there were a series of steps that the Robinhood Securities team took to
reclaim my time, sir. At that exact moment, did you have the liquidity for $3 billion? 5:11 a.m.
At that moment, we would not have been able to post the $3 billion in collateral.
And Zach, that was the first time we've heard Vlad Tenev at least explicitly, publicly say what was really behind the halting in that trade. And it sounds like things could have been much worse at that point.
Yeah, and it was, I think, for a lot of people who are comfortable and watch business news, watch this show, they might have been disappointed by what they saw in the hearing, because that highlight was really one of the few times where we got into the heart of what happened on a minute-by-minute basis. It was a very good question because, you know, this was supposed to be a fact-finding mission, as you laid out. I mean, we wanted to learn more about what happened, what went wrong. There were a lot of accusations. But I think that, you know, even we heard congressmen and women going back and forth against each other, highlighting the fact that this kind of turned into political theater and talking about, you know, some larger maybe hedge fund versus Main Street kind of ideas, but not necessarily into what exactly happened. And we heard some of that in the opening testimony, but this was the chance, you know, you had these people sworn in to get into the details and get answers to questions that we couldn't get on this show because we don't have that kind of power. But yeah, I think overall, we didn't learn as much as we wanted. And again, this was kind of, we heard from Chair Maxine Waters talking about this being the first go at it. But you would have hoped we would have learned more, or would have been able to show more than just one question here in terms of things that jumped out at us. So I think overall, a little bit maybe of a disappointment in terms of learning more about what went wrong and what we can do to kind of prevent this from happening again.
Yeah, Zach, you talk about the political theater. Well, these Zoom hearings also are never smooth. People forget to unmute, and there's all the usual sort of things that we have to deal with on a daily basis. But I think in the 5 hours, there were a few points that potentially could point to what lawmakers are looking at as their next step. But another issue that was raised in the hearing was the time it takes to settle a trade. This T+2 is what we call it. Vlad Tenev saying that, look, technically we should be able to move to a T+1. In the case of something like that, then a company like Robinhood wouldn't need as much collateral, certainly not the $3 billion, although there's questions about, you know, considering just how volatile things were at the time, whether that would have actually resolved any issues for Robinhood.
Yeah, and I mean, we heard a little bit about that too when they were discussing potential policy changes around all of that. And it was interesting to hear the update from Ken Griffin, of course, representing Citadel there, to say that, that wouldn't be in his top 100 list of things to change about the system as is, because it's not all that important. We're talking about a very unlikely situation with what happened around GameStop and the volatility there. So kind of, throwing cold water on the idea of that being something that needs to happen right now. And again, kind of a smokescreen from what actually did happen in the case of GameStop, because it's a policy solution perhaps going to T+1 over T+2 settlement, but again, kind of not exactly getting into the heart of it. But hopefully, we're going to see that happen in the second go around, or perhaps in follow-up interviews.
Yeah, several more hearings to come, but we're certainly going to put the question to some key lawmakers here a little later in the show. We're going to be joined by Congressman Patrick McHenry in the noon hour. We're also going to be joined by Representative French Hill a little later this hour. So you certainly want to tune in for that conversation, because they were the ones, in fact, putting the question to the executives yesterday in the hearing. Let's bring in our first guest for the hour, though. Craig Fair is Principal Investment Strategist at Edward Jones. And Craig, you've been hearing our discussion on what came out of the 5 hours of hearings yesterday. What stood out to you in terms of the discussion that happened? What do you think that hinted at in terms of what could happen when lawmakers look to maybe tweak some of the market mechanics?
Yeah, Kiko, I thought your and Zach's conversation was spot on. The term you use, political theater, these things often tend to take on that flavor. I think when you sift through some of the theatrics, and you guys were just pointing on this, there's a couple core elements of this, which is one, lawmakers are trying to better understand what happened here. It's pulling down the drywall and looking at the plumbing of how trading and market settlement works. That is not typically detail that most people spend their days thinking about, but it's important that the lawmakers have an understanding of what the system is and what the system isn't, to ensure that maybe the regulatory framework is capable of handling it. I think that's what they're trying to get to. What I'm struck by, one of the interesting takeaways from this is there's not a clear side to the argument from the lawmakers' perspective. There's some elements of this conversation that are, should we be ensuring that retail investors or traders are not restricted from investing in the things they want? The other side would be, should we be protecting retail traders from some of the elements and the machinations of what's occurring here, or what was exposed by the GameStop frenzy? So I don't know that there's a clear one path from the policymakers here, but I suspect the ultimate intention is to ensure that they learn enough to know if there's going to need to be additional regulation around this.
Yeah, and when it comes to the volatility issue tied back to the retail trade, I mean, that was one thing we did learn is how popular trading on some of these platforms have become, simply because of interest from normal retail investors. And whether or not you really change the piping or the plumbing around, payment for order flow, which we're going to get more into later on in the show. But I guess it raises the question, is that volatility tied to the retail trade expected to stay here in 2021? Because a lot of people point to the stimulus checks. They clarified, some congressmen were clarifying that it didn't necessarily, you can't connect those dots directly, that stimulus checks led to some of this gambling in the stock market. But what would you say it might be here to stay when it comes to that in 2021?
I think one of the bigger, broader, if we just as you said, if we ignore the plumbing here for 1 second, and we just think about the broader implications, I think this highlights, importantly, the distinct difference between trading and investing. And I think that's particularly important for what is being called the retail investor, right? Individual investors that are trying to save for something, a financial goal, education, retirement, whatever that might be. That can be very different from trying to capture the gains that occur, these flashy, exciting gains that occur in the day trading environment. There's a place for both, Zach. I think you just pointed that out. There's a place for both. My view is there just needs to be clear understanding of what risks investors or traders are taking. And then individuals, institutions can determine if those risks are appropriate for their particular situation. I think that's what this is ultimately going to highlight. Whether that produces new regulation remains to be seen. But it's critically important that if you are a day trader, an individual, and we've obviously seen tons of these stories that have played out over the course of the past 2 weeks, there is a very big difference between, as you noted, kind of the casino element of what feels like this GameStop frenzy versus the need to invest for a long-term financial goal, which isn't necessarily going to be captured by chasing after the latest hot stock or speculative investment.
And Craig, finally, turning to the broader markets, it looks like, at least in the session right now, we're going to close out the week on a positive note. Certainly a lot of factors at play right now. There's the issue of the $1.9 trillion stimulus. Also, Janet Yellen sort of hinting at additional stimulus that could come, something in the form of infrastructure potentially. How are you looking at the policy aspect of all of this? And then also looking at what this means down the line potentially for inflation and your portfolio at the end of the day?
Yeah, Kiko, I think that the fundamental backdrop you just described is categorically positive. That's not new to the markets. Markets have gone sharply higher over the past year for good reason. The outlook for the economy in the back half of the year is quite favorable. I do think we're going to see a meaningful jump in output as we see vaccinations become more prevalent, as we see economic activity get opened back up. There's a huge amount of pent-up demand. You think about all the folks that are buried underneath snow at the moment across the country that are probably dying for a vacation as conditions warm up. I think we will see that demand show up in terms of a meaningful economic rebound in the second half of the year. So markets, in my opinion, are right to do what they're doing, which is move higher. At the same time, we are not going to move up every single day. We're certainly not going to, in my opinion, post another 70% gain over the next year like we did over the past year. Some of that is just pricing in those future expectations. I would point out, maybe to Zach's point earlier about some of the market implications of this. While the fundamental conditions remain broadly positive, an economy that's going to rebound later this year, corporate profits that look quite positive in terms of gains, and a monetary policy environment that continues to be quite favorable, add on top of that the fiscal stimulus that you just mentioned, Akiko, all of those chips are stacked in the favorable outlook camp. It is worth at least noting when markets are broadly tilted positive as to what could be the risks that would pop up and scare the market periodically. A couple of weeks ago, we saw that in the form of very, very narrow pocket like GameStop. I think interest rates could probably be that thing that at least temporarily takes a little bit of the shine off the market. We've seen 10-year rates rise sharply. 30-year rates have risen to highs we haven't seen in over a year. I think that might be the new area that the market might key in on, because that does speak to the broader implications here. But overall, I'd say the longer term fundamental outlook for this bull market remains quite favorable.
All right, Edward Jones, principal investment strategist. A lot of pent-up demand out there for trips. Some people are getting an early start with trips to Cancun, but appreciate you coming on here. Craig Fair, thanks again. Have a great weekend, sir. Be well. We're going to take a quick break here on Yahoo Finance Live, but when we return, wrapping up Infrastructure Week here on the show with a discussion around digital infrastructure. The CEO of Vertiv will join us right after this to discuss. Welcome back to Yahoo Finance. And this week we have been spotlighting infrastructure projects and spending in our Rebuilding America segments. And it's fitting to kind of wrap up with what's often overlooked in the infrastructure discussion, particularly around digital infrastructure. Happy to break that down with our next guest here, the CEO of Columbus, Ohio-based company and $4.4 billion provider of digital infrastructure, which went public last year. We're joined here by the CEO of Vertiv, Rob Johnson, alongside Yahoo Finance's Brian Sozzi. And Rob, thanks for coming on here. I mean, it is an important piece increasingly of infrastructure, digital infrastructure, as we're seeing this build out. But as we're talking about the Biden administration and what they have planned, what are your expectations and kind of where this sector goes and how important it's going to be to really spotlight if we're thinking about investing in infrastructure?
Absolutely, Zach, and thanks for having me today. We're really excited about the investment in infrastructure. People don't really understand kind of what companies like Vertiv do, but we provide the foundation of the internet. We provide the power, the cooling, the thermal management. So, for example, down in Texas, where they've been hit really hard with power outages, we have to keep those data centers up and running so people can continue to communicate, people continue to do telemedicine. So we are really a vital part of the overall infrastructure. As you know, there's a big data center boom, lots of hyperscale companies and co-location companies. We support them with power and cooling and modular solutions. So we look forward to the Biden administration building out more broadband. It's digital everything that's happening these days, and that requires processing of that data and then storage of that data. And you hear a lot more about edge data centers, and we play a big part of allowing that to happen.
Rob, you mentioned the situation in Texas. Really, it's been a tough couple of days for people there. How do you imagine that situation will change how Texas thinks about their infrastructure, and what would that mean to your business?
Yeah, well, absolutely. We've got a lot of people on the ground right now down there, service techs and so forth, keeping whether it's the communication networks up and running or the data centers. And I think there was a bunch of things that happened, in Texas, the failures of whether the windmills and then the gas pipelines and a combination of things. And one of the things that this country's got to look at is energy storage, right? Energy storage is going to play a big part of our future as we integrate more renewables. It's going to be necessary, and it's a reliable part of the infrastructure going forward. So I think Texas will probably look at energy storage as another form of backup for these types of natural disasters.
Rob, I want to get back to the growth that you have seen in data centers, and I wonder how you are looking at the carbon footprint element in all of this. We've talked so much about the migration into the cloud. It's great that everything's moving to the cloud, and yet there's a lot of power that has to be generated to cool down these servers. Is the technology for energy efficiency keeping up with the type of demand we're seeing for data centers right now?
Absolutely. Well, data centers today consume about 2 or 3% of the world's electricity, and they're only consuming more. Things that we're doing at Vertiv is absolutely addressing some of those energy hogs, if you will, in the data centers. And the big one you talked about is thermal management. And we've made a lot of strides in that and in driving efficiency and making those more effective. But there's a lot more innovation. And one of the things we're doing as a company, we publicly announced we're doubling our R&D over the next few years to just solve those types of problems. But there's things like generators, right, that diesel generators that we need to find alternative ways, whether it's fuel cells or battery energy storage or solar, in order to take care of that. But a lot of work's being done to make data centers more efficient. But the boom of data centers continues. Every country in every world wants their data within the country, and it needs to be local. The issue with data is the latency side of things, which means, when you get on your phone and that little dial spins, that means that you're going too far in the cloud somewhere, and we need a data center closer to you. So as they proliferate, we have a responsibility to make sure we make these most efficient and effective as we go forward. And there's things like battery and energy storage and integrating with renewables and fuel cells that I think can help drive the overall carbon footprint or reduce that.
Rob, outside of infrastructure, I think a lot of folks would be surprised regarding your company. Vertiv kicked off the SPAC boom. You brought the company public, one of the first ones to do it using a SPAC with the help of Goldman Sachs and Honeywell's former longtime CEO, David Cote. Are you surprised by how much that industry or that path to public markets has taken off since?
Absolutely. I'm not too surprised, but we knew we were going to be the largest SPAC and the first SPAC that Goldman had done. And the combination of Goldman, myself, and Dave Cody really, as we went out and raised the pipe for the SPAC, a lot of people were doubtful on SPACs because they had been burnt on them in the past. But here we are a quality company, a great company in a great position in a great industry, making money. So what I'd say is, I think as we look at SPACs going forward, I'm not surprised. It's a great vehicle for companies to get out there. We just need to make sure that we've got the appropriate leadership and we're investing and have sensible valuations on some of those companies as we go forward.
Vertiv CEO Rob Johnson, it's good to talk to you today. And our thanks to Yahoo Finance's Brian Sozzi as well for joining in on the conversation. Coming up, breaking down that marathon hearing on the GameStop trade and the next step for lawmakers. We're going to be joined by Congressman French Hill, a member of the House Financial Services Committee, coming up after the break. Lawmakers on Capitol Hill assessing the next steps in their investigation into the GameStop trade after that marathon hearing yesterday before the House Financial Services Committee. Let's speak to Representative French Hill. He is a Republican congressman from Arkansas, sits on that committee. And this was a very long hearing yesterday, certainly a lot of discussions about the market mechanics. You went into this saying this was a fact-finding mission. What's the conclusion after the 5 hours? Is this about a company that simply just got in over its head, or are there fundamental flaws in the market mechanics that need to be addressed?
Well, from listening to it yesterday, my personal view is the equity market plumbing worked as we expected. And so it really, in the face of a bubble in GameStop stock or AMC stock, functioned just like we hoped it would. And so that was my major takeaway. However, it was good to hear the CEO of Robinhood acknowledge that they did not have sufficient capitalization at their clearing process to absorb the shocking amount of trades that came through in that bubble. He apologized for that. And I made recommendations that their customer service should really change and reflect a more traditional way to help customers through tough times.
Congressman, you say the system worked as it should, but I had a feeling there were a few retail investors out there who might have been blocked out from buying some of these shares that might differ from that opinion. And obviously, Robinhood, we should point out, was not the only brokerage that had some issues. You know, there were other ones, but they were the only one there on your panel. So, I mean, when you dug into it, was it surprising to not hear that many specifics behind what happened? I only counted one question that really got into that idea on a minute by minute basis. I mean, what more would you have wanted to learn about what preparations could have been made at Robinhood to prevent having to block buys?
Well, the CEO, Vlad Tenev, suggested it was a Six Sigma event based on the run-up in GameStop prices. And that's possible. You're right to note other brokerage firms were engaged at the same time. But large capitalization, large amounts of capital held for clearing purposes are essential. And Robinhood, while they had plenty of net capital as a broker-dealer, had insufficient deposits at the depository trust company where all the shares are cleared every day in order to meet their margin call on the next morning. So I would say risk management is a takeaway, but we have laws that cover that. We have policies that cover that. All brokerage firms are treated exactly the same, and Robinhood just was not prepared to deal with the requirements they had, but they got it fixed. But retail investors were inconvenienced on their platform because they did not have the ability to process those trades on the second day.
Is it your sense that the mechanism with which these trades are executed, and specifically the time that's needed to settle the trade, was that part of the problem too? I mean, we heard Vlad Tenev say that, look, the technology is there to really reduce the time so it's more immediate. If that's the case, potentially Robinhood didn't need the kind of collateral which it had to raise because they just didn't have the money.
Yeah, it's a good point. That's a much longer process point. You know, we used to have trade plus 5-day settlement when I first started my career in stock and bond trading. And now we're at T plus 2 trade, 2 days to settle. As we move towards blockchain and we move towards other settlement technologies and the whole ecosystem is redesigned, we will be able to move to a same-day settlement, but we're not there yet. And so I thought there was a good discussion about that, but that's really something to talk about at future hearings. What are the conditions precedent necessary to move trading from T plus 2 to either T plus 1 or same day?
Yeah, Congressman, the other issue at hand in, I guess, the plumbing of these trades was the discussion around payment for order flow, which, again, you know, Robinhood may have pioneered that payment for order flow kind of methodology there or business practice, but other brokerages quickly followed suit. We know how much TD Ameritrade and others make on it, but there wasn't necessarily, I don't know, maybe I'm wrong. Were you satisfied with kind of the discussion and the answers you got around that and kind of the push back against the conflict of interests in payment for order flow?
I have no doubt that that's going to be a topic at a future hearing, but the SEC, the Securities and Exchange Commission, has blessed payment for order flow for, I would say, certainly over 10 years. So it's nothing that was pioneered by Robinhood. The payment for order flow accomplishes a couple of things. Number one, multiple brokers in the exchanges, I'd say up to 40, compete for best execution on retail trades. And so the whole effort is to have competition to give the customer the best price at that millisecond of the trade. Secondly, payment for order flow has allowed different models at Schwab or TD Ameritrade or Robinhood now to offer lower cost access to accounts and lower cost trading down to zero commissions now. That's been help to, I think, a lot of consumer households to lower the agency costs and trying to plan their long-term investments. But to your point, it could use more discussion and make sure that members of Congress and the public understand just what's going on in this area called payment for order flow.
What other questions do you have on the issue, though? I mean, it sounds like you think that this should remain in place, that this is not something that needs to be addressed in its current form, but there's more explanation that's needed. Is that a fair assessment?
Well, there could also be more transparency around it on how that works, what customers' expectations are, how you assure best execution every day. Brokerage firms could better disclose perhaps what they're paid in order flow and make sure retail customers and institutional customers understand that, to make sure there's not a clear conflict of interest. And then in my view, in these app-based fintech platforms, how you qualify an investor for access to margin, access to option trading, and certainly access to low dollar stocks is important. That's a big part of compliance at most brokerage firms. And my view was, after listening to Mr. Tenev, that he's going to relook at that at Robinhood and make sure that they're doing that in the right way. And you can't base that always every day on just an algorithm based on boxes checked by an individual client.
Representative French Hill, congressional or Republican congressman from Arkansas, it's good to talk to you. Would love to have you back on the show.
Love
After
to be
the
back.
next spring, as it is planned now. Thanks so much for that. Let's bring in Jared Blickery now for the very latest on the market action. And Jared, specifically, we're looking at cryptocurrencies right now and Bitcoin passing that $1 trillion threshold in market cap for the first time.
That's right. And let's take a look at this on the Wi-Fi Interactive, bringing up our Bitcoin section. Here we go. Wrong click on my part. Bitcoin, guess what? 1 trillion. Now over 54,000 here. And let's just take a look at the chart. We were talking 50,000 just a few days ago. Over the trailing 7 days, here's what it's done, up 14%. Also seeing Ether at record highs. It's up to almost 2,000 per coin. And just a little while ago, I remember when it was trading at 500 or 600, it seemed high. And then some of the other coins, Ripple, XRP, still can't really buy that easily, but it's down over 9% over the trailing 5 days. And then some other smaller coins like Cardano, those have been also trading sideways, but something like Binance, which is up 57% today, I just see these little smaller coins just kind of randomly attracting money. And you got to think that there's going to be some kind of shift, perhaps, into the smaller coins with the bets, hoping that they catch up to the big guys like Bitcoin. But Bitcoin at $1 trillion is really something here.
No, it is. And Jared, you're right to point out Binance. I mean, that was the one that was catching my eye, up more than 400% just in February alone. And I think it speaks to just how rapidly this DeFi movement is really catching steam here. I mean, we talk a lot about Bitcoin because that's where the institutional money is going. But farther out on the fringe, Binance has really, allowed some of these projects to build on their blockchain in the DeFi space. And that's, I think, why we're seeing that run up more than 400%, because, Ether is getting quite pricey. And using that blockchain for some of these DeFi projects is also, by virtue of that, getting pricier too. So interesting to see Binance kind of taking the lead there. And we saw Elon Musk, let's not forget kind of where this came from after that Tesla investment. He was tweeting a bit about Bitcoin, and it was interesting to kind of hear his thesis kind of pointing out that not having a bit of Bitcoin is essentially dumb. He's saying, to be clear, he's not an investor, he's an engineer. I don't even own publicly traded stocks besides Tesla. However, when fiat currency has negative real interest, only a fool wouldn't look elsewhere. Bitcoin is almost as BS as fiat money. The keyword is almost. And that is, of course, kind of this bifurcation in the crypto space, right? You got Bitcoin, as we're talking about, attracting large amounts of money and increasingly becoming a little bit less volatile. And you got that DeFi new space over there in Binance Coin, clearly the standout. But Jared Blickery, appreciate you highlighting all these moves for us too. And we do a great job of highlighting all of these cryptocurrencies on yahoofinance.com, so our viewers can learn a bit more about all of that on the site. We're going to take a quick break here on Yahoo Finance, but when we return, we'll be discussing that increasingly looked at methodology in trading, payment for order flow. We heard it a lot in the House hearing yesterday. Brian Chung is going to break down just how big of a revenue driver it's become for these brokerages. Stay with us. Welcome back to Yahoo Finance Live. If you watched the House hearing yesterday into GameStop and Robinhood, you probably heard payment for order flow mentioned a few times, that practice of brokerages selling your trades to market makers like Citadel Securities. Obviously not something that just Robinhood does. Other brokers do it as well, but here with a look at how much money is made off that practice and how it's continuing to grow in the sector. I want to bring on Yahoo Finance's Brian Chung with a look at that in this week's Yahoo U.
Well, Zach, welcome back to class. Class is in session. And again, as you mentioned, yesterday's congressional hearing did really underscore the relationship between brokerages and also wholesalers in any sort of stock trade. But of course, they can get awfully confusing. So let's walk you through exactly how this works with an example here. So let's say, for example, you, Zach, are trying to put in orders for Chung shoes, right? This is my company. I sell sneakers. And you're trying to snipe some of these crispy tendies that, you know the vibes right here. So you're going to order 100 shares of Chung shoes through your brokerages. Now, back in the day, you had to literally call a broker to do this, right? But today, that call is just going on your trading app, your TD Ameritrade, your E-Trade, Robinhood, and you're going to place the order for 100 shares. Now, in a payments for order flow structure, the broker is going to take the order and it's going to pass it to a wholesale market maker, Citadel Securities or Virtu Financial. Now, these market makers are the specialists at really executing these trades. And they're going to go out on the hunt for Chung Shoe stock, right? And then they're going to buy the stock at a publicly quoted price on the New York Stock Exchange. So again, three players here: brokerage firm, the market maker or wholesaler, to the exchange itself. So where in all of this is the actual payments for order flow? Well, let's take a hot second on that. So when Zach asked to buy shares of Chung Shoes, he put in a price that he's willing to pay. So $100, for example. They call this the ask price. But as part of any order, there's also a second price called the bid price. And this is the price that the broker is actually going to have the wholesaler execute the trade on, right? So Zach asked to buy at $100, in other words, but the wholesaler found it at $98, right? That's a good thing. Now, what happens with the $2 of the bid-ask spread between these two prices? Well, the wholesaler, right, the Citadel or Citadel Securities or Virtu Financial could say, I'm going to pocket $1 of it, kind of as a finder's fee, and then I'm going to take the other dollar and give it back to the brokerage that gave me that order in the first place, right? So let's say, for example, the brokerage that Zach ordered on takes that dollar. It can do a few things with that. It can take 50 cents of that dollar and then pass it on to Zach and say, look, I actually found you that share at $99.50. And then the brokerage can take the other 50 cents and pocket it for its own operations. So the metrics show how big of a deal this has become for at least the four major brokerages, which you're looking at here. This is data from Alphacution, the SEC, and also company data. Again, these are the four top brokerages: TD Ameritrade, Robinhood, E-Trade, and Charles Schwab. And you could see, I mean, just between 2019 and 2020, revenue just from this specific business line almost tripled, from $892 million to $2.5 billion. And at Robinhood specifically, take a look at the blue bit here, $69 million in 2019, ballooned to $687 million in 2020. That's about tenfold in just 1 year. And the data is not on this chart, but among all the payments for order flow, which is more than just these four, there's other stock brokerages that are smaller as well, 41.7% were paid by, you guessed it, Citadel Securities. So they are pretty much a giant in that space. And you know, all of this, guys, really just illustrates why this is such a hot debate. I mean, this structure is the reason for why zero commissions exist in the first place, but it's also added a middleman, and it's raised questions about the incentive structure between the brokerages and how they team up with a wholesaler. But one last thing I want to point out here, and this is really important to keep in mind. The model that I just showed you does not include any hedge funds. So Citadel Securities is different from Citadel's hedge fund. It's separate. And by the way, it's also illegal to front run. There's no front running. There's no jumping any trades when you receive an order flow from a brokerage. That's really important to note as well, especially in the context of GameStop. You didn't even need to have the order flow to see that GameStop stock was going up. So there was really no front running that was needed there. But all of that really important and shows how controversial all of this is. Something important for regulators, the industry, and also legislators to keep in mind in the months and the years ahead. Zach, Akiko?
Brian Chung proving that you don't need 5 hours, right, to explain payment for order flow. With so many questions popped up in the hearing yesterday, but now we know a lot more. And of course, you can read about all of this on our website. Thanks so much for that, Brian. Coming up, we're talking about crowdfunding in real estate. The CEO of Realty Mogul joined us to discuss the huge growth that we have seen in this space. CEO Jillian Hellman will be here after the short break. Welcome back to Yahoo Finance Live. We've seen crowdfunding in real estate gain a lot of popularity, a lot of traction over the last several years, offering access to individual institutional grade assets for retail traders. Realty Mogul, one of the leaders in this space, and we're joined here by Realty Mogul CEO Jillian Hellman. Jillian, it's good to talk to you today. This is a space that we have seen really grow over the last several years, but I wonder if you can just kind of walk us through, for those who are not familiar with how exactly this is executed, how an investor who is not accredited can get in on some of these commercial real estate deals.
Sure. So Realty Mogul is an online platform for investors to invest in commercial real estate deals. And we do due diligence on every investment to make sure that it meets our minimum requirements. And we provide detailed information on each deal so that investors can make their own decision if the risk or reward profile is right for their unique financial situation. Non-accredited investors can invest into our REITs or real estate investment trusts. They're legally public entities, so that means that they're available to all investors, both accredited investors and non-accredited investors. They create an account on our website, they make a couple clicks of a button, and boom, they become investors in commercial real estate. It's really that easy.
So what do maybe investors get with you guys over some of the other options out there, whether it is, real estate ETFs or REITs, competitive REITs? Because I assume maybe more flexibility into some of the projects specifically on your platform. So what's the biggest difference?
Yeah, there's a variety of platforms that are allowing investors to get into real estate. There's platforms that help investors buy a single family home and put a dedicated property manager in place. There's platforms like ours that offer diversified REITs, and we also investments in individual properties. So accredited investors can pick and choose an individual deal, an individual apartment building, retail shopping center, office building is an example. And then there's also platforms like 10X that allow investors to buy whole real estate deals through auctions. So a variety of different platforms. I think our aim is to make it as simple as possible and to make it as passive as possible. So an investor comes online, couple clicks of a button, they buy into a real estate transaction, and it's really set it and forget it. There's nothing for the investor to do beyond that.
Jillian, we've seen some real resilience in the housing market throughout this pandemic, largely driven by these record low mortgage rates we've been seeing. But you've got some visibility on the overall real estate sector, not just looking at residential, but commercial as well. What's your sense right now in terms of how much hotter it can run? And on the commercial side, are you starting to see a bounce back?
Yeah, so in apartments in particular, through the Realty Mogul platform, there's been investments in over 15,000 apartment units. So we have some really, really good data across the country on apartments. They're holding up spectacular. So it's been shocking, but also not surprising when you look at not only interest rates, but also federal stimulus. And now with the rent relief bill, there's going to be $25 billion that comes back into the economy for back rent, which I think is going to be really, really critical. And our commercial assets are also doing very well. I think that the assets that are doing very poorly are hospitality and retail. Thankfully, we don't have much exposure to those asset classes, but I do believe that people are going to go back to retail shopping centers. I do believe that, work travel is going to come back, and you're going to see a bounce back in those commercial markets. In apartments in particular, it's never been hotter. There is tremendous competition to buy apartments today. The difference between the interest rates where you can finance them and the cap rates, which dictate the purchase price where you can buy them, there's an acceptable spread there. So investors can earn cash on cash returns. And there is so much capital that is trying to get into the apartment space. So we've seen that hold up very, very well. And we've seen other asset classes hold up very well as well, other than hospitality and retail, which has been the hardest hit in this pandemic.
Yeah, the accredited, non-accredited distinction there is important to highlight, because that's one thing that I think, irks a lot of retail investors out there, that they might not be able to get into specific deals. But when it comes to maybe flexibility around the markets that they could pursue, whether it is an ETF through the REITs or, specific deals for accredited investors, what are you seeing on your platform for spaces that do seem hottest? Because we've been talking a lot about specific markets out there in the US that still are garnering quite a bit of attention, even this far in the real estate boom.
Yeah, capital's chasing growth. So markets like Phoenix, Dallas, Columbus, Raleigh, Charlotte, I'd say from a state perspective, it's all about states with low or no income taxes. Washington, Texas, Florida, which unsurprisingly are markets where there's job growth and there's population growth. I mean, it's kind of shocking to think in the middle of COVID, how many companies have announced that they're moving their headquarters, and a lot of those, to Texas. So it's unsurprising that those markets are the growth markets, and that's where there's a tremendous amount of appetite from both retail investors and institutional investors to expand their portfolios in those markets.
Yeah, and interesting products like yours to start accessing some of these spaces that maybe people hadn't been able to before. So appreciate you coming on here to share that with us. Realty Mogul CEO Jillian Hellman, once again, thanks for coming on. We're going to take a quick break here on Yahoo Finance Live, but when we return, Bitcoin crossing $54,000 a coin to hit a new record high. We'll have that and more right after this. Welcome back to Yahoo Finance Live. Right now we are spotlighting Bitcoin here, crossing $54,000 a coin, and total market cap crossing $1 trillion for the first time here as it sits at record highs. No telling where we're going to see things go over the weekend, but of course we will be accessing that data. You can access it on Yahoo Finance Live and our crypto tracker. Also want to spotlight what's going on in the broader market. The Dow hitting a session high as well, up by about 140 points. The Nasdaq and the S&P in the green too. On a sector by sector basis, what we've seen play out, pretty mixed day overall, but industrials leading the way higher, up by about almost 2% in today's session. Of course, we are ending things on a positive note here, but for the week, still close to break even, if not in the red. We'll see where we end up at the end of the session. Overall, the month's been very strong for broader gains, but of course, it feels nice to end the week in the green. We're going to have much more coming up for you here on Yahoo Finance in the next hour. We're continuing our discussion around that GameStop and Robinhood trading controversy. We're going to be discussing that with the ranking member in the committee that led that discussion, the House Financial Services Committee, representative from North Carolina, Patrick McHenry, is going to be joining us to break all of that down. So stay tuned. We're going to have much more on the other side of the break. We'll be right back after this. Welcome into Yahoo Finance Live. I'm Zach Guzman alongside Akiko Fujita, and well, that might be a cat scratcher behind me. I am not a cat. I want to take a look at the market action we're seeing right now. To wrap up the week, we got green across the board here. The Dow up by about 140 points. The Nasdaq and the S&P also enjoying in the rally. Also want to spotlight Uber shares here as investors are shrugging off a big court loss in the UK's top court. We'll break down another ruling that says labeling Uber employees or workers there as independent contractors is not right. the pressure mounting to provide benefits, and the fallout from the GameStop and Robinhood hearing in Congress. We'll have the highlights and lowlights and chat with the congressman who co-led that hearing. House Financial Services Committee ranking member Patrick McHenry will join us later on in the hour to discuss all that. But first, the White House Coronavirus Task Force delivering updates on the vaccine rollout, stymied a bit by that storm that rocked the Midwest. Yet vaccination rates are still climbing steadily, with about 12% of Americans having already gotten their first dose. And joining us to break that down is our guest here, Dr. Sharif Elnahal, University Hospital CEO and former New Jersey Department of Health Commissioner as well, joins us now. And Doctor, glad to have you back on with us. Just curious to get your take on what we're hearing of the timeline and rollout, where we're expected to see kind of this return to normal based off the vaccinations we've seen thus far. What's your take on that?
Well, thank you for having me. Despite the difficulties with the weather, which we've experienced here in New Jersey, but also across the country in places that weren't expected, of course, in Texas and other areas, we still are on pace. So we're still at about 1.3 million vaccinations per day. And while 12% is still a far cry from the herd immunity threshold of 70 to 80%, we're almost at President Biden's 1.5 million vaccination per day goal already. And the 100 million vaccinations in 100 days, I think, will certainly be met. I will tell you the vaccination sites are getting better at administering, more efficient, but also you see a lot of doses that were previously reserved for long-term care or pharmacies being harvested, those that were not used because they were not using them efficiently in some places, being harvested by states to re-administer to folks at these vaccination sites. So all of that is helping with the pace of vaccination.
We're also learning a lot more about the vaccines themselves. This latest data coming from Pfizer and BioNTech about their vaccine, that one dose can in fact be as much as 85% effective. Does that change the strategy, you think, around vaccine distribution at a time when there's so much concern about the ability to build up supply to inoculate the entire population here in the U.S.?
Well, I'll say this, absent a full review of that data from the CDC, but also having Dr. Fauci at NIH weigh in, I would still stick with the two-shot regimen for Moderna and Pfizer. And that's because the clinical trials really showed the extremely favorable results against that regimen. And we need to make sure that we try to adhere to the trials as much as possible. I will say, though, that the Johnson & Johnson vaccine is on the horizon, very likely to get an emergency use authorization from the FDA soon. And after that, we will have a explicitly studied one-shot regimen that is just as effective as preventing hospitalizations and deaths for the two-shot regimen, which should be used as much as possible and will only help with the pace of vaccination. So I'm very much looking forward to that.
Yeah, and the other piece of, effectiveness around these vaccines has been the question of spread. A new study out from Israel kind of highlighting that Pfizer shot is pretty effective in reducing the viral load, fourfold reduction in one of these non-peer-reviewed studies that points that out. How important is that? Because we already are seeing cases come down, and a lot of people are asking how much of that is a result of 12% of Americans getting their first dose, and how much of it is just kind of, weather changing or the idea that, people are taking this a little bit more seriously. I mean, how optimistic are you that that data point actually shows that this recovery into the spring and summer might actually be stronger than people expect?
Well, we should all be happy that the pace of reduction in cases is happening to the extent that it is. And unfortunately, the variants do add a variable that will potentially make that, short-lived and possibly turn things around for the worst. But we don't know that yet, and we do know that we're decreasing. So something is happening right. I would be careful, though, of ascribing that to vaccination. 12% is, again, a far cry. And we saw from data out of Israel, which is by far the #1 country in the pace of its vaccination, we really started to see cases drop much more precipitously when you start to get to that 40-ish% range of the population vaccinated. And they're well on their way to getting well past 70 to 80% very soon. So we do know, though, that as long as we increase the pace of vaccinations, if we get to that 1.5 million vaccinations per day, that is the most important determinant of return to normalcy and the easing of many other restrictions. And we're already starting to see, for example, the CDC remove the quarantine requirement, even if you're exposed, if you have gotten vaccinated. And you should expect the CDC to add even more latitude to vaccinated folks in the coming weeks to months.
On the local level, we have seen a number of states now move to lift the mandates for mask wearing, as well as restrictions on social gathering. Iowa, the very latest here. Are we at that stage right now in the pandemic? If you look at some of these states that have moved in that direction, have things quieted down enough to allow for the lifting of face coverings?
Well, I would be very cautious about going too extreme in terms of easing the restrictions. We really need to be careful. Remember, the entire country saw a pretty precipitous drop in cases towards the end of the spring of 2020, only to see sharp increases again in the middle of the summer in many parts of the country because there was a little bit too fast of an easing of restrictions. And so we don't want to be caught in that scenario again, especially as we see so much hope with these vaccinations. We really should wait for the herd immunity effects to be noted clinically and to be noted in the data before we start doing that. So that would be my cautious advice to states that are considering doing that.
All right. Appreciate you bringing us the latest on all of that. Well, a lot of topics we got into there, but appreciate it. University Hospital CEO and former New Jersey Department of Health Commissioner, Dr. Sharif El-Nahal. Thanks again. Have a great weekend. The interesting thing on that front, though, kind of connecting the dots between the vaccine rollout and the recovery on the economic front is getting updated, at least from one Fed official. Interesting to hear the take here just recently, earlier this morning, Richmond Federal Reserve President Tom Barkin weighing in on maybe increasing his outlook that we might not need to get to herd immunity that Dr. Fauci says will come by the fall. He said individual hesitance is going to be a real barrier for herd immunity. The good news is I am not sure the economy requires it. There still may be some caution, but I expect those who have been vaccinated to have large pent-up demand. So kind of speaking to the idea here that meals, entertainment, travel, as cases come down, then with vaccines, warmer weather, that he expects businesses to start returning to normal operations. And we have seen quite a bit of that pent-up demand when it comes to travel and getting out. So could that boost the economy sooner rather than later? Here to join us to discuss is Todd Morgan, chairman of Bel Air Investment Advisors. And Todd, appreciate you coming on here to chat today. I mean, I guess, you know, there is some reason to believe that we could see, you know, that pent-up demand start to trickle into the market when it comes to consumers wanting to spend and get out earlier than reaching herd immunity, if we are to believe, you know, the positives we're seeing in these vaccine studies. What's your take on maybe when we'll start to see that trickle into the earnings reports? We've already seen strength there.
Well, that's a good question. There's multiple answers. First of all, we're starting to see the earnings increase this first quarter. And I think they're going to continue to be extremely attractive for the rest of the year. I also believe that people are spending more money. There's somewhere between $4.5 and $6 trillion cash in savings accounts and checking accounts that is available to spend. It's not going to all be invested in the stock market, and it's not all going to be spent. But the average savings for an individual historically has been around 6%, and we're at 14%. Now, what's interesting to note, and my numbers might be low, is that a couple of weeks ago, I heard the chairman of Bank of America come out and say they have $3.5 trillion of cash in their checking accounts. And just in that bank alone is really enormous. And I can see over the coming months that people are going to get out more. I can tell you, I'm in Los Angeles. Just in the past week, I can tell you the volume of traffic and foot traffic, automobile and foot traffic, has increased dramatically, and I can see it continuing to do so throughout the rest of the year. So I think by the end of the summer, you're going to see people moving. In addition, a number of my employees are already booking trips to Europe, to India, all parts of the world to take advantage of this new roaring 20s.
How much of that pent-up demand that you're talking about, if you look at sort of the high savings rate and just how much cash is on hand as we look to see the economy opening up increasingly, how much that translates into inflation, you think? I mean, you've heard the warnings from economists who've said, look, things could get a little too hot by the end of the year. What's your assessment on how much of that we'll actually see come through once people feel a little more comfortable going out?
I think inflation is slowly moving higher. The question is how much of it is going to be in wage inflation, because that's probably the most important. We see commodity prices going up. but I don't think it's problematic. I think we're better off watching where interest rates go, and the 10-year at 130, 129 is acceptable. Think about those numbers on a relative basis going back in time. If I would have asked you 2-3 years ago, what do you think about the 10-year being at a 130? You'd say, unbelievable. I'm going to go buy a new house, et cetera, et cetera. So I don't think I'm in the danger zone. I think for investing, especially in equities, I think we have the wind to our back for the rest of the year. I think it'll be a good year for investors.
All right, Todd Morgan, Chairman of Bel Air Investment Advisors. Appreciate you hopping on to chat that with us there. Let's shift away from the broader market and dig into a specific story we're seeing play out today in Uber. Investors there are kind of shrugging off this ruling out of the UK's top court around an issue we've seen raised many times, that their classification of workers as contractors over employees getting challenged and losing in that UK ruling, saying that it was wrong for Uber to classify at least 25 drivers as contractors. And Akiko, I mean, this is something that you've covered quite a bit for us here at Yahoo Finance, and it seems to be a question that's raised in a lot of jurisdictions, whether or not it's right. Shares basically flat on the ruling, though, so I guess, and this is limited to just those 25 drivers, but it raises a lot more questions around how they should be classified.
Yeah, that's the key here, I think, in terms of investors shrugging things off. When you look at the ruling itself, it only applies to those 25 drivers. And also it dates back to a case that began in 2016. And Uber has said that with all the complaints that were filed within this lawsuit, the company's already changed some of the services since the lawsuit was filed. And there's a number of issues here on the table. There's the issue of benefits. Uber says, look, we already provide additional benefits, including insurance. Also, the transparency available for drivers, whether that is making sure that drivers know where they're actually going on the trip and what the fare is for the booking. That's something that wasn't transparent when this case initially started, but now is. And also drivers are not necessarily penalized for turning down the fare. So Uber's argument would certainly be that, look, things have changed since this ruling. Labor activists certainly, though, over in Europe, especially feeling a little empowered by this ruling, because there are a number of challenges that are happening across the continent as it relates to not just Uber, but the gig economy. It affects companies like Deliveroo, which is a competitor to DoorDash, a number of other companies as well. So the investor reaction probably as to be expected, just given how long this case is dragged on. But the key is going to be whether, in fact, this ruling is going to set a precedent for the way other European courts start to look at this issue, and that necessarily would not be good news for Uber.
No, it wouldn't be good news for Uber. And we saw that play out in California, too. They lobbied hard. You covered that for us. And it was an extreme amount of money that they spent. But they won that ruling in the way that that vote went. And so to see it play out in the UK, too, now, as you said, these are questions that have lingered for years, now getting some answers in jurisdiction by jurisdiction, case by case. But clearly an overhang for investors if you think about the costs to paying benefits and how they, both Uber and Lyft, stress that it wouldn't necessarily be good for their balance sheet if they had to. It's an important question to stay in mind for investors.
Yeah, no question about that. I mean, Uber, as well as other companies, have said that their costs are likely to go up if they have to reclassify their workers as full-time employees. And to your point, we did see in the initial passage of Prop 22 over in California a huge bump to both Uber, Lyft, as well as DoorDash, who poured in a lot of money into that campaign. So something that we will continue to watch, of course. Coming up, Rebuilding America. We are wrapping up our infrastructure week by looking out the jobs picture, specifically the jobs that could be created if there is a bump in manufacturing. The CEO and founder of Workshop for Warriors joins us after the break. All this week, we have been honing in on the issue of infrastructure, Rebuilding America, the series really looking at the individual change that we're likely to see as a result of a new focus potentially on infrastructure from the Biden administration. Today, we're focusing on the jobs picture, specifically in the manufacturing sector. We've got Hernan Luis y Prado, who is the founder and CEO of Warriors for, did I get the name? Warriors for Workshop for Warriors.
Workshop for Warriors.
Looking through my notes here. Let me just ask you, first of all, you work specifically with veterans as well as sort of transitioning service members. What does the jobs picture look like on that front, specifically because there's been a lot of concern about manufacturing jobs that have not necessarily come back to the U.S., despite the focus on that under the previous administration?
So this is a kind of a chicken or the egg issue, that there are 2.4 million advanced manufacturing jobs that will be going unfilled over the next 10 years. And you currently have 522,000 unfilled jobs due to a lack of skilled labor in America. And we have almost 1 million veterans that are transitioning out of the military over the next 5 years. So it's literally a perfect storm for America to regain the workforce that she deserves and to give veterans careers that I think that they've earned.
Yeah, and Hernan, we've talked about, skill building and kind of this transition for veterans coming back, re-entering civilian life. And it seems like it will take a bit. It takes a long time for some of these skill building programs to pay the dividends they promise, 2 to 6 years, you say. How does maybe Workshops for Warriors do a quicker job of matching veterans with these manufacturing jobs you're looking to get them started in?
So when the Secretary of the Navy visited our school, he called us the SEAL team of manufacturing. And what he meant by that was that you're able to get an incredibly high caliber person quickly trained up into an advanced manufacturing career. If you've ever been in the military, you know that you're dealing with literally the best of the best, the top 1% of Americans that are even eligible to become part of the United States military. When they come out of the military, they come through our program, we are dealing with an incredibly competent, capable, committed crowd of people, and we provide accelerated and compressed training programs in computer-aided design, computer-aided manufacturing, machinery repair, and we get these people trained up and give them an opportunity to earn nationally recognized credentials so that they can hit the ground running. And since 2008, 95% of our graduates have been placed and retained in full-time jobs. So in short, what I can tell you is we've been doing what we've said we've been doing for quite some time, and in 4 months, Workshops for Warriors graduates can be the vanguard for America's manufacturing workforce. Internally, we say from front line to production line.
Hernan, when you think back to where the discussion was in the labor market pre-pandemic, things were much better, but there was also concern about the skills gap, that the job openings didn't necessarily match the skills that were available. Do you think that has actually widened as a result of this pandemic? And if so, what opportunities do you see to try and narrow the divide that already exists?
So that is a great question. The current state of America's manufacturing sector is embarrassing as an American. America's manufacturing capability has been slowly eroding for decades, and it's leaving fewer Americans interested, and it's creating this ballooning skills gap that you're mentioning that's dragging down the entire U.S. economy. Right now, as I said, 522 open positions, which is going to result in $2.5 trillion in lost economic impact. Fortunately, America has got 1 million motivated service members that are transitioning into the workforce, and if given accelerated training, coupled with nationally recognized credentials, they're going to become America's manufacturing vanguard. That's the number one complaint I hear from top manufacturing companies like Reliance, Steel and Aluminum, Ariel Corporation, SpaceX, Google, Tesla, is they don't have enough skilled workers to fill the job openings they have. And most importantly, America does not have a nationally viable training pipeline to be able to give American companies the employees they need. And that's where Workshops for Warriors steps in.
And what do you think is, real quick before we let you go, what do you think is the biggest misconception maybe around programs like this that really is taking veteran service members and putting them in the manufacturing sector? I mean, it would seem like one that might translate well. So what are you always surprised by when you hear people reacting to Workshops for Warriors?
The biggest reaction we get is that they're surprised. Workshops for Warriors is the only accredited school in America that trains, certifies, and helps place veterans and transitioning service members into advanced manufacturing careers throughout America. The only school in America, and we are raising our throughput to almost 2,500 graduates by January 2024. So if your viewers, and I know there's 10 million of them here this morning, go to wfw.org and donate. They can do so knowing that 87% of their monies go straight to training programs, which lead to average jobs of $60,000 a year.
It's important work. I love what you're doing. The CEO and founder of Workshops for Warriors, and I'd be remiss if I didn't thank you for your service too, sir. As an American whose cousin served in the Navy, got to thank you for that, and thanks for coming on. Hernan Luis y Prado, appreciate it once again. Have a great weekend. We're going to take a quick break here on Yahoo Finance Live, but when we return, breaking down the new tax questions that a lot of freelancers out there are going to have to sift through this tax season in 2021. Stay tuned. We'll break all that down for you right after this. Welcome back to Yahoo Finance Live. In this week's Tax Time, we're breaking down some big questions that our viewers have regarding the upcoming tax season, given all the changes on the stimulus front, on the freelancing front, as well as we see more Americans start to work as freelancers. I want to bring on our next guest to break down all the questions and answers. Joining us right now on that front, Caroline Bruckner, a tax professor at the Faculty of American University Kogod School of Business and Managing Director of the Kogod Tax Policy Center, joins us right now. And Caroline, I guess, you know, some Americans out there might be facing this question of what it means to pay taxes as a freelancer for the first time. So what stands out as important to know this time around?
So, a couple of things are really important. For freelancers, most of them are unfamiliar with the process of paying taxes, and so they don't realize it's a pay as you go system. So, we pay a little bit out of every paycheck when we're employees, our employers withhold and send that money on to the IRS. When you're a freelancer, you don't get the benefit of withholding. And if you are going to owe more than $1,000 of taxes over the course of a year, you should have been paying quarterly estimated payments. That is a huge tripping point for many freelancers the first year they file. A second issue that really comes up and really hurts gig workers is they don't know that they're responsible for paying self-employment tax. These are the equivalent of payroll taxes, so your Social Security and Medicare taxes. It's 15.3% on their net earnings of over $400 or more. That really can be a bear for gig workers who might not even owe any income tax on their earnings, particularly if they're low wage or low income taxpayers, but they still nevertheless have to file a return to pay self-employment tax, which is a separate schedule with their 1040.
One of the reasons you're focused on gig workers, of course, because we've seen so much growth during the pandemic, even those who had jobs, who were potentially looking for additional funds on the side. When you look at the pool as a whole, how much of an increase have we seen during the last fiscal year?
So MBO Partners, which tracks independent contract work every year, just put out their latest survey results in December of 2020. And they found that across the board, only occasional gig workers, so folks that have a side hustle, were the only category of workers that actually had job growth, not just job recovery. And that number increased from 15 million in 2019 up to 15.8 million. So about 800,000 people. And that makes sense because when people were furloughed or they lost their full-time job, what did they do? They turned to their side hustle to make up the difference in income.
The other thing that we were talking about in last week's tax time is kind of the question and maybe surprise around having to pay taxes on unemployment insurance and that whole aspect of the tax season. But I mean, when you look at what Americans are, I guess, bracing for this time around, it doesn't necessarily sound fun to have to pay as you go, where some people have the enjoyment of just that withholding up front. I guess, what's the biggest headache for Americans that you work with out there in dealing with all this, especially in a pandemic?
So there are a couple of really big challenges. The first one is, yes, unemployment insurance is in fact taxable income. And this matters for gig workers because part of the CARES Act, what it did was create unemployment insurance availability for gig workers and self-employed workers who traditionally are shut out from claiming unemployment insurance under state programs. So when Congress made that change, gig workers for the first time, so existing gig workers, could claim unemployment insurance. And the reality is that most state agencies did not do withholding as part of the pay-as-you-go system for federal tax liability. What that means is that a lot of gig workers are going to go file their taxes having claimed unemployment insurance because they didn't have work and then walk away actually owing a tax bill. Problem number one. Problem number two, how do you pay your taxes when you don't actually even get an information return from the company you work with? Under current tax reporting rules, online platforms aren't required to give gig workers that they work with, so Uber drivers, Lyft drivers, Airbnb hosts, they don't get any kind of tax reporting form like a 1099 from the platforms they work with until they have $20,000 in transactions and 200 transactions. So very few gig workers make that $20,000, 200 transaction threshold to even get a 1099. So they don't even have records on how much income that they earned.
Yeah, so just more headaches on top of those headaches for people who are not exactly as established in the freelancing space. But Caroline Bruckner from the Kogod Tax Policy Center, appreciate you joining us to answer all those questions for us. Have a great weekend as well. I want to shift back over, as we approach the weekend, let's focus in on the streaming side of our coverage here on Yahoo Finance as we break down in this week's Fame and Fortune, not just the new titles coming to streaming platforms, but also the engagement on those platforms, a very big competitive piece of the streaming landscape. And it's an important piece for Disney, which is going to be rolling out a live action Emma Stone starred Cruella take on the Disney classic, and just want to play a piece of that before we dig into it. Take a listen.
But a new day brings new opportunities. And I was ready to make a statement. How does the saying go? I am woman, hear me roar.
All right, so joining us in this Fame and Fortune this week to break it all down for us is Yahoo Finance's Alexander Canal. And Ali, when we look at it, Cruella is a big bet for Disney because, the live action one's always a little bit of a break from what we think of when it comes to Disney. But what are the expectations around Cruella?
Right. And this seems to be a little different movie overall, right? It's a little darker, a little more adult and sophisticated. The tagline of the film is brilliant, bad, and a little mad. So I'm personally pretty excited to see how this goes for Disney. If we take a look at some of their recent live action films, like Mulan, for example, that was PG-13. So it seems like they're leaning into this more sophisticated versions of their movies. Now, I'm happy that they're focusing on a villain. Normally, their MO is to focus on princesses, but this is going to be a prequel. It's going to dive into the backstory of Cruella, what made her the hardcore fashionista villain that we all know her from in 101 Dalmatians. And if we take a look at some villain-focused prequels from the past, they've actually done very well. Maleficent, which is a Disney film that was released in 2014. It grossed over $750 million at the box office. Outside of Disney, we had Joker, another really successful villain-focused prequel that had over $1 trillion in sales when it was released in 2019. So people really gravitate towards these types of films. A lot of fans on Twitter were talking about this trailer. They were making comparisons between Emma Stone's Cruella and Harley Quinn from the DC Comics series that was played by the one and only Margot Robbie. I want to read off a couple tweets from fans. One user writing, quote, honestly, getting more Harley Quinn vibes than Cruella DeVille from the recent Cruella trailer. Another saying, are we absolutely sure Emma Stone's Cruella DeVille and Harley Quinn aren't the same character going through a different style phase? And you can see there, they do look very, very similar. Now, this film is expected to debut May 28th, 2021. So just in time for Memorial Day weekend. I think the expectation here is that it will be released in theaters. The marketing for this film, it did not say exclusively in theaters, but it also did not say that it would be released on Disney Plus. So I think that's something that we'll get a little more clarity on as we get closer. Obviously, Disney had to delay quite a few of their films amid the pandemic. So it's just a wait and see approach right now when exactly we'll get this film. But it's an all-star cast. Emma Stone, she's an Oscar winner. Emma Thompson's an amazing actress. Glenn Close, who is the OG Cruella DeVille for many of us, she's serving as executive producer. So I think we could potentially get a few Oscar nominations here. I do think we could see a potential Oscar nod for best costumes. It looks like the fashion in here is pretty intense. And so I'm very excited about it. And hopefully we can all be able to enjoy this and watch it on May 28th.
Yeah, Ali, I have to say, I thought the original 101 Dalmatians was pretty dark as well, even as an animation. So we'll see how this one fares. You're also looking at just the amount of growth we have seen in streaming. It feels like every week we're talking about just new numbers out, but you've got the latest updates here in terms of how many hours were actually streamed.
Right. I mean, the growth on video streaming apps, especially on mobile devices, that's increased exponentially over the past few years, but especially in 2020. App Annie, which is a mobile analytics firm, found that on Android devices specifically, total hours spent on streaming apps from Netflix and Disney Plus to YouTube and TikTok hit nearly 1 trillion hours last year. If we take a look specifically at breakout apps that have experienced year-over-year growth, in the US, we're going to see Disney Plus reign supreme. Then Netflix is also having a lot of growth in other global international markets, especially Argentina, Mexico, and Brazil. But when it comes to total time spent, that's not going to Disney Plus or Netflix. You're seeing on your screen now that it's actually going to YouTube. So that short, snackable content is really engaging for consumers. YouTube in the US seeing 23.1 hours per month, increasing levels from 2019. And that's bleeding over into other apps like TikTok. TikTok experienced a 70% growth from 2019, with users spending 21.5 hours per month on the app. So there's still a lot of streaming content to enjoy. I also think that's a reason we're not going to see the streaming wars come down in the energy that we've seen over the past year or so. We have Paramount Plus coming out in March. And the reason for this is because consumers are craving it. And now we have all this data to back it up.
Well, and there's plenty of content out there, right, to continue fueling the growth there. Thanks so much for that, Ali. We are looking ahead to the next steps for lawmakers coming up after the break as they investigate the volatility around the GameStop trade. Ranking member of the House Financial Services Committee, Congressman Patrick McHenry, joins us for that conversation after the break. Welcome back to Yahoo Finance Live. Shares of GameStop trading above the $41 a share mark. That's a 2% gain roughly in the session, but still well above that $480 a share we saw it peak to at the height of the volatility in the trade. Yesterday, we heard from House lawmakers as they heard from the executives of Reddit as well as Robinhood, Melvin Capital, and Citadel. Let's bring in a ranking member of the House Financial Services Committee, Congressman Patrick McHenry. And Congressman, it's good to talk to you today. A very lengthy hearing yesterday. What was your takeaway? You've called this a fact-finding mission. What's the one nugget that you pulled away, you think, from the hearing that could lead to potentially additional questions or regulation?
Well, I think this is a bullet point to a larger value. This is a story in a larger narrative. And the larger narrative is that retail investors, so-called non-sophisticated investors under our securities law, they want more and better access to our markets. They want more investment opportunities. They want more sophisticated investment opportunities, and they've been locked out of it. So this is but a bullet point in a larger story, in a larger narrative about fees being crashed through competition, and about retail investors wanting greater access to more products.
And Congressman, I mean, I guess, there were criticisms even during the hearing of political theater on both sides. It was interesting, the start that we got when Robinhood CEO Vlad Tenev was talking during his opening statement. You had to kind of jump in there to stiff arm Chair Waters to kind of protect his testimony as she was kind of interrupting with questions of her own. What did you make of just the overall flow of this thing, and maybe the grade that you would have given it in terms of getting into the details?
I would give it less than a passing grade as far as getting into the details. Look, when you're the majority, not to quote Hamilton, the musical, but you get to choose the menu, the venue, the seating, right? And so the chair of the committee gets to determine when we meet, for how long we meet, and who's on the panel. And as a Republican, as being in the minority, I get to have one witness on the panel. So I try to get a witness who could answer the fullness of what's happening in the marketplace. The rest of the folks on the panel get to a piece of the story. The Reddit CEO got a couple of questions, but frankly is secondary. You're talking about asking the CEO of a company about stuff posted on one section of Reddit when they have millions of users. So I don't think the setup was right, and I don't think the panelists were correct. And I think it was about grabbing a headline rather than finding facts. The reason why I called the hearing and called for the hearing was so that we could get to the heart of what happened here and whether or not laws were adhered to, and whether or not we need to change laws to open up additional access, or what's really happening in the marketplace.
What do you see as the answer to that latter point that you just made about whether changes are necessary? And if so, what's the next step?
Well, I think, first of all, we need to ensure there's disclosure around payment for order flow. There is. That laws are adhered to in this transaction. That appears to be the case, and we're going to continue to dig through that. And so my clear takeaway is that to re-regulate or to enhance regulation or to layer on more regulation or to lock retail investors out is the wrong approach. New taxes, financial transaction tax, as one of my Democrat colleagues called for in the hearing, is not the right approach. Taxing people for their investment opportunities or taxing people for saving is not smart for our economy and for long-term saving. So we know there's some bad ideas. I think we have to look more deeply at what's happening here. What is happening is we have individuals that paid off student debt. We have folks that lost money, but we also have people that said, the hell with it. We're just going to invest. We don't care if we're going to get into this trade. We don't care if we make money or lose money. We just want to put the screws against a rigged system. And so they're speaking to the larger narrative piece that I mentioned, that they want more access to equity. And that's why I raised with the CEO of Robinhood whether or not they would offer equity to the users of their app. If they seek to go public, will they do that? The fact is that regulation out of Washington prevents that from happening. The Uber driver should have been able to have an ownership stake. They're the ones that made Uber successful. The Robinhood user is the one who's made Robinhood, the company, successful. So we need to make sure that we can open up equity, ownership in our society much more broadly than it currently is.
Yeah, and it's a complicated slate of issues you guys were getting into. So, just to be fair, there was a lot of moving pieces and you had 5 hours. So maybe, it could have been divvied up. I hear what you're saying on that front. When it comes to maybe the issues on Robinhood specifically, because of course, payment for order flow is something all the brokers get into, but Robinhood was the only one on the panel to talk about it. And I really enjoyed the line of questioning that came from Representative Anthony Gonzalez, who got into the details about what happened specifically when they had to raise the $3 billion to kind of cover the liquidity issues here. So I wouldn't necessarily let them off the hook right away. So what do you want to learn more about what happened there? Because obviously we saw GameStop stock. We were talking about it on Monday. We saw the trading issues come in later in the week. So what more do you want to learn about maybe what happened on a minute-by-minute basis that could be potentially problematic in locking out retail investors?
Well, I think that is a very good point. There is some detail here that we need to drive towards. And Representative Gonzalez from Ohio, I think, asked a really sharp question, which was getting into the nature of whether or not Robinhood was equipped to provide the access that they claimed that they were providing to their users, and why they locked customers out. And so they're raising $3 billion tells me that they needed additional liquidity. That's kind of obvious, right? That's an obvious statement to the marketplace. But we need to make sure that these institutions were properly regulated for the value at risk, properly regulated for what could be a very turbulent marketplace, hour to hour, minute to minute, day to day. And so we need to get more deeply into the heart of those issues of proper funding and the liquidity practices of broker dealers, and specifically new broker dealers.
All right, appreciate you coming back on here to chat all about that. Obviously, this is an ongoing story, so love having you back. We'll have to have you back yet again as this goes on. But Representative and Ranking Member of the House Financial Services Committee, Representative Patrick McHenry, thanks again for coming on. All right, we're going to take another quick break here on Yahoo Finance, but we will be right back with much more, including more on today's trading session to see all three indices in the green. Stay with us. Welcome back. Let's get technical on the trading action we've been seeing play out here, including a look at Beyond Meat, one of those names that got caught up in that retail frenzy a couple weeks ago. Here to chat more about that is Yahoo Finance's Jared Blickery, along with a special guest. Jared?
All right, we got Brian Shannon here, founder of alphatrends.net, and let's go into Beyond, because this is a stock we were talking about a month ago, starting to show some bullish signs, and it looks like it got caught up in the GameStop volatility, although I didn't really see it part of the Reddit phenomenon, but a lot of stocks just got caught up in it. So what are you seeing in this chart right now?
Yeah, last time I was on, Jared, the stock was, I think, 137 or so. And, 2 days later, it gapped up to 200 plus. And we were talking about GameStop, and I'd actually mentioned that there was a sizable short position in Beyond. I certainly didn't expect the stock to run from 135, 37 to 220 in 2 days. So I took the opportunity, don't look the gift horse in the mouth, to feed some stock out into that strength, and then got stopped out of the balance a couple days later. But now I think it's back to a place where it's a low risk area to reload for another thrust higher in shares of Beyond.
Well, let me just, why don't I get you to break down this blue line, which is anchored VWAP. In fact, this is a volume weighted average price since the beginning of the year. And you'll also notice I'm still calling it VWAP, force of habit there. Yesterday in the hearings, none other than Ken Griffin, he was pronouncing it VWAP, and that's, I know, the way you pronounce it, so maybe I'm wrong here.
Well, regardless of what it is, it's a great tool for really helping us determine who's in control from a certain point in time. And Ken actually said something really important that I think a lot of people missed, and that was that he's talking about buying on behalf of institutions based on the daily volume weighted average price, the weekly, or even mentioned the monthly. Also, you've got the year-to-date volume weighted average price, and that's that blue line we're looking at on Beyond right now. And what we saw is the stock pulled back to that area. It also closed the gap from that big move higher. So it tells me, I think, that the profit taking is most likely done from that big move higher. And now that it's back to the average price for the year, it's in a better position where institutions don't feel like they're chasing the stock anymore. They're getting the average price and feeling good about their purchase. So I think it makes a great purchase right in this area with a stop, just below, maybe, here it is at 164. I think that, it'd be a little too tight just below yesterday's low, but maybe about 160 or so. And it wouldn't be a surprise to me to see the stock return north of 200 here soon. And Bill Gates is on the bandwagon for fake meat too.
That never hurts. If you get Bill Gates or Warren Buffett on your side, tend to see some institutional support there. Well, I want to move to a different industry, and that is biotech. We saw some individual names in biotech also getting caught up in Reddit, but this in particular is the iShares Nasdaq Biotech ETF. So it's an average of a bunch of different components. What are you seeing in this?
Well, we see a clear uptrend, Jared. I mean, just a beautiful pattern of higher highs and higher lows. And kind of the same thing. We have the year-to-date volume weighted average price just below. That's the blue line. And then the red line you see there is the rising 50-day moving average. So what we see is a pullback. Now, I don't like to buy pullbacks necessarily, as they're pulling back. But when they come into a certain area of technical significance, such as the year-to-date volume-weighted average price, it looks to me like, the old phrase that innocent till proven guilty, a trend once established, more likely to continue than reverse, that we should treat it as a pullback, and it's getting ready to make its next move higher again. And if it fails, again, we're in a low-risk area that if it does fail, you don't have to risk a whole lot. You could put a tight stop, probably just underneath that rising 50-day moving average.
All right, great. Well, it looks like we got a little bit more time. We were chatting about Tesla briefly. This is a stock that kind of broke 800. That was a red flag for me, but what are you seeing right now?
Yeah, I mean, when last time we spoke, it was just ahead of earnings in Tesla. And I had made a point that I was cautious ahead of the earnings because it's had such a good run. And now, the stock is 50 points lower from there. So, it always pays to be a little bit cautious ahead of earnings. But now we're seeing the stock is kind of settling onto its rising 50-day moving average. So I think it's just a little bit neutral here right now. Not quite ready to buy, but certainly in an area where it's going to make sense to start looking for emerging signs of strength again to see if it can continue to move higher, or if it's going to be a deeper correction, or maybe just something that needs some more time to digest the big gains of the last year or so.
All right, Brian Shen of Alpha Trends, thank you for joining us. Tossing it back to you, Zach.
Thanks, Jared.
All right, Jared Blickery, appreciate that. I want to shift gears over to a story we've been covering in Texas and other Midwestern states there. And this power awkward position, considering the fact that Texas really does rely so much on natural gas. And Akiko, you've been looking at kind of the natural gas industry's role in light of all that and where it goes from here.
Yeah, Zach, we were talking about this earlier this week. It's been interesting to see the finger pointing that has happened in the aftermath of these power outages, as we often see it after some natural disasters. But I've been looking through the numbers here that's provided by the Energy Information Administration, and it really does highlight what you just said about just the dominance of fossil fuels within Texas. This is the look at Texas's net electricity generation. So which source generates the most electricity? The very top bar you see there is natural gases. So regardless of what we have heard from the likes of Texas Governor Abbott talking about the frozen wind turbines contributing to the outage, there's no really going around the fact that the failures in the natural gas system contributed to the scale of the outage that we saw. And the interesting backdrop to all of this is that we have seen the natural gas industry increasingly face a lot of skepticism about the claims that they are, in fact, a cleaner fuel energy. Because at the end of the day, while it is much cleaner than coal, it still is generated by fossil fuels. And what we've seen nationally are these local fights that have been popping up to ban natural gas hookups. We've already seen that in more than 40 cities in California adapt some type of ban on natural gas hookups. We saw earlier this year, New York City Mayor de Blasio talking about a potential ban on new developments. We've seen Seattle pass a similar law. We've seen Denver as well. So there does seem to be a lot of momentum building in this push to electrification. And the American Gas Association says, of course, that they've got 180 million Americans who use natural gas. It's not feasible to transition completely to renewables, but it does feel like this fight that has kind of been brewing under the surface in these local markets have now kind of spilled over in Texas, as we've seen this huge failure in the powers there.
Yeah, it's a good piece to point out there. You know, it's all each form of energy carries its own emissions, and you know, it's all kind of a riding scale. Natural gas cleaner, as you pointed out, than oil. But interesting to see kind of the role of natural gas failing in Texas and the awkward position that we found a lot of politicians in when they were describing those failures relative to the renewables. But at the very least, we did see Texas just a short moment ago call off that emergency, says its grid is back to normal. So there's that positive to focus in on. For Akiko Fujita and myself, that'll do it for us here in our hours on Yahoo Finance Live. Stay tuned. We got much more coverage coming your way as we see the S&P 500 dip into the red. Stay with us.
Happy Friday. Welcome into the 1 p.m. hour here on Yahoo Finance Live. Checking market action right now. The S&P 500 flipping into the red, down about 1 point right now. The Dow and the Nasdaq, however, in the green. Markets getting a slight boost today after Treasury Secretary Janet Yellen said that a large stimulus package would be needed for a full recovery in the United States. The Dow reacting positively there, up over 62 points right now. On a sector basis, we have industrials and materials leading right now. Industrials up about 1.7 percentage point. In the red right now, we have communication services and utilities. Communication services down about 0.9 percentage point. Want to take a look over at some stocks right now, but first let's start with cryptocurrencies. Bitcoin hitting a market cap of $1 trillion for the first time. As you can see there, almost $55,000 for just one Bitcoin, getting a pop today, up over 5% right now. Want to take a look over at Palantir. Palantir getting a boost today, up almost 12% right now. Now, that stock is rallying after the investor Cathie Wood actually decided to double down on her bets in the company. And a lot of folks have been watching Cathie Wood and been following a lot of her stock picks. And as you can see there, Palantir getting a nice boost after she said that she was going to continue to reinvest in that company. Want to take a look over at Roku right now. Roku up over 2.5% right now. Roku rising after they posted a beat on the top and bottom lines in their quarterly earnings report. And they also said that they saw a 58% surge in some of their numbers, as a lot of folks like you and me are staying at home throughout this pandemic. And I want to start today's show on the coronavirus pandemic. We have Yahoo Finance's Anjali Khemlani here to talk to us about all of the latest details, as well as her conversation a little bit earlier today with former CEO of Haven. Hi, Anjali.
Hey, Kristen. Yeah. So let's start with that coronavirus news. Obviously, we know that the winter weather has been hampering vaccination efforts as well as deliveries. With the White House COVID-19 response team today say that there's about 6 million doses backed up, or about 3 days worth of delivery. And they're working on getting that backlog worked through the weekend, employing FedEx and UPS, who have already been working on the deliveries, to see if they can coordinate those weekend deliveries, as well as asking vaccination sites to stay open longer for the next couple of days so that we can catch up on all those canceled and delayed appointments. Meanwhile, looking at the FEMA sites that are continuing to open up around the country, 5 more sites have been stood up, 1 in Pennsylvania and 4 in Florida, including Orlando, Jacksonville, Miami, and Tampa. So getting those larger scale sites, these are supposed to be about 6,000 per day going. Meanwhile, we also got news out of Pfizer, really good news about their temperature storage needs, and possibly being able to reduce the temperature to what is normally found in freezers in pharmacy. So they've submitted that data to the FDA, and we're waiting to hear back on whether or not that will be accepted. All of this wrapped up around really the outlook of the COVID-19 response. And we know Dr. Atul Gawande, and not only is the former CEO of Haven, and that's that joint venture between Amazon, Berkshire, and JP Morgan, but also served on the COVID-19 advisory board for the Biden-Harris transition team. And so he has a lot of insight into what the federal response should be looking like, as well as firsthand experience with running vaccination sites. Listen to what he had to say.
Yeah, first of all, understand where we are and how far we've come. We are at 5 times the doses per day than we were at the beginning of January, about 1.7 million doses a day. The last few days with the disruptions in the South and Southwest due to weather have slowed down vaccination in several parts of the country. Our team, I'm a co-founder of CIC Health, which is administering vaccine in mass sites like Gillette Stadium, Fenway Park, a place called Reggie Lewis Track and Field. Those sites, we now suddenly are being notified that there may not be the deliveries of vaccine that we expected. And it's mostly about communication and letting people know what the disruptions are. This will slow down for a few days, but we'll get back on track. I'm confident in the coming days after that. More to the point, I think that the increase in supply that the government has been able to procure, there's every indication those supplies will continue to increase over time. And I think that will help alleviate some of the bottlenecks, but still the demand is enormous. It will take at least 6 to 8 weeks to work through getting to all of the people over the age of 65 and with 2 comorbidities that are seeking to get their appointments.
When we're talking about that and the seeking appointments, it seems like technology has been one of the hurdles. You started CIC with testing. So what are some lessons that you've been able to apply in knowing how to reach some of these individuals, especially when we're talking right now, across the country about vaccine equity?
Yeah, so there's the easy way to get to large numbers of people is you have online sign up, you have people coming in who can be savvy with technology, but there are 2 big disruptions. One is that many of the software systems have been built, by startups or entities that are just getting these systems up and running, and they've been swamped, and we've seen significant downtime, and that's meant that it's the most persistent and ingenuitive that have been able to get access. Furthermore, plenty of people do not have ready ability to navigate, and many of the most needy folks are in situations and in communities or speaking have language barriers that make it so this is not the ideal way to go. Many states have set up call centers to make that easy, but those are also swamped. Part of what we've been building out is that we've released blocks. We're releasing blocks of scheduling. We're going to be testing this out to community health workers, to agencies that can go door to door and get people signed up. Because although there is the flood coming in of folks who are coming in online or willing to, stand in lines overnight, many of the neediest people are those that are not getting the vaccine, and we have to get to them.
I know that today there's a House subcommittee hearing on just this topic. When it comes to being able to solve some of these problems, is it the federal government's job? Is it the state? Who should be responsible for solving this?
Well, it's all of our responsibility. The federal government is essential for setting up several things that I've seen now rolling out. One is FEMA being able to set up vaccination centers in sites where there are significant holes. It is extraordinary, but as a country, we have major pockets that don't have pharmacies, don't have clinic access, and don't have large centers with the capacity to take on the need. And so the federal government is going to be essential for backing the funds to enable those sites. Many, not only FEMA, but state agencies are also vital for doing that. It's exactly the same we saw with testing. You had people who had lots of access to testing and good turnaround time, and then a whole lot of other places where there simply wasn't the availability, and you had to stand up testing sites like now are present in most counties across the United States, and where you can still get walk-in or drive-up testing. We have to make that possible for vaccines too.
It's one of those things when we talk about, generally the healthcare system in the U.S. and the public health system in the U.S. Definitely the veil has been lifted on some of the issues that are here. And when we're talking about that in the global context, the U.S. is used to sort of touting being number one in so many areas. And now we see where the system is kind of broken. But that also plays a role, I think, in the vaccine rollout, where we're looking at not just the U.S., but the Western countries that have developed vaccines have not really hoarded, but there's definitely a lot more allotment going there. And so it leaves room for other players like Russia, India, and China to play a larger role when it comes to the global vaccine distribution. Is it safe to say that they're sort of leading this right now?
Well, it's certainly the case. We in the United States and in other countries have been accused of hoarding the vaccine. We have made purchase agreements that would be enough to do more than 3 times our population. Canada has bought enough to vaccinate 9 times their population. And then there are other countries that have had great difficulty having access. It is interesting seeing Russia, China, and India, even though they are pressed for supply, are also using a certain portion of their supply for getting diplomatic advantages. It is great news. I think that the Biden administration is committed funds and willingness to transfer vaccine that goes unused abroad to the COVAX facility, which is run by the World Health Organization to arrange distribution for low and middle income countries. This is a global pandemic. It won't be solved only by vaccinating here.
When we're talking about also just the healthcare system, you are a professor at Harvard. We've heard a lot about the idea that there could be ways to help fix the healthcare system. And with tying in your role at Haven, what did you see that maybe could be fixed that needs to be started, or some things that surprised you about the health system in this country?
Well, very clearly, there are certain things that that the private sector can do, and part of my learning working with Amazon, Berkshire Hathaway, J.P. Morgan Chase was how do you stand up mass capabilities like testing, like vaccination to get us towards the top? And as a country, that kind of capability for delivery, it has, we started out in a rocky way with vaccines, but we're now in the top 5 in the world for distributing vaccine. However, there are fundamental ways in which we need the public sector fixes that the private sector cannot fix. We have way undercommitted to our public health resources. Long before this ever happened, we had 1/3 of our counties that did not have access to an obstetrician, even more that didn't have inpatient psychiatric care. Why are we surprised that we find that we don't know where the gaps are for testing or for vaccines, let alone identifying where shortages of masks are? And we're now playing catch up on a desperately underfunded public health sector. I hope that coming out of this, we will finally recognize those investments are essential to being able to move us forward. And then we're not committed as a country, even now, to making sure everybody has coverage, everybody has a doctor, and they're part of a system that can reach you. That's part of the difficulty that's made this so specifically difficult in the United States.
So as you can hear, a lot of commentary on really some of the issues that have been coming to light throughout the pandemic, and hopefully some light going forward on how to fix that. Kristen?
All right. Thanks for, as always, with all the latest updates and details. Yahoo Finance's Anjali Khemlani, and everyone can go tune in to that full interview again at yahoofinance.com. And coming up, we'll be talking with Time's Up CEO Tina Chen about investing in caregiving and its impact on women. That's next. Welcome back to Yahoo Finance Live. We have Time's Up CEO Tina Chen here with us now to talk all about how building up infrastructure for caregivers will help women. Tina, welcome. Thanks so much for joining us again. You and I were chatting in the break about the fact that I've been having this conversation a bit recently with Reshma Sojani from Girls Who Code, and she's been on with us before, and we've been talking about this burden that women have been shouldering throughout the pandemic. How much is this burden of caregiving for children, for elderly parents? How much is that costing women?
Oh, we know it's costing them a lot, both because women are speaking out, but they're also voting with their feet, meaning that, we've had over 2 million women leave the workforce during the pandemic since less than a year ago. Women's labor force participation is at its lowest rate since the 1980s. So we are on the verge of wiping out all of the progress that we have made over the last several decades of women coming into the workforce. And it is because they can't manage caregiving, right? Schools are out, childcare centers have closed, folks can't afford it. They can't be balancing going out to work and caring for someone at home. We've got elderly parents, as you point out, not just children. This is about caregiving from zero all the way through to your elderly years is what we need. And we need self-care. We need paid leave. We need paid sick leave. We need that whole comprehensive infrastructure to help get women back to work. And not just women. Here's the thing, Kristen, it's going to stimulate the whole economy. We need to make these investments if we want our economy to recover.
Okay, so I want to get into that in just a moment. But what would building up this caregiving infrastructure, really look like?
Well, what it would look like is several things. So first of all, we need to have paid leave and paid sick leave, a national policy. We are one of only 2 industrialized nations in the world that has 0 policies for any form of paid family leave of any kind. We need to have a national paid leave family leave policy. We also need to support caregivers. We need to support making sure that caregivers have labor protections and a living wage, so that it's not all just unpaid caregiving work. My dog supports that. We also then need to build up the caregiving infrastructure. So that means building up childcare centers that have closed during the pandemic, but they weren't sufficient before the pandemic. So we need more childcare centers, and we need more facilities, for our elders. We have a disproportionate use in this country of long-term care facilities, nursing homes, as opposed to investing in what would be cheaper and better for folks, meaning in-home care and community-based services, which is what most people want, and will actually be more affordable and will keep them safer. We know so many people who were in nursing homes and exposed to the pandemic at even worse rates. That's what a comprehensive caregiving solution looks like. It's childcare, it's elder care, it's self-care, it's paid leave, it's investing in our caregivers.
Right. Now, would some of those services be paid for by taxpayers or the families themselves? And when I say that, I mean, would we have free daycare? Some countries do this, where they provide free daycare for children up to a certain age, usually until they go to school, or free elder care is also being provided in some other Western nations. So would those services be free? And how much would this stimulate the economy if we made those moves?
So some of it you need government investment to build the infrastructure. One of the advocates has likened it to like you have to build the mass transit system so that people can get things like the tax credits and the infrastructure, the payments, the pandemic payments that are in this American Rescue Plan that President Biden has proposed. But just giving folks cash isn't going to solve the fact that there aren't enough childcare centers available. So we do need government investment to, as you point out, build affordable and where people need it, free childcare, free elder care, daycare centers for the elderly, for respite. We need to have supporting, in-home services, expand the Medicare program so that it will do that. But then we also need to empower people themselves. And that's why President Biden, and I'm so pleased, has put in the expansion of the child care tax credits and the earned income tax credits to make sure that people have cash in hand to actually also help support their ability to purchase childcare that they need and support themselves when they need it. And then finally, we need something like paid leave. And we need a mandate, Kristen, that will actually set up a social insurance program. They've done that in California. We know that it works. If you like the unemployment insurance program, tack on less than pennies on an employer tax that will build up a fund that will help finance paid leave for everyone, for those employers who can't afford to provide it themselves.
Now, when we talk about some of those caregiving jobs, because, your study shows that millions of those new caregiving jobs would be created. But when we look at some of those caregiving jobs, these jobs are often taken by women, and they're often taken by women of color. And frankly, a lot of those jobs are typically described as having poor job quality. They're described as having low wages, those home healthcare aides and nurses, for example. How can we make sure that even with an initiative like this, that the creation of those jobs doesn't continue to exacerbate some of those problems that we're already seeing in the caregiving system, and that it doesn't continue to, in a way, exploit a lot of minority women?
No, absolutely. But that's why part of what we are supporting when we talk about supporting a comprehensive caregiving infrastructure is investing in those paid caregivers. So that's why it's so important to increase the minimum wage to $15 an hour and make sure that caregivers are covered in that expansion of the minimum wage. We need to make sure that caregivers come into the formal economy. So many of them exist right now outside the formal economy. They don't have the ability. Actually, caregivers aren't allowed to unionize. It's an artifact back to the New Deal. And we need to change that so that they can get labor protections and we can recognize them for their workforce. And here's the thing, Kristen, because we're talking about Yahoo Finance, this is a growth industry. We need this, the supply side of this industry to grow. There are 4 million babies born every year, and 4 million of us become senior citizens every year. We are going to need more capacity in the caregiving, industry itself to provide quality care for everyone who needs it. So if we compensate people fairly, we create a pathway and make it professional and provide people training and the ability to move up, this is an industry that can grow and is actually really ripe for investment and serious look at investing in it as the infrastructure that we need.
All right. Time's up, CEO Tina Chen. Always love chatting with you, and I appreciate you coming on to chat about this very, very important topic.
Well, thank you. Right now to push through transformational change on this issue.
All right. Well, coming up, we'll be talking about the little-known process that was in the spotlight yesterday during the GameStop hearing. That's payments for order flow, and it's grown in 2020. Welcome back to Yahoo Finance Live. Now, yesterday's GameStop hearing touched on a process called payments for order flow. Now, that's when a brokerage like Robinhood processes orders from investors like you at home and passes them on to a market maker to complete the purchase of a stock. And it's only been increasing lately. We have Yahoo Finance's Brian Chung here with more details. Hey, Brian.
Hey, Kristen. Well, usually when someone puts an order in for a stock trade, buying or selling a stock, you just put the order into your brokerage and then some magic happens and then it shows up into your account if all goes well. Now, obviously with the GameStop trade, it seemed like there was a lot of confusion over all the back processes behind that, which has called into attention this process known as payments for order flow. And you laid it out quite nicely. Essentially what it is that a brokerage will pass on an order from clients to a middleman, a market maker, wholesaler like a Citadel Financial or Virtu Financial, for example. They'll actually execute the trade on the exchange. And then based off of the improved price that they can get, they'll take that money, keep some of it for themselves, and then dole out the rest back to the brokerage. The share that's brought back to the brokerage is referred to as payments for order flow, and it's really exploded in 2020. Take a look at this bar chart that shows you just the change between 2019 and 2020. You can see in 2019 that among the 4 largest brokerages, there are more than this, but these are the 4 largest ones. It really increased by almost 3 times between 2019 and 2020. It's about $2.5 billion in revenue from this specific business model in the course of 2020. And pay attention to also the blue, the light blue section of these bar charts. That represents specifically order routing revenue made at Robinhood, Vlad Tenev's company. You can see that it actually increased quite a lot from 69 million in 2019 to 687 million in 2020. That's a tenfold increase. So obviously this is a pretty big cash cow for the company, and a big reason why also there's a lot of interest in this payments for order flow structure, which has really been quite profitable for these companies, Kristen.
All right. Well, AOC actually asked Robinhood CEO Vlad Tenev about this payments for order flow process. How did that conversation go for anyone at home that might have missed that exchange?
Yeah, well, to kind of drill down on it, and a lot of people probably did miss because it was towards the end of that 5-hour hearing, but she essentially asked the question, well, why don't you return more of that revenue that you're given from the market maker and pass it on to cost savings for the client? Now, the way that works is because, again, any sort of improved price that the market maker is able to get, they'll pocket some of that for themselves and they'll give the rest of it to the brokerage like Robinhood. But Robinhood can decide to pocket 100% of that for their own operations, or they can pass some of that on to consumers by saying, actually, we'll give it to you as an improved price beyond what you had already put in your order. So AOC was asking, why don't you just return all of that money that's given to you from the high frequency trader or the wholesaler? And Vlad Tenev said something to the effect of, well, we need that money to operate. In fact, we operate on low margins already, so that's what we need to use to survive here. That's the reason why zero commissions exist. So very interesting commentary. And another way of translating that is we're not going to return more money to those people, and that these trades essentially are not free.
Okay, so I'm really glad you mentioned that, zero commission trading, because we've seen that really proliferate across the space, or almost every broker right now does not charge a fee in order to do some sort of transaction, or at least make these trades for most retail investors. So when we were looking at that chart, you saw the absolute explosion in the payments for order flow. Now, is that all down to the fact that we essentially have a lot of these brokerages saying, listen, we charge zero commission trades and they have to make that money from somewhere? Or is it because 2020 was a year where everyone was staying at home, pocketing a little bit of extra money, and they decided to invest? Or is it a case of perhaps all of the above?
And this is exactly the right question to be asking. Keep in mind that payments for order flow, what you were just looking at in that chart, is not all the revenue sources that go to E-Trade or Robinhood or TD Ameritrade, for example. They have other revenue streams as well, subscription services like Robinhood Gold, for example. But payments for order flow has become a larger share of revenues for all of these companies. And that's because those commissions don't exist anymore. You didn't need to necessarily make that much money off of payments for order flow when you were charging per trade. So it's a little bit of the structural change within the industry itself. It's a little bit of the increase in just the amount of interest in retail trading because of the pandemic, because of the stimulus checks, because of Wall Street bets. But regardless, it's a kind of the confluence of all these things that made the GameStop story so interesting here, and why it was such a part of the kind of spotlight in that hearing yesterday. But a very interesting trend to be watching in the years and months ahead as well.
All right, Yahoo Finance's Brian Chung, thanks for breaking all of that down for everyone at home. All right, coming up, our Business in Black segment, we'll be discussing the Black-owned skateboarding company, Proper Nar. Welcome back to Yahoo Finance Live. Time now for our Business in Black segment. We're highlighting the Black woman-owned skateboarding company, Proper Nar. Let's take a quick look.
I think that little Black girls should be able to pursue whatever interest that they're into. If they want to skateboard or start skateboarding, they should go ahead and do it. Don't let people discourage you, just go for it. I grew up in like small town Ohio. Not only was I like the only Black girl, I was like the only Black person there at all. I've been in love with skateboarding since like middle school. I first started on like a penny board, which was those little like plastic boards. Then I moved on to like a regular size skateboard, and that was way better. Proper Nar came into existence about 7 years ago. I was working at this factory and it was horrible. It was hot. I was like making windows. It was like minimum wage. And I was just like, I can't do this forever. I just took my tax return one year and just went ahead and did it. I love skateboarding, and it's just something that I've been into ever since I was a little kid. I have always had a passion for it, and what better thing to do than just to go on with your passion. Getting into skateboards, it's like a big investment. I design all the skateboards from Proper Nar. Every single one I have drawn either on my iPad or, drawn on paper and, scanned it in. Kind of like taught myself graphic design. About 6 years ago, I decided I wanted to actually go to school for it. So I went and got my fine art degree and then finished with a graphic design degree. It's really hard for women to break into the industry with, being a professional skateboarder, let alone, being on the sidelines and owning a skateboarding company. Nobody will tell you, who their supplier is because they don't want you to be able to go to the same person. And, a lot of these companies, they get bigger by working with professional skateboarders. I haven't had access to those same professional skateboarders. I'd say the last big challenge that I had would be business knowledge and being able to get funding. I didn't have a big investor. It's been all my money or money that came from sales. Definitely had people that have doubted me along the way, family members that were kind of like, shocked when they heard that I was like quitting my job to, work in skateboarding. A lot of people online too, I've had people, say Black girls don't skate. You get the occasional person at the skate park that, has something dumb to say about it. But I feel like I've definitely had more supporters than negative people though. The pandemic has affected the business in a positive way, and with people having more free time and doing more outside activities. Skateboarding is an awesome outside activity. People have been buying more boards to get out and do that. Beyonce, I am so thankful for Beyonce and her Black-owned business list. That was also one of the things that really helped my company this year. That kind of happened at the same time as around like all the protests and stuff. I could definitely tell something was going on with my sales that day when I woke up to that list. Right now, business is doing really great. It feels surreal seeing my art go out and going into people's homes, and people will send me videos of themselves skateboarding. I can like see my graphic. It makes me realize, like why I do what I do. It's an awesome feeling.
And let's bring in Proper NAR owner Latasha Stone. I loved reading about this story because I don't think people give enough, or the Black community enough credit for the depth and breadth that exists. We have Black nerds and Black musicians and also Black skateboarders. So what was it like, getting into this space, not just as a business owner and not just as a, female business owner, but as a Black business owner trying to break into the skateboarding realm?
It's been fun, but it's definitely challenging. It's been a long learning process, a lot of mistakes along the way, but overall, it's been good.
Did you feel like when you started this company that a lot of folks were saying, listen, not only do women not skate, but Black women don't skate, and therefore not really take your company as seriously or want to invest as much into you? I know you talked about in that video, we heard a little bit about some of your struggles really trying to get this business up off the ground.
Yeah, and those comments are things I've heard ever since I first stepped foot on a skateboard, and even to this day, I still get it, and I still get it online too. But yeah, it's a lot to handle at times, but you just gotta learn to kind of brush those negative comments off and not let them really get to you, and kind of use them as motivation to keep going.
And how much do you think being a Black woman, helped you in this space? We talk a lot about, the struggles and the hurdles that Black folks face when really trying to start some of these businesses. I'm really wanting to flip that on its head and kind of figure out where you feel as if, this actually helped you, that it was an asset being a Black woman in this space. Are you having folks saying, I was underserved before. No one really saw me. No one was, catering to my needs. And now here you come along. Proper NAR has come along. And now they feel like they have products that they actually want to purchase.
Yes, definitely. I've been hearing that a lot the past year or so, especially from like parents, like, oh, I'm so glad that I found you because now, I can find a product that my Black daughter likes. And like when they look at my videos that they see something that they can relate to that helps them. And I feel like it's definitely helped a lot more women that look like me get involved in the skateboarding industry.
I'm wondering how you see the skateboard industry changing, especially as you mentioned, your business is doing pretty well throughout this pandemic as more folks are staying at home and want to be outside, just want to do something and not be cooped up. Do you see any permanent changes in the industry at all? Perhaps maybe it's even getting more inclusive?
Yeah, I have noticed that it has been a little bit more inclusive here lately. I've seen some of the bigger companies try and like post more people that look different. Maybe I've seen a couple try and add more Black people to their skate teams, so that's good. And I hope it continues. And I hope they're getting the pay that they deserve within the industry. And yeah, I just hope it keeps going.
Last question for you here, Latasha. As I had mentioned to you, I was checking out your website and checking out some of your boards, and they do seem to cater a lot more towards girls and to women that are interested in skateboarding. Wondering what kind of interest you've had in men that want to purchase.
I'd say most of my sales do go to women, but I do have guys that buy. I get a lot of guys that ask like, "Hey, are these only for women? Like, can guys ride them too?" And the sizes, they fit everyone. You just have to broaden your imagination or your style for when it comes to what you like. But yeah, they definitely can ride them if they want to.
All right, Latasha Stone, owner of Propernar, congrats as well for making it onto Queen Bay's list of Black-owned businesses. And coming up, we will be talking about USPS delays and how it's impacting companies. That's next. Welcome back to Yahoo Finance Live. Checking market action. All three major indices are now in the green. The S&P 500 had been in the red a little bit earlier. And of course, stocks right now are still fairly flat today, despite the increased support for stimulus from Treasury Secretary Janet Yellen earlier today. Now let's talk about the United States Postal Service. U.S. Postmaster General Louis DeJoy will be facing Congress over questions of his overall leadership of USPS and of those postal delays. And those delays have had huge impacts on businesses. So let's talk about that now. We've got Mitch Goldstone, CEO of ScanMyPhotos.com, here with us to discuss. So Mitch, thanks for joining us. We've had you on before, and we had you on in the run-up to the elections when we saw a pretty big slowdown in postal deliveries. You said at the time that these delays were pretty bad back then. Have they gotten any better?
It's not, and there are a lot of new troubling signs that are going on where we're all trying to restore trust in the U.S. Postal Service. So the biggest issue that's happened through the pandemic is that 40% of all of our orders are from families preparing for memorial services through Zoom. It's so sad where they're sending in all their photos, digitize it, get it back, and the delays are unacceptable. It has to be instant.
Now, I'm wondering how these delays, really impact a business like yours.
They do. They're devastating for everyone. You look at what's happening, really with 38% on-time delivery for first-class mail now. And the new plan through Postmaster General DeJoy is to delay it further by transferring first-class mail from airplanes to trucks. So that's going to be really bad. But we're seeing it really hard. It hasn't just been seasonal from the holidays, but especially now. And I know from so many other businesses, we're all trying to reinvent ourselves to challenge the delays because people have to get their orders instantly. We've come up with a couple of cool ways of doing it, but a lot of businesses can't.
So let's talk about that for a second. How have you had to innovate around all of these shipping problems and delays that you guys have been experiencing?
Sure. And every day we get questions from customers about delays. They need their orders scanned immediately. So what we came up with at Scan My Photos is instant scanning. So the same day it's received, it's scanned, it's uploaded, sent back to you the same day. So that's been really helpful, but it's also been very costly. We've had to increase postage to get the orders back quicker too. So there's so many added costs with that. So what we're doing is we're preparing a bill to send to Mr. DeJoy directly, if he's still there, because next week is a big deal. President Biden is able to nominate new board members, and with the majority, then DeJoy can be fired, and that's what we're hoping is going to happen.
So how big is that bill that you plan to send to the Postmaster General?
And I was hoping to have it for you today, but it's probably going to be in the hundreds of thousands of dollars. And we're adding all the expenses, all of the costs we had for it. And when you take that and with all the other companies to send a bill to DeJoy for all of the delays, problems, and it's not just delays, but it's goodwill too, where our name is being tarnished because people need the deliveries instantly, and it's just not happening. Now, a good question is, why not just switch to FedEx, UPS? We've been in business 30 years, and I think the biggest secret to our success is trust, and we trust our vendors, 600,000 employees at the U.S. Postal Service, and we would never dream of switching to another courier. I think what needs to happen is with the new Postmaster General, Brad Stone, a great author, wrote a book about Jeff Bezos and Amazon. It was published in 2013. He's working on a new one. And that's what I hope the new Postmaster General will read to understand if Amazon could do it, the U.S. Postal Service can do it too.
I'm wondering, I know you said you wouldn't dream of switching to, another postal service provider, but is it getting to the point, however, where, these losses that you're facing are getting greater than the costs of going to UPS and FedEx? I mean, how long can you guys reasonably, continue with these delays?
That's a good question. It doesn't matter. I don't care because we passionately love the U.S. Postal Service. They invented our business, and even though they're having problems from the top, it's not the other people. It's the Postmaster General that's causing this. I'm not bending. I'm not going to leave. What I'd like to do is to rebuild trust, have them rebuild trust with us. We're not leaving because it's all about loyalty. And when you have a partner like that, you can't just leave. It's more than just economic factors. It's emotional, and they become such great friends of ours over the years, and our customers love them. So yeah, that's not happening. They need to fix their act.
Well, unfortunately for the United States Postal Service, a lot of customers do not have the same level of loyalty that you have. Of course, as we've seen, the amount of customers that the USPS has had steadily decline throughout the years. Mitch Goldstone, CEO of ScanMyPhotos.com, thanks so much for joining us. And coming up, we will be talking about student loan debt. Welcome back to Yahoo Finance Live. Let's talk student loan debt now. It's top of mind for many after a town hall where President Biden said that he would not support canceling $50,000 of student loan debt. We have Arti Swaminathan here to discuss the latest in student loans and how some borrowers are actually being left out of that student loan repayment pause. So again, I thought everyone had that federal loan, or at least who had a federal loan, was getting this pause now until October 1st, but that isn't the case. So tell us why.
Yeah, so this goes into the complicated history that went on in the back end, right? So before 2010, people didn't take out federal loans with the government. They actually took out something called a federal family education loan. This is a little bit different. It looks a lot like a private loan, but I'll explain to you what happened. So in 2008, when these liquidity crisis happened with the Great Recession, the government went in and bailed billions of dollars in these federal family education loan programs and brought it into the federal loan system, right? So they became federal loan borrowers. But millions of people were left behind in that system. It didn't matter for like 10 years until 2010 when this payment pause happened. And then 6 million people suddenly realized that they didn't qualify. And this was not something that they decided. This was something that Congress did and kind of unintentionally hurt them. And also debt collection. Debt collection hasn't paused on their student loans if they had defaulted on it. So this is something advocacy groups are really upset about. And they wrote a letter to the education department saying, please change this. But I think they're just looking at it now and deciding what to do.
I have a question here about what kinds of folks really have most of these loans, because private loans tended to have much higher interest rates. Folks who couldn't get lines of credit for student loans were really forced into this private loan, which is not really a great thing now when we have coronavirus and the pandemic, and they're struggling just to make ends meet. And then they have these really high bills with these higher interest rates. So tell me about how big the problem is and who owns some of these loans.
Yeah, 6 million people own these loans. And I spoke to one lady who is African American, and she's 50 years old. She's retired and she has a FEL loan that she has been holding since 1989. So a lot of FEL loan borrowers are a little bit older, and they also, that was the predominant loan system back then. So everyone had taken these loans out. But if you were not smart enough to consolidate it or lucky enough to be part of that federal bailout, basically screwed. So kind of interesting, very black boxy, but hopefully they fix it.
All right, Yahoo Finance's Arti Swaminathan, thanks so much for joining us today. And Alexis Christoforous picks up in the 2 p.m. hour next.
Hello, everyone, and welcome to Yahoo Finance Live for Friday, February 19th. I'm Alexis Christoforous. It looks like stocks are clawing their way back into the green or recouping some of those recent declines that we saw, and the Nasdaq actually set to outperform the other major indexes for the first time this week. You see here all three major indexes higher across the board. For much of the week, we saw this rotation out of high growth tech and into the cyclical stocks, and things are starting to even out a little bit more today. I want to run through some of the data we received today, which was pretty positive on the whole for the economy. Business activity in the U.S. private sector held up, boosted by accelerating service activity, also manufacturing output. And that followed a report just a couple of days ago that showed consumers used those latest stimulus checks to boost retail spending in January. We saw the largest increase there in 7 months. And also this morning, sales of previously owned homes in the U.S. unexpectedly increased in January, up 0.6%, extending 2020's strong run of housing market activity. Still, though, we are seeing that activity begin to slow down from its historic clip as inventory remains squeezed and also affordability remains a big issue. Some economists, though, have actually increased their estimates for gross domestic product for the first quarter of the year. I want to bring in Jared Blickery now for a look at some assets that are moving particularly up today, and that would be Bitcoin surpassing yet another milestone, Jared, now blasting through $55,000. What's going on there?
Minutes ago, on some exchanges higher than 55,000, and yes, on ours as well, 55,125 every day. You need a new hat with the security. You can see over the trailing week, up 16%. Ether also at a record high. That's up 6% over the trailing week. But I also want to mention Binance. Now, this is kind of an Ether alternative, maybe playing a game of catch up, and we've seen some of these smaller coins really pick up steam as well. You can see that's up 128% over the last week, and that's 61% today alone. So not a lot of incremental news here other than the price itself, but keep waiting for somebody like Apple or some other big company like Tesla, in addition to Tesla, to announce that they, in fact, have bought Bitcoin. Alexis.
All right, I want to get to our number one trending ticker on the site today, and that is Palantir, finally rebounding. It had a really rough week after that disappointing profit report. So what's going on there?
Yeah, 6 days, 34% down, and we had a ton of shares coming into the market. So vested stock of 410 million outstanding options and restricted shares. That's about 5 to 6 times its current float. And given the very low institutional ownership at this point, it's only about 30%, you can really see that drop affecting it. However, emerging on the other side here, we are up for the day. So I think that's telling. Now, here's a 3-month look, and you can see we got this big spike top. This was the stock did kind of get caught up in the GameStop phenomenon. But you can also see that it's rebounding off of what potentially could be strong support here. So we do have this base that we broke out of before, and now maybe we're just building a new one, Alexis.
All right, another trending ticker that caught my eye today was Dropbox. I guess earnings were pretty good, but again, it's that outlook, right, that's tripping up investors here.
Yeah, this isn't necessarily one of those high growth names. And let's just take a look at our cloud database and software heat map, because in the lower right, that's Dropbox. So you can see they got a lot of competition. They're definitely on the smaller end. Over the trailing year, they're up decently, 29%, but not as much as some of the other high growth names. So after their earnings yesterday, William Blair is saying the revenue outlook was below expectations, and the results show that Dbox trying to strike the right balance between growth and profitability. They have an outperform rating. Citi has a buy on it with a price target of 30, and they're saying DBX may remain out of favor given the growth-oriented backdrop in the sector, although confidence will grow if it hits its guidance through the year. Also, I want to know that Jefferies has a buy on it with a price target of 28.
All right, and we want to get a check, of course, of energy, which has been very active all week with what we've been seeing going down in Texas. I know the sprawling blackouts that plunge that state into chaos because of the cold blast there starting to ease a little bit. We're also seeing some oil prices starting to stabilize, right?
Yeah, stabilizing right around $60 a barrel, which should be nice news for the energy majors. As you see on the screen here, energy stocks really up nicely today. Let's take a 5-day look at this. You can see Exxon's up 5%, Chevron almost there. This is for this week alone, excuse me. BP's up 7%. And only today we got news that the Electric Reliability Council of Texas, they manage the grid down there. They're saying that it's returned to normal operations today. But nevertheless, Texas has sustained about $50 billion in damage and economic loss. That's according to AccuWeather. And I know in a minute we're going to be talking to Ed Hers at the University of Houston, an economist, about this very matter. But just looking at crude oil here, we'll look at a couple of charts and we'll get the final settlement in about 25 minutes here. Crude oil down about 1/10 for the day. You can see not quite back up to 60, but over the trailing year just kind of gives you an idea of the incredible run it's had, Alexis.
All right, thanks a lot, Jared. Also, sticking with this story, President Biden says he expects to sign federal disaster assistance for Texas once the governor's request reaches his desk. And as you heard Jared just talking about the last few hours, power being restored to millions of Texans who had been without it because of the bitter cold. But still, you have millions of people in Texas not having safe drinking water, residents looking for groceries or bottled water in the stores are being met with bare shelves and long lines. And my next guest predicted that the Texas energy grid would fail. He predicted that about a decade ago. Ed Hers is an energy fellow at the University of Houston. He joins us now. Ed, good to see you. First off, I know that you are currently in Houston. Can you just tell us what conditions are like for you there right now?
Well, quite frankly, I've been very fortunate. Power was out maybe 40 hours off and on. I have power now. The water just came back after being out for 2 days. So in terms of my situation, it's just been inconvenient, but it's been a tragedy for many people.
For sure. And people have lost their lives because of this. And Ed, I know that the polar vortex is hammering a lot of different states across the country, Oklahoma, Louisiana. Why is it that Texas is the only one to have such a severe power grid failure?
Well, it's because of the way this market is structured. The ERCOT market is an electricity-only market. The generators all kind of gear up for the summer peak, August, September. After that, they're not all needed to maintain the stability of the grid most of the time. And so a lot of them go fishing and they just close the shop and head out. That's the easiest way to put it. They aren't paid to keep the equipment ready to go during the winter or during any other type of natural disaster that may recall them to service. And so that's what's happened. I mean, the grid tried to dial it up, tried to call in the units. Everybody had issues. They had not put antifreeze on, hadn't oiled, hadn't cleaned it up, hadn't purged the natural gas lines. That was the problem. And it's the same problem as we had in 2011.
Right. I was going to say, this isn't the first time that Texas has had to deal with such severe cold temperatures. It seems like lessons were not learned back then. I know back then you also were writing extensively, still do, about the Texas power grid. You called it a Soviet-style electricity market. So what can be done? How do you incentivize generators to maintain a reliable supply of power?
Well, you're going to have to pay them. You don't get a rate of return. Just look at the returns out of the generators in Texas. And of course, the flip side of that is look at the companies that are selling backup generators into Texas. I mean, starting 10 years ago, on the late night TV after the Tonight Show, the ads were for, male enhancement or final expenses, or your own backup generator, because the grid was becoming unreliable at that point.
Look, Texas has dodged federal regulation here for years because it operates its own power grid. Do you think in the aftermath of this, that might actually change? And is there a way to connect that grid to the national grid?
Well, even if you connect to a national grid, that's not and would not have solved the problem we had here. We had 40% of our generators go offline. We can't draw 40% of max power out of these neighboring states, especially when they're suffering from the same weather California in August had the same situation. You know, California on a daily basis imports 35% of its electricity. The heat wave hit California, but it also hit Oregon, Washington, Wyoming, Arizona, all the states that California buys that 35% from, and they couldn't sell it to them. So connecting to the federal grid, no, that's not going to help the Texas grid. It's not going to help the Texas market. This is something they built in-house. You're going to have to fix it in-house.
So, I mean, I know that Texas's leadership has come under fire here, particularly Governor Abbott, who has said the situation facing the people of Texas is unacceptable. He's saying he wants to ensure it doesn't happen again. But how do you do that? I mean, this is a system that has structural flaws that was operating under Governor Abbott's watch. Where do they even begin, Ed, to redo things and to fix things in that state?
Yeah, it's not just Governor Abbott. It's Governor Rick Perry. It's Governor George W. Bush. They didn't understand what they were putting into place and lining up a way that generators would not be able to cover their cost. And over the last 10 years, they haven't been able to even cover the cost of new equipment. They haven't been able to cover the cost of operations. So we've had a lot of supply leave the grid, and we ran against ever increasing demand because the population kept increasing. We're going to have to make payments to generators to have them on standby, or maybe full re-regulation of the ERCOT market so that the equipment will be ready to run.
I know that, in many ways, Texas was seen as a blueprint for other states looking to deregulate their energy markets. You have to think they're having second thoughts now. I don't know if you were able to hear me there, Ed.
Yeah, I'm having an issue on the internet side.
Sorry about that. I'll ask you one more time. We'll see if you can hear me. But I know that a lot of other states were looking to Texas as an example of how to deregulate their energy markets. Do you think that they're rethinking that now?
Oh, they certainly should be. I mean, for goodness sake, California deregulated first and Texas followed. California went into this disaster in 2000, 2001. They learned a bit. They learned a lot. I've spoken with some of the grid operators around and explained to them what the Texas situation has been over the years. And that stopped at least one state from this so-called deregulation. It's not deregulation. It's just simply a different form of regulation.
All right. Well, look, best of luck to you and all the folks there in Texas right now. We hope that federal assistance gets there very quickly. Ed Hers, Energy Fellow at the University of Houston, thank you. Coming up, the CEO of Waste Management stops by to discuss earnings and a whole lot more. We're back after this. Welcome back. Shares of Waste Management under a little bit of pressure here today, despite news that the waste disposal company reported earnings and revenue ahead of analysts' expectations. The Houston, Texas-based company reporting fourth quarter earnings of $1.13 a share on revenue of more than $4 billion. Joining me now is Waste Management CEO Jim Fish. And Jim, I know not only is the company based there, you live in Houston as well. Before we get into the company and the earnings report, just tell me how things are there for you and for your family.
Well, I was listening to your previous guest. I mean, we've had quite a bit of damage at our house, actually. So it's been a little bit of a tough week for us. And without power for about 48 hours, without water for 48 hours. So I don't know who to point the finger at, but there certainly needs to be some questions asked here.
What about for the company's operations as well? Did you experience any interruptions there?
Well, for the most part, our entire state was shut down operationally at Waste Management. We are fully up and running in Houston today, but Austin is just a kind of a skeleton operation, and the same for Dallas and Fort Worth.
It's interesting because the governor just said, just before we came on air, had announced that the energy emergency was over and the power grid was back up to normal. Are you experiencing that personally?
I think that's right. At least personally, we have power at our house and our operations seem to have power. I suspect we'll be back up and running across the entire state tomorrow, but Houston is up today.
Right. No, I'm happy to hear that. All right, let's talk about these results, which came in better than expected during a very challenging time for many industries, including yours. Just talk to us about what drove that momentum for you last quarter and last year.
Well, I thought our results were incredible. To actually in 2020 have earnings EBITDA numbers that were within 1% of 2019, which was a record year for us, was amazing. And then to have strong guidance going into somewhat of an uncertain year in terms of the economy, we think the back half of 21 looks to be. We think that'll be good, but the front half still has the COVID effect. So I'm a little perplexed at how the stock continues to react, not only for us, but for our entire sector, when this is really a reopening play. This entire industry is a reopening play. It's not getting priced like that, but I can't predict the stock price any better than I could predict the weather.
Yeah, I mean, I think that's a great point. There does seem to be this disconnect, right, between what the financials are showing and what the stock price is doing. What is it about Waste Management's story in particular that you think the investment community just isn't getting?
Boy, I don't know. I don't know what they're not getting, because we had a pretty long call yesterday and they were able to ask just about any question they wanted. I mean, when you look at Waste Management specifically, but also at the industry in general, we are a big reopening play, and a lot of our business has not reopened. I mean, you think about the industry being a trash and recycling industry and think, well, you haven't been shut down at all. But in our company specifically, 12% of our commercial business is schools. And schools in many cases have not reopened. In some states haven't reopened at all. And in some states are only partially reopened, whether it's universities or high schools or elementary schools. Anything related to hospitality, hotels are at 20% capacity versus a year ago. Sports teams, we pick up a big percentage of the NFL and Major League Baseball, NBA. Those haven't had fans for the most part. So the hospitality space, the educational space is all yet to reopen. Yet our industry is reporting these outstanding numbers. Waste Management reported outstanding numbers yesterday for 2020 and good guidance. And I also think they might be missing the commodity piece of this. Commodities, just about anything you read, it would tell you that commodities are going into a long-term uptrend, and the industry, and WM disproportionately so, has exposure or opportunity in the commodity space in our recycling business and our renewable natural gas business.
I know that you had to temporarily suspend price increases and certain fees for customers who were impacted by the pandemic in 2020. Has that spilled over into this year for you?
A little bit, because as I said, some of our businesses haven't reopened, some of our customers haven't reopened, and it just doesn't seem morally right to go hit somebody with a price increase when they haven't been able to reopen their restaurant. So there's still a little bit of spillover. I suspect that will dissipate as the vaccine rolls out, and we think that the economic reopening is largely tied to that vaccine. And everything you read about the vaccine is that the United States and Canada will probably be, the majority will be vaccinated by Q3 or Q4 of 2021. Therefore, you would expect small businesses and big businesses as well to be pretty fully reopened in the latter half of the year.
And I know that you recently closed your acquisition of the fellow waste disposal company, Advanced Disposal. What do you expect in terms of synergies there, and when might we start to see that happen, Jim?
We've seen a little bit of that already on an annualized basis. We closed at the first week of November. So annualized for 2020 synergies, we got about $10 to $15 million there. And then we'll get another $50 to $60 million in synergies on top of that in 2021. The number we've given out as a whole, once we're fully through the integration, is north of $100 million. And we think we'll be somewhere well north of that. We're very confident in how ADS is rolling together. We love the fact that we have some new teammates that think about our business very similarly to our existing WM teammates.
With the time that we have left, I know a few weeks ago you held your annual sustainability forum with lots of heavy hitters, CEOs from PepsiCo and Walmart, Microsoft. Give me one big takeaway from that forum when you had all these minds in one virtual room, if you will, talking about how to combat climate change.
I think what we found out, and we knew it going in, was that those three companies, among many, right, are very ESG focused. So whether it's Pepsi or Walmart or Microsoft, they're all very focused on ESG, and WM is as well. We think it's an opportunity for us to differentiate ourselves. We've focused very heavily. I mean, the E components, the environmental component, has been part of our business for a long time, and we're the biggest recycler in North America. We focused on producing renewable gas out of our landfills. So I think the biggest takeaway for us, whether it was through the environmental piece or the social piece, and I would tell you on the social side, we've not been, we've been focused on that social aspect of our responsibilities since I took the CEO position, whether it's inclusion and diversity or whether it's taking care of our employees through COVID, or enhanced benefits, whatever the case is. We've been very focused on ESG, just like those three companies that joined us for the Sustainability Forum. And I think the biggest takeaway is that maybe was for them recognizing how focused WM has been with ESG, and maybe it ends up being a differentiator as we gain more business from those companies and others like them.
All right, we're going to leave it there. Jim Fish, CEO of Waste Management. Good to see you. Have a good weekend.
Great to see you. Have a great weekend.
Facebook faces some global backlash for its decision to block users in Australia from getting news. We have the details after this break. Facebook's decision to block people from sharing news in Australia is being criticized by lawmakers around the world, and it sets the stage for a much bigger showdown between the social media giant and governments and news organizations. Yahoo Finance's tech editor Dan Howley is here now with those details. Boy, oh boy, did this thing mushroom and mushroom quickly, Dan.
Yeah, this is something that's been boiling up for some time, and now obviously it's boiled over. Essentially, what's happening here is Australia is saying, look, social media, Facebook, Google, the like, have really dominated the ad market and damaged the media industry to a degree that now government has to step in and kind of make some kind of deal between these companies and media industries in which if those companies, Facebook and Google, are going to use news stories from media organizations, then they have to compensate those organizations. Now, it looks like this legislation is going to pass in Australia next week. Google has already tried to come forward with some kind of agreement where they will pay News Corp, which is obviously the owner of the Wall Street Journal, Fox News, and owned by Rupert Murdoch, basically providing money for the use of articles in the US, UK, and Australia. But Facebook has taken a completely separate approach and decided they're not going to play ball at all. So they've pulled the ability to look at news in Australia, whether that's national or international news. In the process, it ended up taking down other kind of posts that weren't related to news. And basically, what we're seeing now is heavy pushback from the Australian government. We actually have a quote from Prime Minister Scott Morrison in which he says, "We will not be intimidated by big tech seeking to pressure our parliament as it votes on our important news media bargaining code. I encourage Facebook to constructively work with the Australian government, as Google recently demonstrated in good faith." Now, this is something that we're going to see potentially reach our shores in the US as well as in the UK. And we've had organizations like Google and Facebook say that they will work with media in the past, have provided some money to them. But the fact that they dominate the ad industry so much almost makes it untenable for media organizations to continue to operate as they would. And obviously, we've seen that impact from mass layoffs across different organizations around the world.
You have to think, though, this would be a huge revenue stream for media companies, which can use it right now. And wondering if even you might see a situation where there would be an ad revenue share, talking about how much these social media companies are now getting for their ads. You know, could that maybe be part of the equation going forward?
And that's kind of the idea here, right? The idea is that, you know, digital advertising has traditionally not done as well as far as revenue as print advertising. But the idea that there's so many people using a site like Facebook that makes up for that fact. So because they have so many users, there's so many different eyeballs on these ads that it makes it more profitable in the end. And that's what these organizations are arguing. They're saying, look, we were able to at first have some kind of revenue stream. Now that we're basing our entire revenue model on advertising, or have been doing this, we've been eaten alive essentially by the likes of Google and Facebook, as well as others. Like Amazon is up and coming in the digital advertising space as well. And so that's what they're trying to counter in Australia. And it looks like, you know, Google is willing to jump in there. They had originally, though, threatened the Australian government and say we may just pull out entirely. And they have done that before with Google News. I believe it was in Spain where they had pulled out when Spain tried to do something similar. But I think the fact that Australia is moving in this direction, and there's murmurs of it happening in the US and in Europe, there may be motion from the companies to signal their willingness to work with them. But from Facebook, that is obviously not the case.
Yeah, well, could be definitely larger implications here for us all. Thanks a lot, Dan Howley. Coming up, we're going to speak with Fastly's CEO Joshua Bixby about the outlook for cloud computing, and we'll wrap up your day in commodities right after this. Welcome back. We have got oil prices pulling back a little bit, but the industrial metals are absolutely on a tear. We have got Jared Blickery back to wrap it all up for us on this Friday. Hey, Jared.
Hey there. So we're settling lower today at 59.24 per barrel. That's WTI. Haven't said lower in a while because we've been hitting highs here for quite some time. In fact, we're going to finish the week lower. Haven't done that in a couple weeks as well, but still around these 13-month highs. And not surprisingly, as the power is restored in Texas and the permafrost melts in the Permian Basin there, I don't think it's called permafrost, but you know what I mean, we're probably going to see prices ease back a little bit. But the main drivers are just the reflation trade. And you mentioned copper. Well, guess what? We're going to take, let's take a 3-month view of all these commodities, and you can see some really big gains. Up in the upper left, that's RBOB gasoline futures. That's up over 50%. Then you got heating oil, Brent crude, WTI, and also copper. Copper has been on a tear, not only this week, this is over 7 days, but let's take a look at the last 3 months, basically back to middle of November. And it was really in the beginning of November when that reflation trade started taking off on the Biden victory. So industrial metals really surging here, along with some of the more traditional markets that we look at, like energy. Alexis.
All right, thanks a lot, Jared. The cloud computing services provider Fastly released earnings this week that beat on both the top and bottom line, but it was Fastly's guidance that left some investors a little disappointed. Joining me now is Fastly's CEO, Joshua Bixby. Joshua, good to see you again. Let's start with last quarter here. A pretty impressive revenue spike, up 40% year over year. Tell us what drove those results.
Yeah, thank you for having me here. It's an honor. Those results are driven by the trends that we're all seeing. The internet continues to grow. Security is critical for those who are serving on the internet, and the gains that the industry saw in March, April, May, they continue. Habits have changed, and people continue to use the internet more and more. It was a great quarter. I'm very proud of the team.
You say things behaviors have changed. Do you see this continuing even post the pandemic, even after we get back to business as usual and things open up? Are we still going to see the same kind of demand for all of these cloud computing and online services?
Yeah, we certainly feel that way. One of the beauties of being global is we get to see the openings happening at different stages. So when you go look at Israel, you look at some of the countries which are already starting to open up, you can see that the trends that we saw have continued. One of the great advantages we have is we serve those who have digitally transformed and those who care deeply about that process. They're kind of at the innovators, the most innovative. And so when you look at the Shopifys, or you look at the the Slacks and folks who are really at the forefront of innovation, we see that trend continuing. And we have already seen, as the world gets back to normal, we have seen it continue. So we're very optimistic about that.
Now, having said all that, you're still issuing some weaker than expected guidance for the year ahead. Why are you not as optimistic as Wall Street was hoping you would be?
Yeah, it's a great question. I think that we have always guided the same way. The principle for us is we start the year, we're a usage-based business, so we see, what we have and we commit to that. And as the year goes by, as we see more usage and our hypothesis becomes true, we are able to readjust. And so we've taken the same approach as a public company in every year that we have been in this seat, and that hasn't changed this year.
What about what you're expecting to see in terms of Fastly's new edge computing services?
That's a very large growth area. We are fundamentally at a turning point in how the internet is designed. For those of us who have been in this market for a long time, it really started with this sort of notion that everything would sit in a data center. And you would design to a web server, an application server, and a database server. What we now see is primitives, these new blueprints for how organizations are building websites and web applications and how they're doing security. And that involves the edge. So when you go to something like the New York Times, the edge, a set of servers really close to you, probably in the city that you live in, are actually responding to your request. It's figuring out if you're a paid customer, it's figuring out personalization and all of the things that make the web this incredibly unique platform All of that is now being done at the edge. So we are at the start of a revolution where developers are in control. They understand that speed and scale are important. We all know that if we encounter a website and it's slow, we go somewhere else. So when people understand the value of speed, and the closer we can get all of those critical processes to you, the faster it is, but more importantly, or as importantly, the more secure it is. The farther we can keep the bad folks away from the crown jewels of organizations, the better.
You mentioned being global a moment ago. I know that you just brought on a new chief revenue officer, Brett Shirk, who has a extensive background, I guess, in cloud computing. And one of the things he's going to be focusing on is expanding your overseas operations. Can you talk to us a little bit about what the goals are there?
Sure. The market for the internet is global, and security is as important an issue outside of North America and Europe as it is inside. In fact, in some areas, even more so. So our goal is to continue to expand globally. We have a very strong presence, but we continue to see tremendous demand. So what you will see from Brett and from the whole organization is continued commitment to those global regions where we have users who are, you look at a country like India, for example, onboarding onto the internet, getting more connectivity. The 5G revolution is very important in all of this. And what we know from history is the more connectivity we have down into our phones, or into our homes, the more internet we consume. There's just a strong ratio that we've seen over 25 years. So we are looking for an explosion, which we're already seeing, but we'll continue to see in the consumption of internet all over the world.
And I want to talk to you for a moment about the stock. And I know that as the CEO, you can't be fixated on the stock price. I mean, it is up 250%. Or roughly that over the past year. But some analysts are mixed on the company. They actually point out that you've underperformed actually some of your peers. And at least an Oppenheimer analyst who is bullish on the stock, we should say, who says it is a buy, says that this stock is relatively inexpensive versus its peers. Do you think that there's something that investors are just missing with the Fastly story that you'd like to communicate to them?
I mean, as you know, I don't control the stock price. What I do control is how much our customers use and love us and the happiness of our employees. And I think on both fronts, we are extremely strong. We came out last quarter with 40% growth. If you look at last year, it was 45% growth. If you think about the growth in the greater market, those numbers are incredible. I would point to 99% revenue retention rate. Our dollar-based net expansion in the 140%, plus. So what we see is an engine where customers love what we do. We have the most innovative customers in the world, and they continue to use more and more of our product. We long-term think that's a recipe for success.
All right, we're going to leave it on that upbeat note. Joshua Bixby, CEO of Fastly, good to see you.
Likewise, thank you.
Up next, the CEO of a brand new e-commerce platform that promises to get you your items without all those pesky cardboard boxes. Welcome back. Nate Faust is no stranger to e-commerce. The co-founder of Jet.com and former senior VP at Walmart is looking to disrupt the e-commerce industry with his latest startup, Olive, which consolidates your purchases into a single weekly delivery in a reusable package. Nate's here with us now. Thanks so much for joining us, and congratulations on the launch of Olive, which when I said it was brand new, I wasn't kidding. You launched 2 days ago. That's not a lot of data to work off of, but how are things at the get-go?
Yeah, the response has been great. Obviously still early days, but both from consumers and I would say what's even been more unexpected over the last few days, we had over 100 retail partners signed up for launch, and we've had significant amount of outreach just in the last 48 hours.
So talk to me about why you felt it necessary to launch Olive. Why do we need a more sustainable e-commerce experience?
Yeah, it's funny. As you mentioned, I've been in e-commerce for over a decade now, and I left Walmart about a year ago and was thinking about what I wanted to do next, and wanted to do something with sustainability impact, and hadn't even considered e-commerce until one night, taking out the trash, just realized how big of a problem this has become from both an environmental perspective and a consumer pain point perspective. And I think that's what really makes it time and ripe for an opportunity to change, is that it really has gotten to the point where from just a raw convenience perspective, it's become almost inconvenient.
So then how do you sell the platform to people who don't necessarily think twice about the environmental impact they're having every time they have an item shipped to their house in a cardboard box?
Yeah, absolutely. So the mission of Olive is undeniably on creating a greener supply chain for e-commerce, but our value proposition to consumers is all about convenience, because we feel the greatest long-term impact will come from a service that customers love to use, regardless of whether they're focused on the environment. And so with Olive, when you sign up, there's absolutely no fee to consumers. You can shop over 100 of your favorite fashion sites, and everything you order comes delivered in these reusable two-way shippers. And the most convenient aspect is our return process, where there's no labels to print. You just drop any unwanted items back into the two-way shipper, a few clicks in the Olive app, and we pick it up off your doorstep.
So I want to talk a little bit about that process, because I know it comes to your doorstep in this reusable tote that says Olive on it. And I guess you then can keep that recyclable bag if you're not returning items. If you are returning items, you put them back into that tote. But let's talk about your consolidation facility. Oh, there we go. We're showing some video of how it works right now. So the products are sent to an Olive facility, but aren't they getting to your facility with the same boxes and packaging that you're trying to do away with?
Absolutely, they are. At the moment, they absolutely are, and we're very transparent about that with consumers. There's actually a dual sustainability impact that we're aiming to have. The first and most noticeable to consumers in the long term will be the elimination of the packaging, but the more significant benefit from an environmental perspective is actually the fact that we send you, depending on where you live, we only deliver to each zip code 1 or 2 times per week. And so you get multiple deliveries together in one of these two-way shippers, such that the number of truck stops, the number of last mile stops, which is where the majority of post-purchase e-commerce carbon emissions come from, are reduced. And just one quick thing to note, we actually do still have customers send us back the shipper, even if there's not returns. And the way we do that in the most sustainable way possible is, for the majority of our footprint, your local mailman or mail carrier will pick it straight up off your doorstep when they're delivering the mail.
I was wondering, as I was saying, if you use the service enough, you're going to be stuck with a lot of those reusable Olive totes. So that was a good point to make. But in terms of delivery, I mean, there is this war going on between Amazon and other e-commerce platforms to try to get you your stuff as quickly as possible. That doesn't seem to necessarily be a priority, though, at Olive, is it?
It's not. In the longer term, delivery frequency will become faster and faster as consumers order more through the Olive platform. But we always have the benefit to reduce the number of trips. And I used to be part of those delivery wars, starting out at a startup called diapers.com, where we were one of the first companies to do same-day delivery in New York. I worked at Amazon for a while, was part of part of Walmart as we drove 2-day delivery, next day delivery, and now most recently Walmart Plus has launched, which are all incredible services, but there's other elements to the delivery experience that haven't even been offered to consumers. And in the research and studies that we've done, these are huge opportunities to deliver different customer experiences and ones that customers want, even though they might not know they want them because they haven't existed previously.
So I know you're starting out with, you say you have like 100 retailers that you're working with, and this is mostly like fashion and apparel. But do you see yourself expanding to other kinds of products? And I'm thinking, food, maybe perishables, where, delivery and the speed of delivery then becomes more of an issue.
Sure. So the long-term goal is to be able to deliver and service absolutely everything that you buy online. Apparel is a great place to start because it's the largest online shopping category, and it's also the one in which consumers shop at the most number of different outlets, enabling the greatest benefit of this consolidation. In the future, as we do add other categories, the more a consumer buys through Olive partners, the greater that consolidation benefit can become, even with more frequent delivery. So in the long term, a very frequent shopper would still get effectively the same delivery speed that they would otherwise.
All right, Nate Faust, founder of Olive, just launched here a couple of days ago. Best of luck with the company, and we'll be watching.
Excellent. Thank you so much, Alexis.
Thank you. Coming up, Uber loses a major employment rights case in the UK. We've got the details after this. The UK's Supreme Court has upheld a ruling that Uber's drivers should be classified as workers rather than independent contractors. Yahoo Finance's Emily McCormick is here now with what that means for Uber, its workers, and its shareholders. Emily?
Alexis, we are seeing the shares of Uber under some pressure here after this unanimous decision by the UK Supreme Court. And what the court said was that Uber essentially behaves like an employer to its drivers because it sets rates, assigns rides, and disciplines drivers who don't follow its policies. And because of that, the drivers who filed the complaint in the UK would be reclassified as workers, not as self-employed, and receive rights like minimum wage, holiday pay, and breaks. Now, in this initial form, it's likely that only the 25 drivers who brought the case against Uber originally would be subject to these classification changes, though it does set a precedent for other Uber drivers who might also seek the same worker entitlements. Now, Uber has suggested in response to the ruling that it would not at this point unilaterally offer these benefits to all of its UK drivers to get ahead of those potential legal battles. But this is something to note that if it does gain traction with other drivers in the UK or even in other countries, it is something that would likely increase costs for Uber. So a win here for some labor activists who had been promoting the case that these drivers had been making for these additional benefits. But it is something that, again, is another blow to Uber's ride-hailing business already hit by the pandemic, Alexis.
But, Emily, I have to think that this ruling also has wider implications for the larger gig economy within Britain, which I believe tops 5 million employees at least.
That's right, Alexis. And the scope of this and the precedent that it sets would actually be beyond that of even Uber. We have to remember that the country also has ride-hailing platforms like Ola and Bolt, as well as food delivery companies like Deliveroo, which operate under a similar gig employee or gig worker model. And should gig workers at these companies or at other platforms also bring cases against the companies, again, it's likely that these would be viewed, at least in the UK, in light of the precedent of today's ruling issued over Uber. So this is something that could ultimately increase costs for these companies, that these companies could then pass on with price increases to their customers. So all of these things are areas that we should be watching for these gig companies, Alexis.
For sure. Emily McCormick, thanks so much. Coming up on Yahoo Finance Live, former HUD Secretary Henry Cisneros on President Biden's infrastructure plan.
Data from a new study shows Pfizer's vaccine is highly effective after just one dose and can be stored in normal freezers. Epidemiologist Suzanne Judd weighs in on what this means for the country's vaccination efforts. GameStop under pressure today, falling below $40 a share, one day after lawmakers pressed major players in the short squeeze trading frenzy. We'll hear from the House Financial Services Committee's top Republican, Congressman Patrick McHenry. And the Biden administration is seeking input on an infrastructure plan this week as the U.S. faces a number of challenges. Former HUD Secretary Henry Cisneros joins us on what needs to be included in Biden's infrastructure plan. It's the final hour of trading as we wrap up the trading week. Welcome back to Yahoo Finance Live. I'm Shauna Smith.
And I'm Adam Shapiro. As we look at the markets, the S&P 500 is off about 2 points, but the Dow and the Nasdaq are positive right now. You got the Nasdaq up 25 points, and the Dow is up roughly 30 points. Some of the sectors which are doing well right now, once again, energy up about 1.6%. Financials are up over 1%. Also, industrials and materials, they're up well over 1.5%. But when you're looking at specific stocks, let's talk about two which are getting some headlines. First, there is Expedia. Expedia is up today and doing pretty well when you consider Expedia is up about 2% right now. It's been up all trading session, and part of that has to do with people looking in the rearview mirror. Last year was terrible. We learned from their recent earnings report that in the fourth quarter of 2020, their gross bookings were down 67%. But their revenue this year, it was $5.2 billion last year. It's expected this year, analysts say, to be around $8 billion. That's because they have wide exposure. You think Expedia, you're also talking about Hotels.com, Orbitz, Travelocity, Hotwire, Cheap Tickets, and then, of course, Vrbo, the vacation rentals. So they also have, by the way, vacationrentals.com. So there's a bet that Expedia is going to not only pick up because of the pent-up demand to get out of the house and travel, but eventually all this snow covering the country is going to melt and people need to go somewhere. Then there's Redfin, which is on fire right now. Redfin is up over 10%, almost 11%, been trading higher all day. And part of this is that they're making a push into the home rental market. They're going to acquire RentPath for about $608 million in cash. That's on top of the fact, don't need to tell you, this is a hot housing market. The national median home sale price rose 14% year over year to $330,500 in January. That's a report, by the way, from Redfin, but we also saw existing home sales go up. So Redfin doing very well, and they're expecting that year over year, pending sales up 37%, new listings, however, down 6%. So there's demand, but not supply. Shauna?
Adam, I'm taking a look at Deere. It's a huge mover today, the biggest gainer in the S&P. Shares up just around 11%. They beat earnings expectations. You can see shares popping as a result. Earnings per share coming in at $3.85. Equipment sales, total revenue coming in at $8.1 billion. Now, Deere has had quite a streak. This is the sixth quarter in a row that the company has beat earnings expectations. The results, of course, are getting some praise from the street. Baird, one of those names, they were out with a note this morning saying that Deere's pricing is, quote, outstanding. They have a buy rating on the stock and $353 price target, so about $20 higher than where it's trading today. Flipping over to another big winner in today's market, and that is Bitcoin, hitting a new record, market value topping $1 trillion for the first time. Bitcoin has recorded a massive move since the start of the year, and really just over the last month. Over the past few weeks, though, Adam, Tesla has made a $1.5 billion bet on Bitcoin. MicroStrategy also upping a sale of convertible bonds to $900 million to buy more of Bitcoin. As a result, we've seen more and more investors pile into Bitcoin. Bitcoin trading right now just below 55,000. All right, well, we've got less than an hour to go in the trading day, and stocks, more broadly speaking, aren't trading too far from the flat line, giving back most of the gains that we saw earlier today. We want to get to Jared Blickery for a closer look at some of the movers into the closing bell. Jared?
That's right. We are off the lows in some of the big tech stocks, but a lot of green in the small caps. And let's take a look at the Wi-Fi Interactive. Russell 2000 up another 2%. That's breaking a 3-day slide, and nice to see for the month. The Russell looks like it's up about 9%. That should be good enough for the best ever. Now, looking inside the Nasdaq 100, mega caps have been under pressure. You can see Microsoft and Amazon in the lower right, each off more than 1%. Facebook, notably, down about 3%. Also taking a look at the Dow, though. Now, Shauna, you were talking about Deere. Deere not in the Dow, but it is giving a bid to some of the industrials. We see Caterpillar up in the upper left, 5%. Dow, that Dow Inc., that's up over 4%, Boeing up over 3%. And so industrials and materials really catching a bid here as the US dollar declines, also off those dear earnings. And then looking at the travel sector, Adam was mentioning Expedia. We can see lots of green all around here. Stimulus talks in the works. American Airline up over 4%, United up over 7%. But you can see it's been a rocky kind of sideways 3 months for some of these names. Also a lot of money flowing back into cannabis, and also a lot of money flowing back into Bitcoin. So I'm going to keep this relatively brief here, but Bitcoin, $1 trillion, hitting 55,000. Just another incredible milestone. And then got to draw your attention to Binance. That's up 69% today, kind of an Ether alternative. Just over the trailing month, that is up 663%, guys.
All right, thanks, Jared. One of the losers in today's market that we mentioned earlier, GameStop, that stock under pressure. But really more broadly speaking, short selling is in focus after lawmakers pressed the CEOs of Robinhood, of Citadel, of Melvin Capital, just to name a few yesterday. For more on this, we want to bring in Joe Saluzzi. He's of Themis Trading. He's a co-founder there and co-head of equity trading. He joins us now on the phone. And Joe, there's a lot to get into yesterday's hearing. I think the big takeaways, at least for us, we were talking before the show, was short selling and then payment for order flow. So let's start on the short selling real quick. I guess the big debate is whether or not there needs to be more transparency around it right now. What do you think?
Well, thanks, Sean, for having me. I think, short selling it's not an evil thing. It's actually a healthy thing for the market when you think about it. Some short sellers will expose poorly managed companies. They will, be an activist style investment where they're coming in at a different angle. And it's extremely risky to be a short seller because your losses are infinite when you think about it, right? Because as the stock goes up, you're losing money. But transparency, it's a difficult thing because, as Melvin Capital realized, once people realize that you're short, once they see you're short, they could put a run on it. And then that's where you will get squeezed out. So I think it's difficult. If you had a 5-10% holder like you do on the long side, on the short side, maybe there is some valid reasons to identify that as a long-term short holder, but shorts tend to come and go pretty quickly. So I don't know, to be honest with you, what's the right answer on transparency. All I can say is that, it's not a bad thing, short selling. What's bad is when you don't have a borrow, and it's called what they call naked short selling. That's illegal, first of all. And if that's going on, that's where the regulators need to get involved.
Joe, we're going to continue with short selling, but got to bring in pay for order flow. And this seems to be getting a bad rap. For instance, like Citadel Securities, they make their money on the spread between the bid and ask, but you need to have huge volume in closing deals for retail investors to do that. Is this something that we should be looking at?
Yes, I was thrilled actually when I did hear a little bit more about that in the hearing yesterday. We've been studying market structure for years now, and it's really kind of market structure plumbing is difficult. When you press the button to buy a stock and you come back and you get your report, there's a lot that goes on from the time you hit that button to the time you actually get that execution, even though it seems like it's instantaneous. But it goes through this maze of routing and different spots where it might go into a dark pool, it might go into a market maker, it might go to an exchange. But part of the inner workings of the market is where a retail broker will sell that order flow to a market maker like Citadel, and in return, Citadel will give some sort of price improvement, right? Or market makers will give price improvement. Well, in our opinion, what happens is all of the flow, if it was a small amount of flow, it really wouldn't matter. But now you're dominating. It's almost 50. Right now, the retail market is about 35% of the volume that we're seeing out there. All of this flow is being traded off of the exchanges. And what we think is happening is, and the reason why it's off exchanges is because of the payment for order flow, it's hurting the price discovery process. In other words, the orders are not making it to an exchange where they can interact with other retail orders or other institutional orders, mutual funds, pension funds, and so on. And it's being intercepted by the market makers. And the market makers do that, and they pay for that because they want to see as much as they can. And that's the way their business works. The more they see, and in this business, it's always been about information. The more information they get, the more they can predict which way the markets are going, the more they can, model their own book. So we think in the bottom line is payment for order flow, we've always been against it. And not only from the market maker side, but also the exchanges do it as well. But it's something that distorts routing, and we don't think it's necessary.
Joe, this is Jared Blickery, and it's really great to talk to you because I've been following you on Twitter since the flash crash over 10 years ago, and I know you're an expert on market microstructure. I want to get your take on Citadel CEO Ken Griffin's kind of putting this idea out there, and it's been out there for some time, of getting sub-penny fills back. And I know it gets really wonky here, but I see it as basically taking an issue that you have with these dark pools and these market maker matching algorithms and just kind of bringing them back on the exchange. I'm just wondering, is it possible or even likely that that just reduces future transparency and also liquidity?
Well, thank you for that. By the way, we've been around for a while. I'm feeling pretty old now, but this is, it's a topic that doesn't go away, right? And you're right. It's a difficult one when it comes to transparency. When you're trading off exchange, and we trade off exchange as well as institutional investors. I trade on behalf of institutional investors, right? So my clients are hedge funds, mutual funds, pension funds, and so on. And oftentimes during the day, I'm trading on dark pools. I'm trading through, various ones that are institutional sized, and that's where we're putting up blocks and we're getting more liquidity. Now, is that transparent? No, that's not. And someone can make an argument that dark pools are not transparent either. But what we're trying to do is minimize our transaction cost. And if I can do that and match up with another institutional investor, well, that's a good trade in our opinion, without the intermediary getting in between. What happens on the retail side of the market is the market maker is an intermediary, and he touches every order, and they see every order. And here's one thing that a lot of people don't talk about. Suppose a stock, and I'll give a quick example, is say it's a stock is $12 bid and it's offered at $12.10, and you want to buy it. So if you buy it now, you'll most likely get a price of $12.099, and the market maker will give you some sort of price improvement. But what happened to the guy who was offered at $12.10, the person who set the price? The person who displayed the liquidity gets shut out, when in fact they were the price setter. So you're discouraging displayed liquidity, which is not a healthy thing for markets, which is why we think the whole transparency of bringing that retail flow back into the markets, into the lit markets, is a good thing. When it comes to sub pennies, the one exception I would take what Mr. Griffin said yesterday is stock exchanges can trade in sub pennies. They cannot quote in sub pennies. And that's a big difference between a trade and a quote. And he was making a big, point about, hey, we get this flow because we can trade in sub pennies. So can stock exchanges. I do it all the time on all the different stock exchanges. I trade in sub pennies through various methods, like I was saying before, in the hidden venues, in the dark pools, and so on. So I take exception there. But I do think, like I said, transparency, yeah, that's an issue. And the more that gets out there, the better.
Joe Saluzzi, great to speak with you of Themis Trading. We look forward to having you back again soon. Have a great weekend. Coming up next here on Yahoo Finance Live, a new study out shows that Pfizer's vaccine is highly effective after just one dose, and it can also be stored in normal freezers. We're going to talk to epidemiologist Suzanne Judd right after the break.
right, we are about 44 minutes to the closing bell with a mixed picture on Wall Street. The Dow is still positive as the Nasdaq S&P is negative. Let's get right to our COVID-19 update because Anjali Kamlani has news about the president and the Pfizer vaccines and future Pfizer studies. Anjali?
Thanks, Adam. I've got a lot of COVID news for today. Let's start off actually first with the World Health Organization announcing that the U.S. has been part of the G7 countries contributing about $4 billion to a global vaccination efforts. And that's a really big step. We know that there had been some concern over the U.S. not previously being engaged, but there is still a funding gap of about $22 billion right now, but really good news there. Meanwhile, moving on to the White House and the COVID response team, we know that as it stands right now, there's about 6 million doses in backlog, about 3 days worth of shipments that, because of the winter storm and winter weather, has been unable to get sent out. So the teams are working with FedEx, UPS, and McKesson to make sure that that backlog is worked through, as well as the shipments for next week, possibly doing some weekend deliveries and extending vaccination hours at sites is what the administration is asking for. Meanwhile, Pfizer out with an announcement that it has submitted to the FDA data to show that the vaccine is stable at less colder temperatures. So we know it was ultra cold temperatures it needed, but that is something right now that they are able to work around. And so that's going to be really interesting. They also submitted data that or rather not they, but a study from Israel in a medical journal showed that the Pfizer vaccine could be effective at a single dose. Now, this has been a debate for quite some time, but health experts like Dr. Anthony Fauci are really against that at this time. Take a listen to what he had to say earlier today.
It's a variant issue to protect against variant. The other issue that we need to take into consideration is if you do have a less than optimal, even though with numbers they look reasonably good, but not as good as the optimal response, what could happen theoretically is that because of the immunological pressure that you see on the virus, you might actually theoretically be inducing more variants.
So basically the idea that right now tests have showed that 2 doses give you durable, long-standing protection, and that it will help against the threat of the variants. That's something that's really important to keep on right now. But right now, President Joe Biden is actually in the Pfizer facility in Kalamazoo, Michigan. He's touring the plant where these COVID vaccines are being made. And we also learned from the Wall Street Journal that the company is adding an additional plant to help increase the supply of the vaccine. So a lot of news coming out about vaccines today. Back to you guys.
And there's a lot of news about coronavirus. Thank you very much, Anjali. We're going to do that news in this discussion now when we bring back into the stream Dr. Suzanne Judd, epidemiologist at the University of Alabama at Birmingham School of Public Health. Good to see you again. Before we jump into everything, this is going to be a discussion this weekend. It's a Drudge Report headline. It's a Wall Street Journal opinion piece. I just want to stress it's an opinion piece, but that the dramatic drop-off we are seeing in COVID infections nationally is indicating, according to the opinion piece from a Johns Hopkins researcher, that we might be reaching herd immunity. Any thoughts on that?
That is the big discussion in public health right now. It certainly is possible. There was an article published about 3 weeks ago from Columbia University indicating that as many as 10 people have had COVID that never got tested, which means we have 10 times as many people in this country that are immune. You add that to the vaccinations that have been rolling out, and it's possible we could be approaching herd immunity. We should know within the next 2 or 3 months if this trend holds, but this is definitely the most positive news we've seen in a long time.
So with that in mind, and then also coupled with the news out today, we got the data out from a peer-reviewed study that shows that Pfizer's vaccine is highly effective after just 1 dose. It could be stored in normal freezers, but more, I guess, focusing on that 1 dose part of it, how big of a game changer then could that potentially be when we talk about getting the pandemic under control?
That's huge. And it's huge for 2 reasons. It's not huge because people won't need 2 doses. As you heard Dr. Fauci say, we're still going to need 2 doses. But it's huge because that means as soon as someone has their first dose, within about 2 weeks, they reduce their risk of getting COVID and spreading it to other people. The Israeli study showed as much as an 85% drop-off in cases after they fully vaccinated their workforce. And that's just incredibly important in terms of slowing down the spread of this virus. It means that we'll see a response much sooner than we had predicted.
I'm asking a PhD this question, forgive my ignorance, but if things like the Spanish flu, I guess they died out because they didn't have flu inoculations back then. Is there a chance this could just die out and that the vaccines we've developed would not be needed going forward?
Well, we still actually vaccinate for the flu, so that it doesn't really die out.
That variant,
it's similar. It's similar.
Okay.
Some of the flus we have are actually similar to what the Spanish flu looks like. It dies out in terms of spread, but the actual virus remains. So we have to continue to vaccinate probably with COVID. Most researchers do think this will require an annual, at least, if not twice a year booster to make sure that we keep immunity levels high enough that we stop outbreaks. It'll always be there. People are going to get COVID probably now well into the future. But hopefully we can keep the consequences of COVID under control with regular vaccination.
We talk about getting coronavirus under control, the risk of variants. We've been talking about that so often over the last few weeks here. What needs to happen in order to get through this next phase, without a huge spike?
Well, we need to get really consistent vaccine administration to lots of different populations. We can't leave people behind. We have to make sure the vaccine's getting into all communities to get that base level of immunity to stop the virus from spreading. We also have to watch the variants. We have to see, are they consequential variants or just variants that are normal, but the vaccine will still work? Those are going to be the big things we're watching in the next few months. But quite honestly, this is what public health does. It's what we do with influenza, and now it looks like it's what we'll be doing with coronavirus going forward too.
It is always a pleasure to be schooled by a PhD, and Suzanne Judd is the doctor who is a PhD of epidemiology at University of Alabama at Birmingham School of Public Health. Thank you so much for being here once again. We look forward to you returning. When we come back, the Momofuku empire is expanding. How David Chang's famed restaurant chain is bringing the tasty cuisine to your house. Right after this.
The Momofuku Group is expanding beyond its well-known restaurants, which I'm sure a lot of our viewers have either been to or heard of before, and launching its first direct-to-consumer product line. For more on this, we want to bring in Marguerite Mariscal. She's the CEO of Momofuku. And Marguerite, it's great to have you on the program here. We know it's been an extremely tough past 10 or 12 months for the restaurant industry. Just talk to us just about what you've done in order to navigate this very difficult time, and then the launch of your direct-to-consumer product line.
Sure. It's definitely been, a year like any other. And, we're still, I think, in the thick of it with 25, 35% capacities in the cities that we operate. In some cities that we operate where it's outdoor dining exclusively. So we're still very much in it. But over the past year, and particularly in the fourth quarter of 2020, we were able to really expand outside of the four walls of our restaurants, which is something that I think has always been part of our game plan, but really got expedited with the pandemic. So that has meant everything from national shipping of some of our products, classes that we're offering with our chefs. And then the biggest push has been on consumer packaged good products that we're selling direct to consumers starting September of 2020.
So help someone like me who loves to cook, but doesn't necessarily know how to do the right things. I mean, I just learned you could wash rice and keep it from getting sticky. If I were to get your product, would I be a disaster? And I'm not a bad cook, but is it easy to use?
1000%. So I think one thing that's kind of been our North Star is that we only want to create products that we would use in our restaurants. And we use that really more as a standard test. We don't want to put Dave's face on a can of soup or, a jar of tomato sauce that's not representative of the food you'd come in if you ate at one of our restaurants. So what we're really doing is replicating the flavors, but putting them into vehicles that are easy for home cooks. So we have seasoning salts that are basically you can use in the place of salt and pepper. Chili Crunch can basically go on anything. And we're using our social platforms to also educate consumers on how they can use these products. One fact that has been kind of invaluable, I think, for us as a company is that 90% of our followers on social media, between Dave and the company being over 2 million, don't live in cities in which we currently operate restaurants. So we've been able to tap into a customer that I don't know if we quite knew existed or were ever able to really provide, or add value. So, that's really where we've been seeing the success in all these products, is really expanding the reach of outside of our four walls.
So Marguerite, post-COVID, how big of a part of your business do you think the DTC portion is going to be? And what are your plans to scale that part?
I think for honestly every restaurant group, all of these things that everyone's doing to survive are going to become their bread and butter. Just their everyone's model, I would say, in the hospitality industry has been squeezed over the years, and that rents have continued to go up, cost of food has continued to go up. But I would say consumers' appetite to pay more for food has not necessarily gone up at the same rate. So everyone's been looking, I would say, for the past 3 to 4 years in ways to increase margin, increase sales. And I really see these products, classes, all of this as being the way that the hospitality industry continues to evolve and stay relevant. I think trends are going to change. I'm going to guess you're a better cook now than you were a year ago due to COVID and having to be at home. So I think that's true for the majority of the population. So we need to adapt as a business to how people are going to continue to eat in 2021 and beyond.
I'm going to brag that I make a mean short rib stew, but I got to ask you, post-pandemic, your business model is the direct-to-consumer. What percentage of the business? Because a lot of us are just desperate to go back to restaurants.
Well, I would say Dave and I set a goal pre-pandemic of having 50% of our business not come from our brick and mortar restaurants. And we really want to do that to kind of safeguard the business. And I think that's true now more than ever. So I think we'll get there, not in the immediate, but I think in not too far distant future. But I think we always see restaurants as being fundamental in that they help develop these flavors. They help show consumers how to use these flavors. But I think our business moving forward is going to be, we hopefully a pretty good mix between all of these different avenues that we've kind of explored during this time. And restaurants coming back is only really going to strengthen the company and add that dynamic, which we've been missing for the past year.
Marguerite Mariscal, great to have you, CEO of Momofuku. We wish you all the best. Coming up next here on Yahoo Finance Live, the CEO of Qualtrics on how they can improve the nation's struggling vaccine distribution system. We're back with that in just 2 minutes.
News on the move. Texas Senator Ted Cruz returned home to bitter criticism as he fled the deadly freeze that's killed 30 people and knocked out water and power to millions in Texas. Cruz initially blamed his daughters for wanting to go to Cancun to escape the cold, but finally admitted he made, quote, a mistake. And in hindsight, he said, these are his words, I wouldn't have done it. The cold weather in Texas is beginning to warm up, with the National Weather Service predicting temperatures near 60 degrees this weekend. Power has been restored to most of the state, but water systems remain crippled, with boil orders covering 13 million Texans. The race is on to ship food into Texas to replenish grocery store stockpiles, which are severely depleted. NASA's Perseverance rover sent back its first pictures from the surface of Mars late yesterday and today after successfully landing on the red planet. NASA says the rover will explore a dried ancient lake bed, searching for signs life once existed on Mars. The 2-year mission is also intended to assist future human exploration of Mars. Turning our attention back to getting a vaccine into everybody here in the United States, we want to invite into the stream Zig Serafin. He is the CEO of Qualtrics, as well as Julia LaRoche. And we should point out, Qualtrics is a company that has vast experience in what's called experience management. Some people may misunderstand that to be public relations. You got a market cap of $22.7 billion, and your company does so much more because you use data and artificial intelligence to help brand identity. How does that work with the vaccine?
Well, thanks for having us on again. We appreciate it very much. Well, look, we're a experience management company, and we build technology to be able to understand what it takes to be able to engage people and to be able to create experiences for all members of the community, all members of customers that work with businesses. But when it comes to vaccines, we know that vaccinations are key to getting us all back to work and to get the economy going, getting schools open, getting stores open, getting travel running. You know, Dr. Fauci says that we need to have about 75 to 85% of people all to get vaccinated to get herd immunity. But vaccines are just the start. Vaccinations are the real goal. And so being able to empathize and understand the experience of residents really matters now. And we have to be able to treat the vaccine rollout differently to different communities, to different stakeholders, much in the same way that doctors treat their own patients. And so everyone we've talked to sees this as a top priority now to be able to save lives and to be able to get the economy back open again.
Zig, it's Julia LaRoche. And when you talk about experience management, we often talk about the experience economy and the experience gaps. And it sounds like you've obviously identified one here. You know, I like to bring up Clay Christensen's jobs to be done framework and how you look at those gaps and build products, software to fill them. So can we explore this a bit more? It sounds to me like it's a messaging issue. And how do you fill those gaps?
Well, Julia, so first off, if you think about it, the way that people perceive what the vaccine can do is quite different depending upon who you are. You know, our research shows that about 61% of people have confidence in the process that's being used to be able to distribute vaccines. And that varies based upon the state, the local county, and how people feel about that local government's ability to be able to effectively deliver the vaccine. You know, we've heard that about 35% of people are saying that they do not plan to vaccinate. And our research also shows that about 47% who have less than a high school degree plan to vaccinate, and then goes up to about 84% if you have a graduate degree. And people have concerns. I mean, there are concerns with people wondering about whether there's going to be short-term, long-term side effects, if there's safety issues that they should be aware of due to underlying health conditions. You know, there's misinformation that's out there. There's also, you know, people that, you know, then these facts will actually end up varying also depending upon who you are. So, for example, you know, if you're a Black American, they're saying that they would consider taking the vaccine. Only about 42% would end up taking the vaccine compared to about 63% of Hispanics would take it and about 61% of white adults. So it varies significantly. And there's an equality issue that's in this. Only 5% of people that have been vaccinated so far have been Black, even though they represent about 13% of the population. This is recent news source that's been out there. And so, you know, our studies have shown that people perceive vaccine messages quite differently based on their background, their education level, their political party, their race, their socioeconomic class, et cetera. And so by figuring out how people perceive different types of vaccine messaging, understanding their needs, being able to empathize with people, we're able to get people in a position where you take a much more resident-centric approach. And so we're working with state and local governments all across the nation today to be able to put people first.
Well, Zig, what do we do, though, to address the portion of the population that doesn't have access to technology? Because I think that's also a huge headwind and a huge challenge that we're dealing with. So how do we reach that portion of the population?
Well, first off, about 96%, most people have cell phones. And so, we've created a front-end experience working with state and local governments to be able to create it in digital experiences, user-friendly, uses SMS, email, mobile applications. It's scalable, so you can reach everyone, especially underserved communities. And it's also flexible based upon how things are moving quickly and even how people need to be served. And so you have things that will, system that actually can vary based upon the population and how that population is responding. It's inclusive by design. So, you have the ability to be able to understand how you might serve at-risk communities differently. Those that might have more limited access to technology. How do you serve multilingual populations differently? How do you become more personal in the way that you end up connecting with people? And then frankly, just increasing awareness and being able to understand people's sentiments and be able to build trust. All the whole combination of these things is what people care about. So the technology system enables that.
And we should point out that President Biden has just said on his tour of that Pfizer plant in Michigan that they will meet the 100 million doses within 100 first days of his administration. So Zig Serafin, the CEO of Qualtrics, we appreciate your being here. Julia LaRoche, always good to see you when we come back. Former HUD Secretary Henry Cisneros will join us on what needs to be included in President Biden's big infrastructure plan right after this.
The Biden administration says that it's committed to working with states to improve the country's infrastructure. So here to talk about what some of those priorities should be, we want to bring in Henry Cisneros. He's a former HUD secretary under President Clinton. And Mr. Cisneros, thank you so much for joining us this afternoon. I understand you're helping the Biden administration identify infrastructure targets. Let's just start, though, with the dire situation in your home state of Texas right now. What does that tell us about how we should be reinvesting in our infrastructure?
Well, what I think Texas has experienced this week affirms the need to really think about our infrastructure, its adequacy for the future, whether we plan for all eventualities. This situation in Texas has gone beyond what you might call comfortable, uncomfortable, or inconvenient. It's now life and death matters. When people are without power for a considerable length of time, when they're without water, it gets very serious very quickly. We take infrastructure for granted. This is a case example of how infrastructure is essential to the functioning of our cities and to their progress. Just this week in Texas, we saw first glitches in the power generation system, frozen lines at gas plants and at wind turbines, leading then to the need to allocate power around the state. Some of that resulted in cutting off electricity to water pump stations, which then could not pump water, or if they did, at low pressure, which allowed contamination of the lines. And we found then that people could not get water. The implications for people were lack of heat, lack of refrigeration for food, lack of refrigeration for medicines, medical problems. I just heard this morning of a case where a kidney dialysis center had to close its doors, was unavailable for treatment for people who need it 3 times a week, and they're going on 5 days since they've had treatments. Their special centers have had to be set up to take critical cases. So infrastructure really, really matters.
Secretary Cisneros, we all agree with this. And I'm sorry to date us, but I've been covering infrastructure. In the 90s, it was bridges falling in the nation's highways. At the beginning of this century, it was water systems. Then it moved on to the grid. What's going to change this time? Because we've never really funded to the degree that politicians have said we needed to. So why now will we get the funding that's necessary?
I think there's a number of things. First of all, the Biden administration has made a priority, and it's pretty clear they're going to push for a bipartisan infrastructure initiative, and that makes a huge difference. Secondly, we're at a point of inflection with respect to infrastructure in which it is no longer good enough to just do more of the same. Technology has made it possible to apply technology to infrastructure so that you see new ways of handling road congestion, the conversion to renewable energy, things like broadband and communications that are needed in telemedicine, in providing education during the pandemic. So the technology has changed things. And then I'd say, thirdly, it's become very clear that this is an issue of national competitiveness, of national productivity. We're behind other parts of the world in terms of the quality of our infrastructure. And other nations with whom we are competing in trade, for example, the Chinese, have converted infrastructure into a weapon of world trade competition. They are not only building modern cities in China with 200-mile-an-hour high-speed rail, but they're also using infrastructure and building in places where they want to build trading relationships in Africa, in Latin America, in other parts of Asia. So it's very clear this is a national priority that involves jobs, it involves preparing for climate change, it involves economic mobility that we saw this summer. It's so critical in our country. There's a lot of problems that infrastructure contributes to. It's not the silver bullet, but I think most Americans intuitively know it's critically important, and we've got to step up.
And Secretary, in wrapping this up, then, how about the importance of the projects being chosen and executed by local leaders rather than it being directed by the federal government? Why is that so critical in achieving success in this?
Well, I think it's important to understand what projects are priorities for the people who know their communities best and know what their communities need. Local officials all over America are setting priorities for what they want their cities to be, and they know what infrastructure they need. So the old style decision making, what goes top down, where we start with federal cabinet departments or even the congressional committees, and water projects come out of EPA, and river and ports projects come out of the Corps of Engineers, and rail projects come out of the Railway Administration, et cetera, is different from creating a system where it's possible to at least consult, at least understand what the priorities are out across the country. We're very fortunate that this administration is staffed with an unusual number of people who have local experience, like Pete Buttigieg, former mayor of South Bend, now at Transportation. Marcia Fudge, Secretary of HUD, was the mayor of Warrensville, Ohio. Marty Walsh, the Secretary of Labor, was the mayor of Boston. We have governors, Gina Raimondo of Rhode Island, Governor Granholm of Michigan, and Vilsack of Iowa, in the administration at agriculture, at energy, and commerce. A former school superintendent is the Secretary of Education, and a former environmental official in North Carolina is the Secretary of the EPA. So that is the kind of bottom-up thinking that can reach in a special way out to the nation through the Congress, through the U.S. Conference of Mayors, through the National League of Cities, advocacy groups. Let's find out what we really need, and let's this time not build bridges to nowhere.
Secretary Henry Cisneros, great to speak with you. Thank you so much for taking the time to join us. We look forward to having you back once again soon. Coming up next here on Yahoo Finance, Facebook's decision to block news in Australia, what this means for the rest of the world. We're back with that in just a couple of minutes.
It's as if Mark Zuckerberg showed a finger to millions of people in Australia, and I'm not talking about the thumbs up that says I like something. Dan Halley, what's going on with the decision to block news down under?
Yeah, this is all basically a long series of events that have finally come to a head between the likes of Facebook and Google and the Australian government. Now, what Australia wants to do and what it's been lobbied to do by the likes of Rupert Murdoch, who owns obviously News Corp, which includes Fox News, the Wall Street Journal, things along those lines, is for companies like Facebook and Google that dominate the digital ad space to pay their fair share to media outlets when those services use stories that media outlets produce. That could be Google showing snippets or previews of stories, or Facebook using stories in its newsfeed. Now, what Facebook has done instead of working with the government is effectively cut it off, Australia, from news on Facebook's platform. And Facebook says it's a small percentage of what people usually see, but it does make a big difference. And so the Australian Prime Minister, Scott Morrison, sent out a notice essentially saying, we will not be intimidated by big tech seeking to pressure our parliament as it votes on our important news media bargaining code. I encourage Facebook to constructively work with the Australian government, as Google recently demonstrated, in good faith. Now, what he's referring to there with Google is Google's decision to pay News Corp and other journalistic outlets some money as far as their advertising goes. A little bit of a split there rather than simply pulling out. But it's worth pointing out, Google did threaten to pull out originally, and Prime Minister Morrison had said that that's not going to really fly with us. So it's going to be an ongoing issue. They're looking at things in the European Union like this, and obviously it's been discussed in the US, but for Facebook to pull out, it's really not a good way for it to save face.
Dan Alley, thank you for the update. We're going to go to the closing bell right after this. Markets losing steam as we head to the closing bell, which reiterates why if you liked it, then you should have put a ring on it. Let's bring in the guests for us in this hour, and we want to welcome Sylvia Jablonski, Defiance ETF's co-founder and CIO, also Dan I at Fort Pitt Capital Group. Dan, let me start with you. Market's still at record highs essentially, but it looks like we're going to be flat as we go to the close.
Yeah, well, thanks for having me. We've certainly gotten off to a very strong start for 2021. So certainly not surprised to see a little bit of consolidation this week. But we've got a pretty positive view on the markets for 2021. And I think those positive expectations are well understood by the markets at this point. The consumer is very well positioned, a significant amount of pent-up demand out there, and we expect to see an improving employment picture throughout the year, as well as a significant rebound in corporate earnings. So we think this looks like another positive year for equity markets, but our expectations are certainly a bit constrained given high equity valuation levels to start the year.
All right, Dan and Sylvia, just hang on tight. We're going to go to our markets reporter, Jared Blickery, as we are just around a minute from the closing bell. Jared, what are you watching here into the close?
Well, let's take a look at the Wi-Fi Interactive. We got the Russell still holding over 2% for the week, going to end up a little bit down, but it's been choppy for most of the other indices. You can see the Dow is exactly unchanged right now. It's going to finish probably up just a few points in the green for the week. But let's take a look inside the Nasdaq 100, where we've seen a little bit of weakness. And I'm going to change this to a 5-day view. You can see Apple's off 4%, kind of broke down a little bit, a technical formation. Tesla down nearly 4%, Facebook off 3%. Looking at the sector action for the week, energy, the biggest winner by far, up 5%. The winter polar vortex, really a big driver of some of those gains. But oil's been a huge tailwind for the energy sector over the last 3 months. Financials also in the green, up 4%. Materials and industrial rounding out the outperformers. Utilities to the downside, that's the biggest laggard, not surprisingly, as we're seeing some big gains in the treasury market, especially the 10-year. I'm going to talk about that in a little bit, but here's the closing bell on Wall Street as we head into the final day and options expiration.
And that does it for today and the week. We have a mixed picture here as we close out the final few trades. Dow and S&P are up. Oh, actually, it looks like Dow is going to end barely positive, just around the flat line. S&P off just around 0.2%. Nasdaq holding on to gains. We should point out the Dow was up just around 150 points earlier today, so giving back nearly every single gain that we saw earlier. For the week, though, a bit of a different picture. S&P off just around 0.5%. Nasdaq off about 1.5%. Jared was just going through the sector action that we've seen. Energy by far the leader, up 5% for the week. And then we've seen the cyclical trade back in favor here amongst investors, where we have materials, industrials, financials among the leaders there. All three of those sectors up just around 1.5%. We want to bring back in Dan I and Sylvia Jablonski. Sylvia, let me just go to you first. Just where we're trading right now, we're not too far from those record levels. Is there any hesitation just at the current valuations that we're looking at?
I don't have a lot of hesitation right now. I'll echo some of what Dan spoke about before. I think that, the market is in pretty good shape. We have record liquidity pumped into the market and probably more to come if, the 1.9 trillion or some version of that passes. COVID vaccines are on the up and COVID infections are on the down. Earnings just absolutely have crushed it so far. 80% of the names out there have reported, and about 80% of those that reported have beat by 15% or more. I think that the reopening trade, hasn't really started yet. I think a little bit of it's priced in, but in terms of like services and small caps, airlines, casinos, hotels, things like that, I think we'll see some positive momentum. And for the names that are down this week, like the major FANG names that you just went through, I think they're buy on the dips opportunity. They're still quality names with tons of cash on the balance sheet. And I just think that, again, like the incoming liquidity and the passing of COVID should add momentum to the market, regardless of where we are in valuations.
So, Sylvia, the incoming liquidity, though, let's talk about SPACs, because the 45+ billion in just the first 2 months of the year, up and away. And yet many of these SPACs haven't even named the companies they're going to try to acquire. Sounds a little frothy to me that a lot of people are about to get burned. What do you think?
I have to disagree. I love this. I love the SPAC space, and I can definitely recognize the concern. Last year we had 250 SPACs and 83 billion of proceeds. This year we're 6 weeks in, and we've had half of that come out. But I think what's really interesting about the SPACs that are coming out is that the most reputable names, which are sort of the highest market cap, backed by the well-known founders, whether it's Shaq, Bill Ackman, who's, by the way, made 1.9 billion in proceeds from his SPACs. Chamath Palihapitiya, the social capital SPACs. they're doing quite well, and they have done some acquisitions. So Virgin Galactic is up triple digits. Churchill is up on the Lucid rumor. DraftKings did quite well when it came out. So I think that you're getting this access to a space that covers kind of like every sector, but most of the names have something to do with disruption and technology, whether it's direct metals, 3D metal printing, or electric vehicles or green energy. I just think that these are awesome IPO opportunities. Totally agree with you that there are a lot, and not all of them are going to work. But I think if you look at the highest market cap names, or even look at an ETF that'll mitigate the risk to that one single failure exposure, you get a really good potential for performance there.
Dan, how about what's going on in the bond market? Yields are up again this week. Their biggest weekly gain in just around 6 weeks when we take a look at what's happening in the 10-year yield and also the 30-year yield. Should we be worried about inflation? How are you reading that?
So we are keeping a close eye on inflation. And I think right now you're not really seeing evidence of high inflation levels in CPI or core CPI data, but you certainly are seeing it in the base metals. You're seeing it in housing prices, in lumber prices, and I think the fixed income market is starting to say, we're looking at a regime change into a higher growth environment for 2021, and we need to finance very high budget deficits from 2020 and obviously for 2021 as well. So. We wouldn't be surprised to see a continuation of the rise in interest rates, and we've also been keeping a very close eye on the weakness in the U.S. dollar that really started back in March of 2020 and certainly could continue.
When it comes to equities, though, you like to find those which might be trading cheap to the market, and one of them you pointed out is Bristol Myers. What did you find attractive about them?
Yeah, very good question, Adam. And the stock is just way too cheap in our view. It's trading at almost a 65% valuation discount to the S&P 500. This is a company that's posting strong top and bottom line growth, which is expected to continue. We think that Bristol Myers is going to generate almost 50% of their entire market cap value in free cash flow over the next 3 years. They're executing well. They're realizing synergies from their Celgene acquisition. They're deleveraging their balance sheet. And the deep discount is really driven by some concern about generic competition. But that's 4 or 5 years down the road. And we think that their pipeline is very well positioned to more than offset that loss of revenue from generic competition. So we really like the name.
Jared, to bring you back into the conversation, I know you're closely looking at the bond market here as we turn our focus to next week. And there's some warning signs, actually, that you're noticing as of right now. What's going on?
Potentially, and let's go straight to the charts. And this is the 10-year T-note yield. This is over 2 months, but over the last week, look at what we've done here, up 14 basis points. That is a big move. And this is what I tweeted earlier today. This is what I'm going to be watching into next week. First of all, I want to pull up this chart. This is the last 3 days inside the 10-year T-note yield because we have real yields here climbing on the left and break-evens going down, plunging on the right. And break-evens are what signal inflation expectations. Real yields are what are signaling growth. Real yields still negative 80 basis points. But here's my point here. 10-year real yields are surging, got break-evens dropping, and this is all on hot economic data. We got retail sales coming in way above expectations, hot producer price inflation. That's what Dan was just talking about. Market PMIs, strong building permits, import-export prices. And then you add it all up, we got a lot of volatility in the bond market. So the MOVE index, which is like the VIX of bonds, that is picking up. So my takeaway here is maybe good news is bad news, and maybe the market is pricing in a potential tapering, the Fed having to deal with inflation in the back half of the year, as I've been talking about, even though the Fed doesn't see that happening just yet, guys.
All right, Jared, we appreciate that. Dan I, Fort Pitt Capital Group, thank you for being here. Sylvia Jablonski, Defiance ETF's co-founder and CIO. It's good to have you here as well. With Jared's discussion about bonds, that helps us bring in Rick Newman for our latest episode of, I guess I'll call it Bidenomics, because it was, what was his name? Buster Poindexter. Hot. Not only bonds, but what they're going to do with stimulus and infrastructure of the economy, right?
I think so. I think a Biden boom is forming here. So Jared mentioned a couple of the factors I've been following this week. Retail sales coming in much higher than expected, 5.3% monthly gain, driven by that last stimulus bill that I guess a lot of people don't even remember. That was just a $600 check going out to families and some extra unemployment insurance. But people are taking that money and spending it, and that's not just going to be a 1 month effect. That will carry over for the next several months. And then it looks like Biden is going to get nearly everything he's asking for in the next stimulus bill, the American Rescue Plan. It does look like Congress is going to pass between 1.5 trillion and 1.9 trillion in aid there. And that is really going to supercharge the economy by, let's say, summer or fall. So I've been following a lot of forecasters. GDP estimates for the first quarter, for the second quarter, and for the year are going up. One forecasting firm is expecting 6.5% real GDP growth this year. That would be the strongest GDP growth since 1984. And that could lead to some of the problems Jared is talking about. But before it gets to the problems, it's just going to lead to a much improved economy, which will benefit Joe Biden and his fellow Democrats.
Rick, I guess how reliant, though, is this on getting the extra $1,400 in stimulus payments? Because like you were saying, it looks like we are going to get it. But if it is slightly lower than that, I guess, what's the potential impact of that?
Well, he's going to get something. I mean, we've been talking about the controversy over the size of this bill for some time. So the economists who say it's too much and we risk overheating the economy with too much stimulus say that the appropriate amount, instead of 1.5 to 1.9 trillion, the appropriate amount at this point might be between 500 billion and $1 trillion. That is still a lot of stimulus, and we're going to get more than that anyway. So I think generally this is, who do you believe? Do you believe Janet Yellen, who says, don't worry, we can handle inflation if we have to? Jerome Powell at the Federal Reserve says the same thing. And then you've got the worry wart saying, yeah, but what if the Fed has to taper? I think if you're Joe Biden, I mean, I understand his rationale. Basically, get everything into the economy you can right now. We still have 10 million jobs we've lost in the last 12 months. And if we have problems with inflation that hits something worrisome like 3 or 3.5%, deal with it when it happens.
I just want to double check something. Are they still hoping that they can do it bipartisan? Or is it really going to be reconciliation? Because you get one shot a year at that, right?
Yeah, it's not going to be bipartisan. It's pretty clear Democrats have given up on that. They do need to get all the Democrats to agree because they only have a 1-vote majority in the Senate. I think that means there's no way there's going to be a $15 minimum wage component that will make it into that bill and stay in that bill. And the minimum wage might have to get stripped out completely for purposes of reconciliation. But just one point of clarification, Adam, it's you can pass one reconciliation bill per fiscal year. So the government's fiscal year ends September 30th, which means the next bill they may want to pass through reconciliation, big infrastructure bill, they could still go for that at the end of the calendar year, because come October 1st, that's when they get another shot at a reconciliation bill in the Senate.
Good times, good times. Rick Newman, thank you very much. Coming up, Morning Star's Christine Benz on why rebalancing is crucial for your retirement portfolio and where you should look to invest, depending on your years to retirement, right after this.
It's time for our retirement segment brought to you by Fidelity Investments. And for that, we want to bring in Christine Benz, Morningstar's Director of Personal Finance. And Christine, great to speak with you. So let's just start. We're looking at the market today. We're not too far from those record highs. When we talk about saving for retirement, I guess, how should we be thinking about this with high valuations?
I think people who have many years until retirement really shouldn't overthink it. Yes, the market is high, but to my mind, the alternatives are really poor. So if you have, say, 10 years or more until retirement, hold as much in stocks as you can handle. And then also think about tipping some of your stock exposure into foreign stocks, because we've seen foreign stocks dramatically underperform US. Many investors have been just content to let their US stocks ride, but think about doing some rebalancing at kind of the foreign to US level. And I always use the global market capitalization as kind of a starting point. The US market is like 56% of the global market cap today. Most investors don't have anything like 44% in foreign stocks, but kind of think about that as a sort of a way to set your direction if you are many years until retirement.
Okay, Christine, let's talk to the 50-year-olds who are watching, because everyone younger, you can go up and down about 2 more times in your cycles at least. You got $200K in a 401k right now, $200,000. What do? Keep it all in U.S. equities, or are you saying one U.S. equity fund, but break some of that 200K and look for, if your 401k manager offers it, some kind of global equity fund?
Yeah, I think that makes sense, or just add a dedicated foreign stock fund. But I would say for people who are 50 plus, they do want to think about de-risking that portfolio a little bit, because one thing we know is that we don't have as much control over our retirement dates as we'd like to believe. So to my mind, if you are within, say, 10 years of retirement, you need to have some safe investments in your portfolio, bonds, probably not cash at this point if you're not ready to retire currently, but you'd want to begin setting aside money in safer assets, because the last thing you would want to have happen is that you're at retirement and you're having to draw upon stocks when they're in some sort of a downdraft. That is a terrible thing in terms of a portfolio sustainability.
What, though, about a time-dated fund? Wouldn't that protect you in some manner?
It absolutely would. And the great thing is that investors increasingly are using those all-in-one managed type funds, or they're increasingly managed accounts that people can use within their 401k plans. The nice thing is that you can be completely hands-off with those products, and they do move you into safer assets as time goes by.
Christine, I want to ask you about a study that you were out with actually almost a year ago, back in the beginning of March, and you were talking about women and how they aren't as prepared as men when it comes to retirement. Over the last couple of months, we've been talking about more and more women dropping out of the workforce because of the pandemic. So what position are women in now? And I guess what can women do in order to better position themselves going forward?
Great question. And definitely things have been worse for women during this period, during this recession. Women have been stepping away from the workforce for a variety of reasons. Women, in terms of retirement readiness, tend to be in worse shape than men. They save less during their lifetimes, largely because of caregiving obligations for children, certainly, but also for elderly parents. And those things take a cutout of how much women are able to save during their lifetimes. So women are more likely to be poor in retirement. They're more likely to be exclusively reliant on Social Security. So a couple of things to think about. One is that if you are a female and you are contributing to some sort of a retirement plan, while you're working, make sure that you are contributing as much as you possibly can. Take advantage of catch-up contributions that are available if you're over age 50. And another thing to think about is, and people don't love to hear this, but continue working as long as you possibly can, and continue to delay Social Security as long as you possibly can, because Social Security is a lifetime benefit. Women live longer than men on average, and so delaying really does enlarge the payout that you're able to receive from the program.
Now let's talk to the 30 and 40-year-olds who are watching. Wouldn't it make more sense to speak to those folk about, don't worry about the size of the amount you need when you retire. How much income do you want to kick off from that nugget when you retire? Because that nugget's going to fluctuate with the markets. doesn't that become a more realistic way for people to plan for their golden years?
It absolutely does. And you hit on a key thing, which is that to the extent that you can tune out some of the market fluctuations, that usually redounds to investors' credit. And I say put as much of this on autopilot as you possibly can. We know that investors who use dollar cost averaging plans, as you get with a 401k plan, and use some sort of target date vehicle or other automated advice solution, those investors are able to painlessly get ready for retirement. And I think that's really the way to go for most people.
Christine Benz, great to speak with you of Morningstar. We look forward to having you back again soon. Thanks so much for taking the time to join us today. Coming up next here, 5-time NBA All-Star Chris Webber on how he's giving a boost to minority business owners in the cannabis space. More on that when we come back.
For several years in our country, a disproportionate number of people of color were sentenced to prison for breaking laws that had to do with things regarding marijuana. Now marijuana is becoming legal throughout the country, and the emphasis is on making sure that communities of color, which were disproportionately affected by those laws, now get their fair share of the growing business. To make sure that happens, Chris Webber, the NBA All-Star, as well as Jason Wild from JW Asset Management, have created a new $100 million impact fund to assist minority entrepreneurs in the cannabis sector. And I see both of them in my preview window. So I'm going to start with you, Mr. Webber. Why is this, I mean, $100 million is a lot to start. Personally, why was it important for you to take part in this?
Well, it was important for me, and thank you for having us on. It was important for me because after being in the business, I've just seen how there's not much access, whether it is to capital, whether it is to operational know-how, for a lot of minorities. And, you know, the communities have been impacted most negatively by these laws targeted at their communities. needs to be, I feel, the ones that take part in reaping the benefits. And so if they have a partner like Jason, who understands that he shares the same concerns, and he's an industry leader, and it starts with guys like him.
Well, Jason, going off of that, you're looking to level the playing field here. When you're looking at businesses to help identifying certain entrepreneurs, what are you looking for? And I guess, what's your end goal in this?
Sure. I think that a lot of the qualities of the businesses that we're looking at and the strategy that we're attracted to, they're going to be the same as if they weren't being run by these underrepresented minorities. So we want to look at for our regular fund, the companies that we've been the most attractive to more recently have been vertically integrated operators, say in limited license states. We would like to make those same type of investments in similar companies, but with minority members, and more specifically, Black entrepreneurs, because they have been so disproportionately incarcerated and harmed by the war on drugs. What we want to do is even the playing field, bring those entrepreneurs into these programs and support them, not just with money, but with know-how and offering them some infrastructure so that we're sure that they're going to be able to succeed. Because Chris and I know we both strongly share the view that if we do this and we just and these businesses are not successful, then we're not going to be able to continue to do it and to help more entrepreneurs.
Jason, very quickly, what makes you think Congress will pave the way for legalization nationwide this year? I mean, the president, Biden, said he's against it, although there are a lot of Republicans who speak against it are now for it.
Yeah, I think it's just a matter of time, whether it happens this year or it happens next year. I mean, the fact is we have state level programs that are very viable at this point, and where good companies can become sustainable companies that are profitable. So our investments in the space overall have not really been around timing of legalization on a federal level. It will make things easier when it's easier to bank, and there's not this. There's a punitive tax called the 280E tax, which is a real sap on the cash flow of these businesses. Those things would get better, and hopefully with legalization, and even more importantly, people will stop getting arrested if we have legalization. Right. So it's very, very important from that aspect. But from the business perspective, if things went on the way they are, where every state is sort of its own market, we can find and invest in very viable businesses.
Chris, I want to pivot from this to the NBA just to get your thoughts just on, obviously the NBA had a successful bubble season, but now that we're in the real world during this season, how do you think it's going so far?
I think the NBA is going great so far. I know there's a little bit of controversy. The All-Star game, and some players feeling that the season just ended so quickly, and it hasn't been much time to rest and recuperate. But you always have those things. The All-Star game is for the fans, and I think everyone's excited to see if LeBron can win a championship in his 18th season, or if a team like Brooklyn or Philly can dethrone them. I think the league's in a great lot of exciting basketball.
Also, news broke today that you're going to be teaching a course on athletes and activism at Morehouse. And I was curious, a lot of us think about recent events, but there is a historical, I mean, Tommy Smith and John Carlos from the 1968 Olympics. Athletes and activism are part of a history that goes back decades.
Yes, and shout out to people like Dr. Harry Edwards, who helped really forge this lane in school. I mean, when you think about all he's done when he started in 1968 with the Olympic movement there, and Dr. Carlos, he's not only a mentor, he's someone that I admire and consider a hero. And so being able to talk to him and others like a Spencer Haywood, when you look at antitrust laws, and the 4-year college rule, there would not be, his movement alone and going to the Supreme Court accounted for $30 billion alone talk about revenue from basketball players that left college early. And so there's always been activism in sports has gone in hand since the beginning. And so I'm just kind of proud, hopefully, to be a conduit between those and honor those that came before us, and then express to the next generation who these young men, or who these gentlemen, I should say, are.
It's always a pleasure to have you both here. Chris Weber, entrepreneur, 5-time NBA All-Star, founder of Weber Wellness. All the best to you. And also Jason Wild, JW Asset Management, founder and president, as you move forward with your $100 million impact fund. All the best, gentlemen. When we come back, we've got more for you on Yahoo Finance. The CEOs, we're going to hear from Representative Patrick McHenry's top-ranking Republican on the House Financial Services Committee for his take on yesterday's GameStop hearings.
The CEOs of Robinhood, Reddit, Citadel, and Melvin Capital, along with GameStop trader Keith Gill, testifying in front of the House this week, the House Financial Services Committee, on the GameStop short squeeze. The committee's top Republican, Congressman Patrick McHenry, spoke with Yahoo Finance earlier today about the hearing. Let's listen to what he had to say.
This is a story in a larger narrative. And the larger narrative is that retail investors, so-called non-sophisticated investors, under our securities law, they want more and better access to our markets. They want more investment opportunities. They want more sophisticated investment opportunities, and they've been locked out of it. So this is but a bullet point in a larger story, in a larger narrative about fees being crashed through competition, and about retail investors wanting greater access to more products.
And Congressman, I mean, I guess, there were criticisms even during the hearing of political theater on both sides. It was interesting, the start that we got when Robinhood CEO Vlad Tenev was talking during his opening statement. You had to kind of jump in there to stiff arm Chair Waters to kind of protect his testimony as she was kind of interrupting with questions of her own. What did you make of just the overall flow of this thing, and maybe the grade that you would have given it in terms of getting into the details?
I would give it less than a passing grade as far as getting into the details. Look, when you're the majority, not to quote Hamilton, the musical, but you get to choose the menu, the venue, the seating, right? And so the chair of the committee gets to determine when we meet, for how long we meet, and who's on the panel. And as a Republican, as being in the minority, I get to have one witness on the panel. So I try to get a witness who could answer the fullness of what's happening in the marketplace. The rest of the folks on the panel get to a piece of the story. The Reddit CEO got a couple of questions, but frankly is secondary. You're talking about asking the CEO of a company about stuff posted on one section of Reddit when they have millions of users. So I don't think the setup was right, and I don't think the panelists were correct. And I think it was about grabbing a headline rather than finding facts. The reason why I called the hearing and called for the hearing was so that we could get to the heart of what happened here and whether or not laws were adhered to, and whether or not we need to change laws to open up additional access, or what's really happening in the marketplace.
What do you see as the answer to that latter point that you just made about whether changes are necessary? And if so, what's the next step?
Well, I think, first of all, we need to ensure there's disclosure around payment for order flow. There is. That laws are adhered to in this transaction. That appears to be the case, and we're going to continue to dig through that. And so my clear takeaway is that to re-regulate or to enhance regulation or to layer on more regulation or to lock retail investors out is the wrong approach. New taxes, financial transaction tax, as one of my Democrat colleagues called for in the hearing, is not the right approach. Taxing people for their investment opportunities or taxing people for saving is not smart for our economy and for long-term saving. So we know there's some bad ideas. I think we have to look more deeply at what's happening here. What is happening is we have individuals that paid off student debt. We have folks that lost money, but we also have people that said, the hell with it. We're just going to invest. We don't care if we're going to get into this trade. We don't care if we make money or lose money. We just want to put the screws against a rigged system. And so they're speaking to the larger narrative piece that I mentioned, that they want more access to equity. And that's why I raised with the CEO of Robinhood whether or not they would offer equity to the users of their app. If they seek to go public, will they do that? The fact is that regulation out of Washington prevents that from happening. The Uber driver should have been able to have an ownership stake. They're the ones that made Uber successful. The Robinhood user is the one who's made Robinhood, the company, successful. So we need to make sure that we can open up equity, ownership in our society much more broadly than it currently is.
Yeah, and it's a complicated slate of issues you guys were getting into. So, just to be fair, there was a lot of moving pieces and you had 5 hours. So maybe, it could have been divvied up. I hear what you're saying on that front. When it comes to maybe the issues on Robinhood specifically, because of course, payment for order flow is something all the brokers get into, but Robinhood was the only one on the panel to talk about it. And I really enjoyed the line of questioning that came from Representative Anthony Gonzalez, who got into the details about what happened specifically when they had to raise the $3 billion to kind of cover the liquidity issues here. So I wouldn't necessarily let them off the hook right away. So what do you want to learn more about what happened there? Because obviously we saw GameStop stock. We were talking about it on Monday. We saw the trading issues come in later in the week. So what more do you want to learn about maybe what happened on a minute-by-minute basis that could be potentially problematic in locking out retail investors?
Well, I think that is a very good point. There is some detail here that we need to drive towards. And Representative Gonzalez from Ohio, I think, asked a really sharp question, which was getting into the nature of whether or not Robinhood was equipped to provide the access that they claimed that they were providing to their users, and why they lock customers out. And so they're raising $3 billion tells me that they needed additional liquidity. That's kind of obvious, right? That's an obvious statement to the marketplace. But we need to make sure that these institutions were properly regulated for the value at risk, properly regulated for what could be a very turbulent marketplace, hour to hour, minute to minute, day to day. And so we need to get more deeply into the heart of those issues of proper funding and the liquidity practices of broker dealers, and specifically new broker dealers.
All right, coming up, the TikTok economy, social media superstar Josh Richards on how he built his following and what's next. We'll be right back.
Okay, some of us are still trying to figure out how to get TikTok to work on our old Bell rotary phones. Bad joke. Sorry about that. Josh Richards, though, is a social media superstar and entrepreneur, and Julia LaRoche is one of our superstars. They're both here to talk about what's going to happen next in the TikTok economy. But Josh, you are, I mean, millions upon millions of followers. I don't think you're 20 yet. When I was 19 or 20, I was wasting time watching MTV. How do you get millions to follow you?
I mean, it's a lot of work. I've been doing it since I was 14. I've always went about it at a very business-minded, as a business-minded kid. I was hiring my sister at a 15% commission-based salary. We were tackling Musical.ly in the live stream space and just slowly but surely building up the following.
You know, Josh, you certainly are very business minded. And I'm going to quote an article that you published today because this part really struck me. You said, quote, "Why would I or my fellow influencers want to take an endorsement deal when I could build a company with my team, own half, and then directly benefit in its success when promoting the product?" I want to understand how you think about your role as an influencer and structuring the business deals and where you really find the upside.
Yeah, I think a lot of influencers are so intrigued by that instantaneous payout or getting that cash right there in their hand on site. And they don't see the value in the longevity from equity, from doing a deal that isn't centered around the cash or a pay to post. We like to focus on doing a lot larger deals if that's either me coming in as a chief strategy officer or coming in and actually co-founding the entire company from the scratch, like Annie Energy.
Josh, I'm curious to get your perspective just on why TikTok is so successful and why it works for so many users. It kind of goes back to what Adam was saying, how you've been able to build your following. But from your point of view, from the content that you created, what separates it from some of the other social media platforms?
I mean, the amount of user-generated content on TikTok is absolutely crazy. You've never seen a platform like TikTok and its ability to allow every single person, whether they are living in LA or they are out in Alaska, they're able to go and post a video that can go viral and can create a following off of it. So with TikTok just allowing so many people to do that, it's giving so many people that opportunity nowadays to really strive to be a social media creator and take that as a career.
Mm-hmm. And Josh, it's obviously, helped you launch your own business career as well. And you mentioned that Annie Energy is an energy drink, I suppose, that you co-founded, but also you've made a number of recent investments. I kind of want to understand, what is it that gets your attention when it comes to an investment? One, for example, you're reviving, I guess, the craze around silly bands, but also looking at financial literacy as an investment. Walk us through your process, and what is it that makes you want to kind of put your name behind it and your, I guess, kind of your own experience and really drive returns?
Yeah, when I'm looking at investments, a lot of the times it will have to do if I have some high conviction or a passion towards it. So when you're talking about financial literacy and then you go and look at investments like Step, I mean, they're really the only banking product that is marketing or is built for teens. And it's allowing them to build credit before they're 18 years old. It enables them to actually earn money by referring friends, and they can use the app to start sharpening their personal finance skills. And when I'm a social media creator preaching day in and day out about not spending your money on the clothes and the cars and all these luxurious items, and I'm talking about the investments I'm making, I need to be able to actually show that and practice what I preach. And with Step, that's able to be done.
Josh, I think when we had the graphic up, 24 million followers on TikTok, I was curious because I have relatives in your neck of the woods in Toronto and Montreal. But is this a global phenomenon? Are your followers global or North America? Because if you're not global yet, you're going to be a billionaire when you do go global.
No, it's definitely global. There is a large actually following over in Europe, the UK, and Brazil. I actually see a lot of followers from those locations, and I believe on Instagram there's actually up to about 4 to 5% of my followers from Brazil alone.
Okay, I'll go.
Josh, as we just wrap this up, when you think about your next steps, and Julia kind of hinted at this when you identify some of the investments, some of the attractive investments, when you would then potentially transition that to starting your own companies, I guess, what does that look like for you, and how are you charting that path because you're so young?
Yeah, I mean, when I go to co-found a company or I go to do an investment, I'm going in there with the mindset, not that I'm too young to do this, or I just feel like a lot of people will look at me and being 19 and they think, oh, he's not able to do everything that he's doing, or he hasn't been able to learn enough yet. He's too young for this. And a lot of people see that as either a disadvantage or some sort of luggage I'm carrying along with me. But I see it as a huge advantage. I mean, I'm able to get into those meetings and get into those rooms and go and meet with those people because of that young age and that sense of intrigue they have from it.
Josh Richards, I feel like I've wasted part of my life, but you can find me on LinkedIn if you're looking to hire. Josh Richards, social media superstar and entrepreneur. Thank you for being here. Julia LaRoche, good to see you as well. There is some news that has been breaking regarding Kim Kardashian and Kanye West. Let's bring in Ali Canal for more on this, as well as National Margarita Day, which is coming up. But first, the breaking news.
Kim K, National Margarita Day. It's a big Friday, but yes, Kim Kardashian has filed for divorce from Kanye West, according to multiple reports. A big question here is going to be what that means for the couple's finances. According to Forbes, they are both worth over $2 billion. Now, on paper, Kanye West has a little bit more money than Kim, valued at over $1 billion, while Kim Kardashian has around $750 million. However, Kim K K's assets are more liquidable. So if she wanted to, she could more easily convert that into cash. So at the end of the day, both really high net worth individuals. TMZ said that they do have a prenup in place. I did speak to a lawyer earlier about this, and he said it'd be very unusual if they did not have a prenup. This is Kim Kardashian's third marriage. She's been around the block, so this prenup is in place. And what that means is that anything that the couple owned or did business-wise prior to their marriage is protected. So that includes Kim K's keeping up with the Kardashian empire, along with Kanye West's Yeezy line. Now, the big thing that's going to be in question are their multiple properties. They have 4 homes. One of the homes has a $30,000 bathroom sink. They also have cars, art, collectibles, $30,000 worth of livestock. All of that is going to have to be negotiated. And this is the period that they are currently in, this open market bargain situation. For example, if Kim K gets the Hidden Hills house and that is worth more than the ranch out in Wyoming, and that's what Kanye gets, she might say to him, okay, well, take this convertible or take this collectible for X amount of dollars. Now, TMZ says that they are close to their property settlements. All seems to be very amicable at the moment. And that is very important because the lawyer that I spoke with said that this needs to be as smooth of a divorce proceeding as possible. You don't want to get nasty. You don't want to fight over the kids because that can ultimately impact the brand value of both Kim K and Kanye West and prevent them from growing their brands in the future. Kim K is very smart with this. She's been in the media, in the limelight for quite some time, and this seems to be the approach that she's taken. She's filed for joint custody. Kanye West seems okay with that. Neither party has contested the prenup. So if this continues, they should both ultimately get what they want out of this.
Now, switching gears here a little bit, I guess you can maybe transition it from saying some people heard that news and maybe they're going to need a drink, but you're also covering the fact that Monday is Margarita Day. It's National Margarita Day. I guess if you're looking to find the best deals, where can you find them and what can we expect?
Best deals. I mean, Margarita Day, National Margarita Day on Monday. I mean, Monday is normally the worst day of the week, but now it could possibly be the best. But there are some really good deals out there. We have Chili's, Bahama Breeze. You can go there and have a $5 margarita there. There's also the restaurant Tex-Mex on the Border. They are actually celebrating National Margarita Day the entire month of February. You can get a taste of their special tequila drink for also $5, your local eateries as well. But there is new data that suggests that not all consumers are gravitating towards the tequila-infused drink because according to Grubhub, virgin margaritas were actually trending leading up to Monday. So you see on your screen there, virgin margaritas are number 1, followed by tropical, on the rocks, strawberry, Cadillac, and lime. Now, this comes after an explosive year for mocktails with U.S. sales of non-alcoholic or low alcoholic beverages increasing over 30% in 2020, according to the intelligence company IWSR. We also saw dry January have a comeback this year, according to a new Morning Consult poll. Those that were surveyed, 13% said that they are participating in dry January. I am not one of those, but you know, if that's what people want this year because they've been drinking too much in the pandemic, there you go.
I certainly don't think people should abuse adult beverages, but I worked with a weathercaster many years ago in Cleveland, Don Webster of fond memory, rest his soul, who said that the United States started going downhill when they got rid of the 3-martini lunch. And as I've gotten older, I think Don knew something the rest of us had forgotten. Wasted again in Margaritaville. Thank you very much, Allie, and we'll be right back with what to watch for next week.
Welcome back. As we turn our focus to next week, a couple of things that we are watching. Adam, what's on your radar?
Johnson & Johnson, their vaccine, they've applied to the World Health Organization on the 26th. On Friday, they finally get to go before the FDA. Hopefully, we get emergency use authorization. We were asking Angelique Kamlani about this within a day after, perhaps as soon. But, this is not the first time at the rodeo for Johnson & Johnson. They've been around the block more than once, third largest pharmaceutical company in the world getting vaccines approved. So they're not exactly doing the walk of shame. All bets are that they will, with 100 million doses of their vaccine in the United States by the end of June. Shauna?
We have some pieces of housing data out next week. First on Tuesday, we're going to be getting the Case-Shiller report. That, of course, is home prices. This will be the December number. So the last report we got at the end of January was the November numbers. Now, in November, we saw home prices rise just around 9.5%. It was one of the largest gains on record in terms of where we saw the biggest gains. We had Phoenix, Seattle, and San Diego. Those three cities there showed the strongest price appreciation of all the major markets in November. So that number will be very important to watch on Tuesday. And then on Wednesday, we're going to get another reading on new home sales. And we've talked about this time and time again, but real estate market has really been so resilient during the pandemic. So whether or not that continues is a big piece of this puzzle when we talk about the broader economic recovery. Well, one more quick look at the markets before we let you go. Not too far from the flat line today. Dow barely positive, S&P in the red off 0.2%, Nasdaq holding on to positive territory. That does it for us today for Yahoo Finance. Have a great weekend. We'll see you on Monday.